markets.
Why is the pound doing what it's doing then?
Because there's an enormous amount priced in, I think, more than anything else. And I think there's two things. I think, firstly, remember, we priced in a huge amount of risk within weeks of the referendum all the way back in 2016. In terms of the trade-weighted value of sterling, it's been wandering around at the bottom of historical ranges ever since. I think from where we are now, there's one big risk remaining, which is negative interest rates. You listen to the conversation you're having about what is the purpose of more QE. The Bank of England's buying the gilts that Rishi Sunak needs to sell to finance everything he's doing. That seems to me to make perfect sense. To try to be the first major economy with a big current account deficit to experiment with negative interest rates, justified because it hasn't gone so badly for countries like Switzerland and Denmark and the European Union and Japan, which have big current account surpluses, seems to me to be a huge risk to run. So sterling, I think, goes on trundling in its current range unless we get negative rates, at which point it gets significantly weaker.
So what do you think the conditions would have to be for the BOE to do negative rates?
No deal Brexit, I think. I think they're doing the work now, so it's something that they'll be ready to do next year at the beginning of the year. If we go back to World Trade Organization terms for trade, and we get what they think will happen in terms of a real hit to growth at the beginning of next year, then I can't see how they avoid it. But if that doesn't happen, I get the impression they'd rather do more QE than run the risk.
Let's talk a little bit about what's happening with the euro. We've got a euro around 118 right now. We could have a weekly close kind of 118.80 that would get it out of its recent range. This at a time, though, Kit, when we are, and we're going to hear from Paolo Gentiloni in a few minutes' time, we are seeing the European Union, the Eurozone, being hit and hit hard by the virus. Do you think that the kind of the upward trajectory through 120 towards 125 that a lot of people have still got penciled in is viable if we continue to see the economic trajectory looking like it is at the moment? I appreciate there's another side to this, and that is the dollar, but nevertheless, the economic situation in Europe is not getting better. It's likely to get worse.
Yeah, I mean, firstly, the dollar side of it's critical, and that depends in part on the election, but it depends more than anything else on what the Fed continues to do. And I don't think we're going to close or reopen the real yield gap between the Eurozone and the US. But look, I think the critical piece from the European side here is, yes, we're in a bleak environment. As long as Europe's response is an aggressive fiscal response, preferably still a joined up aggressive fiscal response, then ultimately we can go back to where we were at the start of the euro's fall, when the US had aggressive fiscal policy and the Europeans relied entirely on the ECB. If we rely entirely on the ECB to solve the problem of the second wave, then I don't see how the euro gets through 120. As long as we get a decent fiscal response, then I think we've changed the mix of policy, and it'll lead to a strong euro. I don't think, given the growth numbers, that it's going to be a runaway stronger euro. So I don't think we'll be at 125 by Christmas, unless someone gives us some good news from somewhere. But I don't think we'll make it through 120 at the moment, except within the context of a weaker dollar across the board. But it is that fiscal reaction that's critical.
So let me ask about the dollar, because it feels like the U.S. is where Europe was, where now we're in some ways totally reliant on the Fed now to support the economy. If we're not going to get that $3 trillion blue wave stimulus, doesn't look like we are going to be getting that. So what's the downside potential for the dollar here?
Well, the biggest downside potential for the dollar is a good potential. It's that the Fed remains accommodative, but the global economy starts to recover. If someone finds a viable vaccine before the end of the year, and then we get production up around the world, you'll see capital flow out looking for better yields and better opportunities all around the world. And it'll be one of those good weak dollar stories that I shall stand and cheer for years, preferably. If what we have at the moment, which is a nervous, slightly uncertain weaker dollar that is just because of over-reliance on the Fed, then you'll see it reflected with currencies like the yen and the Swiss franc leading the way. And I don't think it can go that far, because all the big open economies, so like the Eurozone, we can't really thrive if the U.S. economy can't get some growth. So it'll be a smaller, more modest, weaker dollar and a less healthy one. So what we really need is a longer term story. But for now, look, the market's just buying into a narrative, the narrative that yes, we're going to get less of a trade war, we're going to get less of a fiscal package, and we're going to get more Fed accommodation over the next few months.
Kit, what do you make of the narrative shift that we've seen over the last day or so? We went from pricing in a blue wave, and that was good, and we've now got divided governments, and apparently that is good as well. Is this just short-term repositioning that we're seeing in markets right now? Is it sustainable? And if so, for how long?
Look, I think the first thing it does is it says that there are lots of narratives, but as long as the narrative comes back to the Fed is even more accommodative for even longer than the last time we thought, and it's getting hard to imagine how they could be more accommodative than I think they'll be, that apparently in terms of risk sentiment, that's enough to float every boat in the sea higher, and everything else is really just a small additional feature of it. So, we cite what it means for this or that sector in the equity market, but in the end, this is a risk rally born of super accommodative monetary policy, and we wake up today with more optimism in the market. That's what we'll get. Now, the trouble with these narratives, you say we're jumping from one to the other. We still haven't finished counting votes last time I saw, so we can change them round. And the bigger test in that sense, though, this evening will be whether the Fed, goes in and does ease more now or waits for a bit, because at the current point in time, things aren't yet so bad that they should be doing more QE yet. So the Fed has a sort of a messaging problem, given how much the market is asking of them.
Okay, so let's go to the Fed a little bit more here then. If they wanted to either signal, hey guys, we got your back, we don't know the outcome of the election, but we're going to get your back, what do they need to change in the statement? And if they're going to pull the trigger today, what would that actually do that would be meaningful? I mean, more QE or extending the weighted average of maturity, you're looking at a 7 handle on the 10-year. Like, what good is that going to do?
I have I'm struggling to see what they could do today, given we have thinner liquid markets. But if they came in and just announced they were buying more or buying further maturities, if they mentioned the words yield curve control, you could get a bigger reaction. If they do anything that talks about extending maturities and that anchors them down, but why would you today? I mean, in a sense, what the European Central Bank did is what the Fed should be doing, which is making it clear that it looks as if we're in for a slightly bumpier time on the economy. We meet again in a few weeks' time. Unless things are brighter than we expect them to be, we'll act then. That would make more sense to me.
Kit, why would the Fed do anything at this point? Financial conditions are actually looking pretty good. In fact, they've got better over the last couple of days as volatility has come down, as the equity market has improved. I would have thought that would be one of the key metrics that they're watching, and it's not getting worse actually right now. It is getting better. Presumably the Fed just sits on the sidelines. Wouldn't that be the message? Credit still looks pretty good as well.
Yeah, making it clear that they're ready to act again soon if need be. Look, the Fed is, I think, probably looking like everywhere else at a world where some of the economic indicators are slightly worrying for the next couple of months, that the labor market improvement is slowing quite significantly at this point in time. Now, we'll see what tomorrow's numbers throw out at us, because that'll give us a better read. And they're probably nervous about what could happen in terms of slower activity through the fourth quarter. They may have been nervous at the way the curve was gradually bear steepening until the election turned it round. But as you say, I think there's no sense in doing anything today, but they will be conscious of the fact that the market is, permanently bidding up its expectations, building up and bidding up its expectations of what the Fed can do. And so they have to do something to nod to that. That's, if we need to act, there's plenty more we can do.
Kit, always a pleasure. Thanks for your time. Greatly appreciated. Kit Jukes, Chief FX Strategist joining us from Soc Gen. Coming up, we'll continue to focus on the Eurozone economy. Could Europe be headed for a double-dip recession with these new lockdowns? We're going to have an exclusive conversation with this gentleman, Paolo Gentiloni, the European Commissioner for the Economy, will be joining us. And as we prepare for that, the vote count continues, Alex.
Yep, you're looking at a live shot now of Fulton County, Georgia, where officials say ballot counting's almost done. We care because that encompasses Atlanta, the largest city in Fulton County. So we might get some information there. Georgia State Voting Implementation Manager saying that it's continuing absentee and provisional ballots and overseas military personnel ballots as well. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Welcome to That's Debatable, an interactive series on today's most pressing issues. The resolution this time, is a U.S.-China space race good for humanity? We'll hear from both sides.
The competition, if you look at the past, led to innovation.
A whole new arms race could start.
And we'll get your perspective too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
Live from London, I'm Guy Johnson. Alex Steele's over in New York. This is the European Close on Bloomberg Markets. So, the European Union sees deeper economic scars from new virus restrictions. The Commission has lowered its growth forecast for a rebound and now says the economy won't reach pre-virus levels until 2023. Joining us for an exclusive interview, Paolo Gentiloni, the European Commissioner for the Economy, and my colleague in Brussels, Maria Tadeo. Commissioner, thank you very much indeed for your time today. We greatly appreciate it. The numbers that you've published today are pre-lockdown. How big is the risk to the downside relative to the figures that you've given us today, do you think, now, for both the European Union and the Eurozone?
Well, of course, we have a risk to the downside, but our figures are already considering the fact that the rebound that took place in the third quarter began to lose momentum already in September, and then in October, new measures, restrictive measures, new lockdowns began to take place. So the figures we are presenting today, which is a negative growth of 7.5% in the euro area and in EU with some slight differences, are figures that include two different phases that we were in. One, the third quarter of very strong economic rebound all over Europe. And second, the phase we are in, and that probably will affect the fourth quarter, which is the interruption of this rebound. And the two things mixed together gives us these final figures of a negative growth of 7.5% this year and a relatively slower path of recovery for next year, exactly because of the consequences of the situation we are in now.
Right, and Commissioner, the question very much in Europe has to do with what the next year looks like. I know that it's very difficult to predict because you have no visibility on the virus at this point, but do you think, given what we know and the restrictions that we're seeing across Europe, that we can avert a double-dip recession?
Well, it definitely, yes. I think that this is possible, providing that all our policies, the policies of the member states and our common policies, keep very clearly in mind that we should not prematurely withdraw our measures of fiscal stance as much as it is needed and for as long as it is needed. This, I think, can avoid that the stall we are in now transform itself in a second recession. This is quite possible, but it depends also on the strength of our support to the economy.
And a large part of that is the recovery fund, the joint recovery fund. Does it need to be bigger than what it is, particularly as we go into the second lockdown phase?
Well, I think that this decision was so important. We also defined it historical for the European Union, that our main task now is to implement it. And quite optimistic that we will be able to implement it in the right time. Then, of course, keeping this supportive fiscal stance mean keeping our extraordinary fiscal rules and state aid rules that we adopted in late April and March. And this allows member states to continue to support their economy with renewed strength. I understand that also the ECB will continue in its program with renewed strength. And this is also the reaction of the new phase of the pandemic.
Okay, let's just break that down a little bit. Let's talk about the rescue fund first of all, Commissioner. You just said you are confident that Europe will implement the fund at the, quote, right time. What is the right time? What is your timeline for getting the rescue fund over the line to make sure that it actually is able to start operating? Because we're not there yet. And when do you think the first euro will actually be spent from this fund?
Well, the first euros, so to say, arrived to member states in October the 20th, after the first issuance of a common debt from the European Commission. It was 17 billion of social bonds emission targeted to this instrument that we call SURE, that is supporting short-work schemes in member states. It was a very interesting emission because, as you know, it was oversubscribed 14 times. And this gives, I think, a good look also to the future much bigger emission that we will have, not only for SURE, but also for Next Generation EU. The timing of this Next Generation EU, which is the bigger envelope of our recovery fund, is that we have to approve national plans in next spring. This will allow to have the first disbursement of 10% of the amount to member states in late spring next year.
Right, but that can only happen if there's a deal over the European budget, because nothing is agreed until everything is agreed. Today, it seems something is moving, that we could be headed closer to a deal on that front. So does that mean that by the start of 2021, the European Recovery Fund is going to be fully operational? Is that what you're predicting now? No delays, not even a month. It will be operational by the start of next year?
Well, I think that what happened in the negotiation between the Council and the European Parliament is a very positive step forward, and this could allow the European Parliament to give its consensus in the plenary session. The consensus kick-start the process of ratification from national parliaments, and this process will, I think, allow us to keep the timing that we had in mind. And this, of course, is extremely important, because the implementation of this initiative is crucial not only for the recovery, but also, I think, for the strategic evolution of our fiscal policies in EU.
Right, so STARS 21, it's still the goal. And I want to pick up on something that you said, where you told us the ECB could potentially take action in December. I know you're not going to tell us exactly what the ECB is going to do or what you would like the European Central Bank to do, but do you have any conversations with them instead of, coming up with joint action?
Well, I think they are confirming their extraordinary programs of purchase in facing the pandemic. This was absolutely crucial in the months behind us to keep the financial markets, to keep the balance in the financial markets, to avoid instability, and I am sure that they will continue with their efforts.
Paolo, talk to me about, you mentioned it earlier in terms of the oversubscribed social bonds. Could you give me an idea of what you're thinking about in terms of total green bond issuance, social bond issuance, and if the ECB is going to have to buy them to truly help develop this market in a speedy way?
Well, as you know, we took a couple of very ambitious commitments. One is to have all this SURE fund of 100 billion euros through an issuance of social bond. And this will make the European Union, the European Commission, maybe one of the first global issuer of social bonds. At the same time, we decided that the other big emission, much bigger one, the 750 billion emission, would be partially through green bonds with a threshold of 30%. Of course, we know that the taxonomy and the characteristic of green bonds is still an ongoing discussion, but I think that also in this case, the European Commission has the opportunity to be a strong first mover among the global player, and I think this is also very important. And I'm confident it will work. There is a lot of demand in the markets, as far as I understand, for these social and green emissions.
Paolo, thank you for your time. We deeply appreciate it. Paolo Gentiloni, EU Economy Commissioner, and Bloomberg's Maria Tadeo. Thank you for joining us as well. Guy?
Let's talk about what's happening in the markets, Alex. We're wrapping things up here in Europe. This is the close. Let's work our way through exactly what we're seeing. We'll see the final numbers in just a moment with the auction process done and dusted. But nevertheless, we have had a positive session, another positive session for European equities, up when it's with the Stock 600 by over 1%. We're trading at 366 now. We've pushed up quite nicely. The really standout story today is just the continuation of the drop in volatility that we have seen. We're also seeing a continued strong bid for the euro. The pound has had a reasonably good day as well. Maybe that's why we're seeing a little bit of underperformance of the FTSE 100. But the euro up by 0.8%, got a 118 handle now. I'm told by the end of the week, if you get up through 118.80, that would be a very positive signal. The pound back through 130, 130.97. We've seen the Governor of the Bank of England out with an additional 150 billion today when it comes to the QE programme. We've seen the Chancellor of the Exchequer here taking advantage of that and extending his furlough scheme through till March. We are seeing a much more kind of sort of even session when it comes to the bond market. Yesterday, it was a kind of big curve flattening as we saw a whole sort of series of trades being unwound. Today, a little calmer. And as you can see, we're seeing a little bit of movement in terms of yield moving higher. The FTSE 100 up by 0.3% today, underperforming continental markets, but you have seen an outperformance of the pound today on the back of what we got from the Chancellor and the Governor. 59.02 is where we're closing out. The DAX and the CAC 40, though, in Paris and Frankfurt up very nicely. The DAX up by nearly 2%. European markets, though, in general, remember, remain at reasonably suppressed levels. In terms of some of the numbers that we've been watching for some of the core stocks that we've been focusing on today. Commerzbank, we'll talk about the banking sector in just a moment. ING and Commerzbank not having good days today. Commerzbank down by 5.5%. Net interest income not looking particularly good at the moment. That very flat curve continues to be very difficult with negative rates in the Eurozone. AstraZeneca talking about a vaccine by the end of the year. Pascal Soriot talking about that, but it is having an impact into the rest of the business. And you saw that in the numbers a little bit earlier on from Astra. But a good few days for the healthcare sector today, flat. And ProSieben Sat.1 over in Germany, a tick up in ad yields. We were talking to Discovery a little bit earlier on, and that's been a much more positive story today. That stock rising really quite nicely. The other sector we've been focusing on, Alex, the car sector.
Right. Good point. You brought that up. Car sales falling in Europe's four largest markets last month as the coronavirus continues to put pressure on economies. We spoke to Volkswagen CEO Herbert Diess. He says he does remain optimistic. He spoke with Bloomberg's Western European managing editor, Chad Thomas.
After this first wave, we had good order intake. We have very high product momentum, so we have many new products coming to the market. I would even say that also because of the lockdown, there was a little bit of demand postponed, so we have a healthy order bank, and we are relatively confident for the next weeks to keep production high and maintain also our sales level. If we don't get into a real shutdown of our dealers and disruption of the supply chains. So I think if well managed, if people now remain disciplined, and if we could drive the cases once again down, and we don't get to the targets of the, or let's say of the limits of the health systems worldwide, I'm still optimistic that we can manage the crisis and get through it. A democratic program probably would be more aligned with our worldwide strategy, which is really to fight climate change, to become electric. No, this is the way we are going. On the other hand, I would say over the past years, we could establish really a trustful relationship with the Trump administration and government. I think we did a lot also to contribute to build America. We are investing a lot. We're building up a new plant, a battery factory, a new car plant for EVs in our Chattanooga site. Yes, at the end, this is the decision America has to take now, and we only can watch, and we have to adopt ourselves. America will remain a key region for us.
Volkswagen CEO Herbert Diess a little bit earlier on, talking to Chad Thomas. Let's switch gear and talk about what's happening in the banking sector. Several names out with earnings today. Bloomberg talked with a number of top executives about the challenges they are now facing.
We have this big issue on the capacity to pay the dividend, which is certainly the major factor which explains why the European banking sector is down this year. And I think to valuation, which makes no sense actually compared with the long-term potential of the banks.
We are still in a stage where we definitely do not really know what's going to happen. We will closely monitor over the next couple of weeks and months.
The ECB is being responsible to make sure that they see clear line of sight from an uncertainty perspective for the corona in light of what we discussed about the second lockdown, we do reserve dividend for payment. So whenever that happens, we have reserved those dividends, allowing us to continue our business while at the same time providing the right returns to our shareholders.
So let's talk about it in a little bit more detail. Basically, SocGen and UniCredit beat estimates. Commerzbank and ING missed. Let's talk about it all. Let's go to Frankfurt. Bloomberg banking reporter Steve Ahrens joining us from there. I want to talk a little bit about Commerzbank because I think it kind of encapsulates the narrative quite neatly. Other banks that have big investment banking divisions are doing well. You've seen that with BNP, SocGen certainly having a reasonably good time of things as well. Commerzbank kind of almost encapsulates the European Eurozone economy much better, doesn't have that benefit, and is feeling the effect coming through of job losses and also the COVID effect. Is that the way that I should characterize the story?
Yes, absolutely. That's exactly right. Commerzbank, as you pointed out earlier, is hammered by the low interest rate environment, by negative interest rates set by the European Central Bank, and of course the Corona credit provisions they have to make. And it can't fall back like the investment banks on trading, which is just benefiting from this massive trading boom. SocGen, Deutsche Bank, all of them, the massive trading results is boosting them. And so there's really a tale of two cities, two banks here.
Here's a fun question. Do either of them last? There were some loan loss releases, but now there's another shutdown coming. What does it do to Commerzbank? In addition, can the win in trading that we've seen from these big guys sustain?
I think those are exactly the two big questions that everyone is asking, and no one has a good answer to. Because, first, the trading boom, it all depends really on the Corona, how it unfolds over the coming months. Because if it stays with us, that's probably, I don't know, but I assume it's probably good for trading, but it's bad for credit provisions. The Commerzbank CFO on Bloomberg TV earlier today said they expect more hits in the fourth quarter, in the first quarter next year, but she was incapable of saying just how much it will be because it all depends just how bad the second lockdown will be.
In terms of the reshaping of these businesses, we are seeing cuts, and Commerzbank is doing it, ING is doing it as well. How much of what we're seeing in the numbers right now is just a reflection of the need to cut those costs, to lay people off? And is there a belief within the analyst community that once that's happened, these banks emerge fitter and healthier? Because the backdrop is still very, very difficult. And you wonder whether or not we're still in this position where the operating environment is moving kind of in front of them, is getting more and more difficult. So they're always going to have to play catch up in terms of cost cuts.
Yeah, I think that's true. It's certainly many of these banks, most of these banks will be shrinking over the foreseeable future over the coming years. It will be one round of cost cuts really after the other. They don't have an alternative because revenue is not coming back. There's not going to be much growth. All they can do is try to shrink costs. And, of course, this has been going on for many years. So there isn't really much they can cut anymore. But there is nothing else they can do.
Steve, always a pleasure. Thanks for your analysis throughout the day on these big bank numbers that we've been working our way through. Steve Ahrens joining us from Frankfurt. Let's take a look at where European stocks have settled. Positive day, more so on the continent, but the FTSE 100 suffering a little bit from a pop in the pound that we've seen today as a result of both fiscal policy and monetary policy from Rishi Sunak and the Chancellor and the Governor of the Bank of England just next door to us here. We'll carry on the coverage. We've got a press conference coming up at the top of the hour as well with Boris Johnson. We'll take that on the cable show. John Ferrer and I will be walking you through that hour on Bloomberg Radio on DAB Digital Radio. This is Bloomberg.
I don't remember a time, and I've been investing for over 50 years, I don't remember a time when I've seen such volatility as we see today.
Have a transition from the oil industry, yes.
Oh,
I will
that's
transition.
a big statement.
It is a big statement because it has to be replaced by renewable energy over time, And I'd stop giving to the oil industry, I'd stop giving them federal subsidies.
That was Vice President Joe Biden speaking at the last presidential debate. That was the slip up that some in the oil industry really cringed with. And you might say it did impact the election vote. Pennsylvania is among the states still counting ballots the day after the U.S. general election. The results may show that the role of the fracking industry in the 2020 race, you can see there that's the intricacy of natural gas pipelines and really centered in a lot of those red states. Well, let's talk to one man on the ground, Scott Sheffield, the Pioneer Natural Resources CEO. Pioneer is one of the biggest shale players in the Permian Basin, released earnings yesterday, just got off the call, fresh off of an acquisition of Parsley Energy as well. Scott, it's always good to talk to you. What does an election, a divided government potentially mean to you as CEO of Pioneer?
Yeah, thanks, Alex. Always great to be with you and Guy on your show. Obviously, I think what's going to happen, there's two key races in Georgia on the Senate, but I think at the end of the day, the Senate will have 52 seats, and Democrats will have 48. So I don't see a lot of changes in regard to taxes on the industry or any major changes. If Biden is president, I think the biggest issue, he's already said he's not going to ban fracking, but the question is whether or not they stop issuing drilling permits. That will have a significant effect on the Gulf of Mexico, Permian Basin in New Mexico, and also on Wyoming. That's probably the biggest issue. We were against the rollback of emissions, which Trump did in 2016. We were totally against that, wrote a letter on that behalf. I think Biden will obviously roll back some of those Trump efforts. We have no federal lands, and so there's really no issue for Pioneer in that regard.
Well, you brought up emissions, and that's interesting because one of the things that he can do is get much stricter methane emissions, which would in essence raise the cost of drilling a well because you have to find a way to deal with the emissions. How does that not why do you want them?
Well, as you know, since I came back about 18 months ago, Alex, we've led the effort to stop flaring in the Permian Basin. Pioneer has the lowest flaring intensity. Rystad just reported we're down below 300 million a day flaring in the Permian Basin in its entirety, both in New Mexico and Texas. We need to get that number down to less than 100 million or even 50 million. I think the next step is to go no routine flaring going forward. So there's a lot of groups working toward that. It's in the World Bank already. So it's something that we hope that we all adopt over the next 5 years by 2025. So flaring really needs to stop both in the Permian and in the Bakken.
Do you think, though, that with divided governments, that the pressure to make this happen is lower now, Scott? The industry, and you've led it, has started to kind of talk about its ESG credentials. But do you think the lack of leadership out of Washington, particularly when it comes to a sort of Green New Deal, will slow that process down for the industry?
It'll slow the Green New Deal process down, but the industry is already committed. So in talking to most of the trade associations and other groups in the Permian Basin and the Bakken, we got to take flaring off the table. It needs to get down to essentially zero flaring throughout the U.S. shale plays. And so I just think it's going to be industry driven. We led it starting 18 months ago. People are catching on. And if you look at the data, almost all the companies are improving their flaring intensity significantly over the last 12 months. So I think it'll be industry driven anyway. We need to take it off the table. And so it doesn't have to be led by either Biden or Trump.
One area where it is led by, though, is the Texas Railroad Commission that does issue flaring permits. Jim Wright, the Republican, took that seat. Is that a bad thing, then?
No. In talking with the Texas Railroad Commission, we've already been talking with Christy Craddock, commissioner, and also the chairman. Wayne Christian, and they are both very supportive. They're getting more aggressive of issuing flaring exceptions. And so I already see positive response. So I think if Krista would have been elected as a Democrat, it may have happened sooner. But I think the Texas Railroad Commission understands how important it is to take flaring off the table in the Permian Basin.
Scott, I want to pick up on some of the comments you were making up on the call a little bit earlier on, talking about kind of waiting for OPEC to make its decisions before you start setting out your budgets for next year. What do you expect from OPEC?
Yeah, so there's two big issues that we talked about. One's the vaccine. Secondly, when are we going to get the vaccine and get it distributed? And then the second issue is the OPEC meeting on December 1st. So this recent monitoring committee, as y'all saw, they met recently. They're talking about not adding the 2 million barrels a day January the 1st. They're even talking about deeper cuts, which may be needed. So we need one of those two things to happen. Do not add back 2 million barrels a day January the 1st, and look at eventually deeper cuts. The U.S. shale is already going to be flat. We've already declined about 2 million barrels a day from that 13 million barrels a day. We peaked in February of this year. We're down to about 11. If you take out the recent hurricane noises in the Gulf of Mexico, we're probably going to be stable around 11. I see no more growth until 22, 23, and it'll be very, very light in regard to the U.S. shale industry ever growing again.
Scott, isn't that just basically asking OPEC to step back so you guys can eventually produce more at a better price? I mean, that's basically what you're saying, right?
No, it's all about, Alex, free cash flow. Our shareholders have spoken over the last 18 months. Everybody wants production to be essentially flat, very minimal growth until it's really needed, and distribute us the cash flow. And so we're moving forward with a strong base dividend, over 2.5%, and a variable dividend that will approach somewhere around 3 to 5% over the next several years.
Scott, you brought up the vaccine a little bit earlier on. We may get it over the next few months. What impact do you think it's going to have in terms of demand for products? Here in London, we're in lockdown again. Across Europe, we're in lockdown. The US, the case count is ticking higher. I'm just kind of, I'm curious as to how you see things developing. You may not get lockdowns in the US, but people aren't going to behave the same way. So how do you see the demand outlook?
No, in fact, I did a survey with a lot of our employees. The first thing when they get the vaccine, you know what they want to do? They want to jump on an airplane and travel around the world. So I think there's a pent up significant demand that people are tired of living in the home. And so I don't buy the fact that everybody's going to stay home. There's going to be no more driving or no more airplane flying. So I'm very confident we're going to get back to a 100 million barrel a day market sometime in 22. And people are waiting for that vaccine. So I think most people will take the vaccine sometime the first half of 21. And you're going to see this pent up demand released, and you're going to see demand come back quicker.
You mentioned when we were talking about OPEC that the need for them to cut was really a free cash flow issue for you because investors have spoken in terms of wanting some payback. You have a sizable variable dividend. What do you think the importance of that is to get investors back into the sector when investors just seem really hard pressed to want to bet on energy right now?
No, I think it's all about free cash flow yield, Alex, and we need to get our free cash flow yield up into a double-digit number. We see doing that in 2022, 23. We see several people moving in that direction in our industry, and that's going to be the main driver of establishing that variable dividend. Or some people may just stay with a base dividend, but they got to continue to increase the base. You just can't put any free cash flow back into growth. Mm-hmm. And so I think that's the key.
Do you think it's going to get more investors to come back?
Yes, I do, eventually. So it's all about returns. And we have to take away the myth that we're going to start spinning in an upward cycle. If we see oil prices in $50 to $60, let's say in the next 12 months to 24 months, there's still this fear factor that we're all going to return to growth. Mm-hmm. And so we just have to convince them with a track record. It's probably going to take a couple years.
And just one nerdy question as we wrap up. I'm curious as to when you are investing in the business. Is it going to be in growing new production, or how much of it is just going to be going to help in any decline rates and stem whatever gap you may have just to keep production flat? Give me some insight into that.
Yeah, we gave a range on the call of 0 to 5%. We came out last quarter with Pioneer establishing a 5% production growth rate. Parsley has come out with a flat production growth case. We won't make that decision on what to take both companies combined. And we gave a range out today on the call, 0 to 5%. And that's going to be very dependent in regard to what happens with the vaccine and OPEC. But long term, we intend to grow both companies at about 5% per year. That's the output of our model, but it's all focused on free cash flow and giving back returns to the investor.
Scott, it's such a pleasure to speak with you again. Thanks for your time today. Scott Sheffield, Pioneer Natural Resources CEO. We continue to watch results from Nevada. They're due to be released in a few minutes. At noon, New York time, President Trump's campaign saying it's filing a suit to stop improper voting. The current Electoral College vote count, Biden 264, Trump 214. Joining us now is Bloomberg government reporter Greg Giro. Greg, we've seen a number of pieces of news over the last few minutes. A Georgia judge dismissing a lawsuit by the Trump campaign, that according to AP. This according to the Michigan AG. Lawsuits lacking in merit, not supported by the facts. So we're getting pushback legally, but I'm curious as to where we stand with the vote count. Are all the vote counts still on? And what does that do in terms of the timing?
Yes, the vote count continues today as we speak, Thursday midday here in the United States on the Eastern Coast. And Joe Biden still has more paths to a 270 electoral vote majority than Donald Trump. We've had updates in states including Georgia, where President Trump leads, but his lead is down to about 15,000 votes and 0.3 percentage point. We've had counts in Democratic-friendly counties, including the county that includes Atlanta, that have narrowed the president's lead. The question is, will there be enough votes for Biden to overtake him in Georgia? But Biden does not need to win Georgia to win the presidency, so long as Biden keeps his advantage in Arizona and Nevada, where we should expect that update soon. As you mentioned, Joe Biden with those two states would get 270 electoral votes and win the presidency.
Hey, Greg, where are we with lawsuits right now?
Well, they seem to be flying around. You mentioned that one in Georgia that had been dismissed, and I expect more to come up. We're just very litigious when it comes to elections. This is something we see about every 2 years. I expect the litigation to ask for a recount. I think we've got one in Wisconsin, although Biden has a 20,000 vote lead there, and that state has been called for him. But at the moment, I see nothing that would really stop any counting. The Trump campaign is questioning the counts in how the ballots are being tabulated in Pennsylvania and Georgia, where he's leading, but he's also that also comes as Trump is waiting for votes in Arizona and Nevada, where late counts the Trump campaign would need to put him over the top there. So it looks like they want to oppose counting in states where they're ahead, but they need votes to overtake Biden in Arizona and Nevada.
Mm-hmm. Greg, thank you so much. A dictionary of stats for this. Bloomberg's Greg Giro, thank you very much. That wraps it up for me and Guy here in the U.S. and in London. But coming up on Balance of Power with David Weston, Sam Zell, Equity Group Investments, will be joining him as we still count down to the vote. This is Bloomberg.
There are $3 billion being prepared. So the lending program has increased. So that's the very important feature we did not expect.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, I'm David Weston. Welcome now to Balance of Power, where the world of politics meets the world of business. Another day of suspense in the presidential election, with the world waiting now for results in Nevada, a state that could take former Vice President Biden up to that magic number of 270 electoral votes. As we wait for more results, which may come out this hour, actually, welcome now our Bloomberg's chief Washington correspondent, Kevin Cirilli, been with us throughout. So bring us up to speed. What are you looking at right now, Kevin?
Well, President Trump's former director of national intelligence, Rick Grenell, is going to be in Nevada today, and they are expected to announce new legal filings in this battleground state that right now, largely amongst early voting counts, is trending toward Democratic presidential nominee Joe Biden. Now, that would put him at the magic number of 270, the threshold that's needed to clinch the presidency, in addition for Joe Biden. In addition to legal action that the Trump campaign is looking into for Nevada, they're also threatening legal action in Pennsylvania, Georgia, and some other battleground states. Now, we should note that in the battleground state of Pennsylvania, they are saying, the Trump campaign, that they have gotten a victory by allowing poll watchers to be participating in these votes that are being counted. Either way, when I speak to sources on both Joe Biden's campaign as well as President Trump's campaign, both sides are saying that they feel confident that they will win. There are no more scheduled public events for President Trump later today, so we aren't, as of now, anticipating that we will hear from President Trump on camera. Beyond that, we should note that another state that the Trump campaign says that they would like to see reversed is in Arizona, Maricopa County, where Phoenix is located. Those results anticipated in the evening hours, 9 p.m. Eastern, on New York time. So bottom line, that's where things stand as of now. But there will be, as you mentioned, David, a steady inflow of data, including in this hour in Nevada throughout the day.
Yeah, and on the subject of that Pennsylvania victory, as President Trump's campaign says, we're going to have Professor Rebecca Green of William & Mary on just in a few minutes from now to talk about that. But let's go back to Nevada if we could. We've gotten familiar with Maricopa County in Arizona. Talk to us about Clark County in Nevada.
Well, Clark County is where 2/3 of all of the state's votes typically come from based on demographics. This is where Las Vegas is located. This is an area which has seen an increase in, or has seen a demographic shift in recent years and an increase in Hispanic votes. We should also note just how Clark County has been absolutely ravaged as a result of the economic calamity that has been brought on by the COVID-19 pandemic. Think of tourism, think of how Las Vegas and the entertainment industry and the supply chain surrounding that have really been impacted here. So it's where unemployment is highest right now in the United States. And then a final point, just in terms of the political shape of it, this is Harry Reid country versus Sheldon Adelson country. And so there's a lot of politics, Nevada politics, as you know, David, can be very volatile, to use a somewhat neutral word.
Okay, Kevin Cirilli, please stay with us, our chief Washington correspondent. In the meantime, we do want to bring in Rebecca Green. As the presidential race narrows, the lawsuits seem to multiply, with the Trump campaign now pursuing actions in Michigan, Pennsylvania, and Georgia. To take us through that range of actions, we do welcome Professor Rebecca Green of William & Mary Law School. Thank you so much for being with us, Professor. Give us your take right now on where we are, and start with that Pennsylvania decision, because we had an announcement a short time ago from the Trump campaign. They think they have a major victory here. As I understand it, it says you can actually have people go in within 6 feet to monitor the counting of votes.
Yeah, so several of the claims that the Trump campaign are bringing
relate to transparency measures, election observers being able to watch the voting process unfold. All states have laws that allow members of, different states have different laws, but it allows somebody, either party representatives or even just members of the public, to observe the counting process. And that's, of course, to ensure that the public can, oversee what's going on and make sure that, satisfy themselves that there's nothing wrong with how the votes are being counted. And so I think it's entirely appropriate for members of both parties to press for, the ability to observe meaningfully. And, I'm glad to see it when courts assist campaigns in ensuring that those transparency laws are followed. I think it's a win for everyone because, the more transparent the process, the more people will have confidence in the outcome.
A bit of different news, just to interrupt for a moment. The UK now is telling people arriving from Germany and Sweden to quarantine. That's something we want our audience to know. Professor Green, let's come back here. Transparency, it's hard to be against transparency in this day and age, but I've heard a lot of accusations of fraud really coming out of the Trump campaign. I don't think I've heard much of that from the Biden campaign. And yet I'm sort of short on specific instances of what the fraud is that they're alleging. Have you seen anything supporting these lawsuits? For example, affidavits. Wouldn't that be normal to have an affidavit saying we've seen that instance of fraud?
Yeah, I mean, you can make allegations till the cows come home, but unless you have hard evidence of an issue, I don't think it's going to get very far in a court situation. So we would need to see evidence. It's not something you can just kind of claim broadly and get anywhere on in the course of litigation.
So we have the transparency claims. We want our observers in there to make sure there are no shenanigans, fraud or otherwise going on in Michigan and Pennsylvania and things. There's also the question of, one could call them late ballots. That is to say, absentee ballots that are postmarked by Election Day, but that arrive later. You have that issue in Pennsylvania and in North Carolina, which has been litigated some already. Take us through that litigation.
Yeah, so the question is, whether or not in Pennsylvania, for example, the state Supreme Court could authorize the state to accept ballots that were postmarked by Election Day, but returned by the Friday after Election Day to the election officials. And the question there is whether or not the state Supreme Court has the authority under the Constitution to make that kind of change. The GOP alleging that only the state legislature can do that. And so that could certainly play out. That's something that the Supreme Court has indicated it's thinking about, even though it denied the stay for the Pennsylvania Supreme Court's decision. But again, I think as with all of these cases, what's really going to matter is whether or not an outcome determinative number of votes are at issue. So I'm assuming that once the word went out, and I know that campaigns were pressing hard for people to get their absentee ballots in well advance of Election Day, meaning that the number of ballots at issue might be quite small. And so depending on what the vote totals are in Pennsylvania, that may not even be enough to overturn an outcome. Not to mention that it's very possible that members of the Supreme Court will find that the voters in that instance had a reliance interest on the deadline being as the state Supreme Court declared it to be. So even if they did agree that the state Supreme Court lacked authority to change that deadline, that may not necessarily mean that those votes would be invalidated.
So, Professor, this is, I think, a terribly important point that you make. I want to emphasize it, the determinative number of votes, because even if there is a case that it has some merit to it in the Pennsylvania situation, as you say, there have been a couple of justices who said, yeah, I think that's worth taking a look at. It doesn't really count unless the number of votes that came in after the election but were postmarked before were enough to make a difference in Pennsylvania, and Pennsylvania is key. That's potentially different from 2000 and Bush versus Gore, where we all knew what was going on down there in South Florida would determine the election.
That's correct. I mean, I think, all of these lawsuits that are being filed, whether or not they have merit, whether or not, election officials have failed to follow the law, as some of them are alleging in terms of the counting process, none of that will matter if the vote totals don't show that the disputed ballots would impact the outcome. So we can't really know what litigation, matters until we know, until the counts are certified.
So finally, Professor, we have a viewer actually writing in and saying, when it comes to a recount, because there's now talk about a possible recount in Wisconsin, if you go back through history, how often do those recounts work, and how many votes get switched? Is it 1,000, 100,000, 1 million? What's the historical experience with recounts?
Yeah, we've actually just I think it was Fair Vote that just published a really amazing study that looked at what the total the changes were as a result of recounts, and it's very small. It's very rare. First of all, it's very rare that a recount would overturn a result, and second of all, if there is a vote swing, it's typically in the hundreds, and not at all in the thousands or even hundreds of thousands. So, I don't think again, it's going to depend on what the margins are. If there's if we have a Bush versus Gore situation where we're dealing with 537 vote spread, then a recount could be consequential. But if you're behind by 40,000 votes or whatever, I don't think you can ask for a recount. And different states have different laws on how that plays out. But it's very hard to make up that spread.
Yeah, if memory serves, I think the number in Wisconsin is 20,000 right now. Thank you so much. It was a real pleasure. Very helpful, Professor. That is Rebecca Green, William & Mary Law School professor. Coming up, the state of the race in Pennsylvania with former Democratic Governor Ed Rendell. And then later this hour, Sam Zell, founder and chairman of Equity Group Partners Investments, weighs in on what the election could mean for the economy and for investors, for that matter. This is Balance of Power on Bloomberg Television and Radio.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We are now getting a few new numbers from Nevada, that critical state. Former Vice President Joe Biden has increased his lead by about 5,000 votes. About 15,000 came in during the last tranche that we just got, but there are more yet to come, as I understand it. We're expecting those to come in throughout the hour and maybe even beyond. In the meantime, we read from within the Biden campaign. We welcome now Bloomberg government congressional reporter Emily Wilkins, who is covering the Biden campaign at its headquarters in Wilmington, Delaware. So welcome, Emily. Great to have you back with us. What is the spirit there right now, would you say, among the Biden campaign?
Well, the Biden campaign said this morning that they are positive, but they are still urging everyone to wait. We are still looking for numbers to come in from Nevada, from Arizona, from Georgia, from Pennsylvania, although the Biden campaign is feeling very optimistic about their chances in each of those states.
So, Emily, if you can, give us a sense of if they're worried. They must be worried about something. Everybody's always worried about something. What are they worried about? What are they focusing on particularly they think they might be vulnerable on?
Well, we're seeing particularly Arizona, which, remember, the AP and Fox News did call Arizona for Biden. But last night, we saw the margin between Biden and Trump close a little bit. We're still waiting for a lot of ballots to come from Maricopa County, as well as other areas of the state. That's something that we're watching closely here. The Biden campaign is saying that they still feel confident they'll see a boost when it comes to Arizona. But that's one place where Biden's lead is shrinking.
Okay, Emily, thank you so much. Great reporting from the Biden campaign. That's Emily Wilkins. In the meantime, apart from Arizona, Nevada, Pennsylvania remains a key element in this presidential contest. And when it comes to the Keystone State, there is no one who knows it better than Ed Rendell, two-term governor of the Commonwealth, two-term mayor of Philadelphia, and now special counsel at Ballard Spahr. So welcome, Governor. Great to have you with us. Where do you think the Pennsylvania race is right now?
Well, I think Joe Biden's going to win. By the time all the votes are counted, he's going to win by about 80,000 votes. There are about a little less than 500,000 votes out. They're almost all mail votes, except for a few divisions in Philadelphia where Joe Biden will get 85% of the vote in those divisions. But the mail vote has been running about 73% Biden. If that holds up, he'll win by at least maybe close to 100. But I think it's going to shrink a little bit, and I think he's going to win by 80. But it'll be a substantial win, probably twice the margin that Donald Trump had in 2016 when he beat Hillary Clinton in Pennsylvania.
So what's your take on all these lawsuits? And we had just this morning an announcement from the Trump campaign of what they called a major victory with at least one judge, I think an appellate judge in Pennsylvania, saying you have to let those poll watchers come in and observe what's going on.
But as long as the poll watchers behave themselves, I don't think there's any problem with it. Look, the people who do the counting, they're civic heroes. Some of them volunteer their time, some of them are paid, but paid very little, and they're there under pressure. Everybody's yelling at them, speed it up, let's get this stuff done. And they're Republicans and Democrats. They're just good, ordinary citizens who care about the democratic process. So you could have anybody in the world watch them. Doesn't bother me. It's not going to change a thing as long as the watchers behave themselves. Don't yell, don't shout at them or anything like that.
So if, in fact, you get an 80,000 vote majority, as you predict right now, what does that do to this issue about the ballots that were received after but postmarked before Election Day? Does that remain a viable claim? Because that's something where President Trump's campaign has now intervened in the Supreme Court proceeding.
No, they won't even bother to be counted because they'll be way less than 80,000.
So that becomes irrelevant. Let's move forward here. Let's assume that that's correct. If it's correct, by the way, then by most projections, former Vice President Biden will be the next president of the United States. The question of the Senate very much hangs in the balance right now. Where do you think the Senate lies?
Well, I think the Democrats are going to pick up one or two seats, but not enough to take control of the Senate. But it looks like there'll be two runoff elections in Georgia, because neither of the candidates in either of the elections, and the reason there are two elections is one senator stepped down and had a temporary replacement. So there are two elections in Georgia. Neither one of them is the winner going to get 50%. So there's going to be a runoff election, I think, January 5th. And if the Democrats were to take both of those Senate seats, I think they would take control, assuming Joe Biden becomes president. That's a long shot, but Georgia looks like it's up for grabs. Biden may win it in the presidential. So it's going to be a heck of a, if all of us who thought the elections would be over by at least Thanksgiving, no, it's going to be a Christmas present that's going to keep on giving to January.
Yeah, Christmas present indeed. Thanks a lot. So the Senate, what about the House races? Because I think some people were surprised that Democrats lost several seats, it appears.
I'm one of the people who are surprised. And look, give the devil his due. Donald Trump does one thing very, very well. He motivates people who like him to get out and vote. This turnout was exceptional for Donald Trump. Without it, he would have been the victim of a blue wave. It wasn't good enough to win, but it was pretty spectacular in its own right.
So, Governor, let's look forward here, and I don't want to tempt fate, but let's assume for the moment that it comes out the way it looks like it may at this point. That is to say, we'll have a President Biden and quite possibly a Republican Senate, majority still Republicans in the Senate. What does that mean for Democratic policies, for Joe Biden's policies and his ability to implement them?
Well, it means that Joe has to do what I think he does best, and that's get people to listen and get people to cooperate. Look, the problems of this country, let's take one big problem, infrastructure. Infrastructure. Donald Trump promised us in 2016 he would have a massive infrastructure bill that would fix the country's infrastructure, get millions of people to work in good-paying jobs. He never even put a bill in 4 years. Joe Biden, I believe that's one of the first things he's going to do in the first 100 days. Now, infrastructure is an issue that doesn't break down on partisan lines. Everyone's for infrastructure. We've got to find a way to fund it, but I think we can work it out. And Joe Biden, that's his strength. He can get Republicans to work with him. I mean, Lindsey Graham, a real partisan, has said many times publicly that Joe Biden is one of the best human beings he's ever met. So I think Joe has the capacity to do what maybe no one else could have done at this time, and that's to bring us together, not only as a nation, but to bring us together in Washington. Not that everything's going to be kumbaya, but I think we're going to see some stuff getting done. Some Republicans breaking off and voting with the vice president's agenda.
In the shorter term, what about fiscal stimulus? I mean, there was a lot of back and forth through the summer on that, didn't get done. Is there any hope of that in a lame duck session? And what might it look like going into next year if they can't get it done in lame duck?
Look, if there's a president-elect Biden, he can tell them that he's going to be for a broad and very robust stimulus package. And then their decision is, do they wait until January 20th to start working on it? Or do they start working on it now and pass it anyway? And I think President Trump, even if he knew he was defeated, would support a big stimulus package if the Congress sent it to him. And by the way, no fooling around. Americans need that stimulus package now. Now.
So, Governor, one of the issues for former Vice President Biden was keeping the party together. At least that was perceived in the media. There was an issue because you've got some very progressive elements. You've got some more conservative or moderate elements as well. Does a majority Senate actually potentially help President Biden if, in fact, he gets elected? Because it sort of takes that issue a bit off the table?
It does. But for the long-range good of the Democratic Party, we've got to get both elements together. I'll tell you something interesting. I was asked by some of the Sanders people to work on a project with them, to raise money for a project, to go into 4 states where we had 4 terrific Senate candidates and try to raise money so that we could communicate with progressive voters. And I had to work for 10 weeks with a very talented woman by the name of Meredith Purak, who is a real flat-out conservative. And she and I would argue over policy in between our phone calls. But we made phone calls and we realized that the good of the Democratic Party, the progressives wanted to persuade their disaffected voters to vote for the Democratic Senate candidates, even though they were all moderates. So I think the progressives understand, and we moderates should understand, the only way we're going to advance as a party and as a country is to work together, to find common ground.
Governor, always a treat to have you with us. Thank you very much for your time today. That's Ed Rendell. He's former governor of the Commonwealth of Pennsylvania. This is Balance of Power on Bloomberg Television and on radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Going into the fourth quarter, we're going to have to see how healthcare systems grapple with the next wave of the pandemic. But I believe that healthcare systems have now learned a lot, learned how to manage the cases better. So overall, we're cautiously optimistic.
This is Balance of Power on Bloomberg Television and Radio. I'm David West, and it's time now for a check on the markets as stocks continued their post-election rally. Joining us now is Scarlett Fu. A lot of green there in equities.
A lot of green, and a lot of green around the world, too, because that post-election rally circled the globe. We saw Asian stocks move higher. We saw European stocks close. And now in the United States, we're, of course, repricing from a blue wave to a divided government scenario. And the narrative is now a gridlock means fewer, if any, tax hikes on companies, individuals, and capital gains, and lighter regulation for big tech. So you look at the NASDAQ 100, it is on course for its best week since April, which is basically right after the pandemic sell-off. Meantime, you look at the U.S. dollar, it is extending its declines, sinking to 2.5-year lows. It's weakening versus all the major currencies by at least 0.4%. And as you've been talking about, a divided government means saying goodbye to massive fiscal stimulus, which means the Fed is the only game in town. Supporting the economy is once again Jay Powell's burden to shoulder. And of course, he'll be speaking at 2 p.m. Through the press release and then again with reporters at 2:30 p.m. Slower growth expectations means a cap on Treasury yields and a weaker U.S. dollar.
So, Scarlett, you said it, a divided government, which is what it seems what we're headed toward, means we're not going to get all those big tax changes we had. Are you seeing a differentiation among equities according to whether they are really getting benefited by that change or not?
Yeah, absolutely. Among the many proposals that Joe Biden's put out there is to raise taxes on companies that repatriate overseas earnings. And tech and pharma were most at risk if a blue wave did materialize. According to Bloomberg Intelligence, the likes of Apple, Alphabet, P&G, they all have billions of dollars, tens of billions of dollars left to pay of their repatriation tax because that tax is payable in installments over the next few years. Goldman Sachs had estimated that Biden's tax plan overall would cut S&P 500 earnings by 9% in 2022 and have a fuller impact in 2023. So perhaps that's not going to materialize either, and that's what a lot of investors are responding to right now.
Okay, thank you so very much to Scarlett Fu for that report on the markets. Up next, we're going to talk with Sam Zell, founder of Equity Group Investors, for his views on just about everything from real estate to the election to energy. That's coming up with Sam Zell. This is Balance of Power on Bloomberg Television and on Bloomberg Radio.
do you think you'll have to produce less beer in 2021?
No, I don't think so. I think consumers will find a way. But I mean, if there are restrictions, but consumers, of course, are smart and they'll learn to live with those restrictions, I think some occasions will migrate.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. As we have been reporting, the fight for the White House is heating up. President Trump's campaign has filed election-related lawsuits in Michigan, Pennsylvania, and Georgia, and it says it intends to do so in Nevada. The Biden campaign is calling that, quote, political theater. As it stands now, Mr. Biden has 264 electoral votes. President Trump has 214. In the UK, people who work for companies that have closed because of the coronavirus lockdown will still get 80% of their pay until March. Chancellor of the Exchequer Rishi Sunak reversed course today in remarks to the House of Commons.
Given this significant uncertainty, a worsening economic backdrop, and the need to give people and businesses security through the winter, I believe it is right to go further. So we can announce today that the furlough scheme will not be extended for 1 month. It will be extended until the end of March.
For weeks, Mr. Sunak had argued the program should end on October 31st. The second wave of the coronavirus has gripped the UK, exceeding even the worst projections of government scientists. France is stepping up its border controls after a series of terror attacks in recent weeks. President Emmanuel Macron says he will double the number of police and troops in charge of border controls. They will focus on fighting illegal immigration and smuggling activities. President Macron referred to last week's attack at a church in Nice that killed 3 people. Officials say the main suspect is a Tunisian who traveled through Italy on his way to France. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much, Mark. When it comes to shrewd investors, Sam Zell is in the pantheon. Over a career of contrarian moves, he's made money on everything from real estate to energy to waste management. After starting a business managing apartment rentals in a law school, he has now become the chairman and founder of Equity Group Investments. And we welcome him now back to Bloomberg. So, Sam, it's always a treasure to have you here. Thank you for being with us. There's so much to talk about, but let's start with the immediate, what's going on right now. We're in the middle of an election. It's not over yet. Not clear where it's going to come out. I think there are some indications of what's going to happen. As an investor, as you look at this, where are the challenges? Where are the opportunities? Because you always find the opportunities.
Well, I'm not sure I know the answer quite yet as to what the opportunities are. I think the result, frankly, for the country to basically come out, quote unquote, even as opposed to a wave going the other way, is kind of a reflection of how lucky we somehow or always turn out to be. I think that, this kind of an election in perhaps a president like Joe Biden, who's focused on quote unquote, making deals and compromise, might be a very positive outcome for the country going forward, which would translate into a commercial environment activity that would be, much better than what might have been the people could have been afraid of had, some of the more vociferous left parts of the Democratic Party gain more power.
Are you concerned about backing off? If in fact, and we're not sure that's going to happen yet, if in fact Vice President Biden is elected and we don't have 4 more years of Donald Trump, are you concerned about deregulation? Are you concerned about further tax cuts?
Well, I think that, the Obama administration was probably the most regulated administration that we've ever had. I think that the first 4 years of Trump probably brought a lot of those regulations back to, let's say, equilibrium. I would expect that a Biden administration would be more pro-regulation, but perhaps less so than what occurred during the Obama years.
Sam, we've had a rough year, I think it's fair to say, in 2020. I mean, we've had a pandemic, the biggest one by far for 100 years. We've had the severe economic downturn in the course of that. We've had disturbances, civil disturbances in some cities around the country. What has this done specifically in the real estate area? You're really known for your success and how astute you are in real estate. What has it done specifically for real estate as an investment?
Well, I mean, obviously, you've seen, a tremendous increase in the interest in suburban locations. You've seen, we're probably, among the largest central business district owners of residential in the country. And we've seen, particularly in New York and San Francisco, significant reduction in demand. In New York, it's more a question of price. So as prices have come down, demand has increased. In San Francisco, you have an environment that's more difficult, and I think that's in effect putting people who previously fought for a place to live in San Francisco being able to work from a more remote location. Perhaps you could argue that this has certainly done a lot to increase the pace of conversion to e-tail and retail on the net. And I think it's fair to say that probably January 1, 21 in 2021 is probably going to be equal to where we thought we were going to be in 2025. So the lockdown and the pandemic has certainly accelerated the movement, an increase in retail online. There's a lot of discussion today about change in office activity going forward, and higher percentage of offices operating remotely. I'm pretty skeptical of that. I tend to believe that we're social animals and that we perform best when we're stimulated by other human beings. I think that you can be remote in nowhere, Iowa, but at 5 o'clock there's no place to go, as opposed to living in New York or Chicago or San Francisco. At the same time, we've seen an explosion in distribution real estate. Probably the most best performing part of real estate today, although I would be a little much warning and say that, this is probably the least sophisticated form of real estate creation. Therefore, the barrier to access is by far the least in that area. Then you can look at hospitality, and hospitality is looking at a catastrophe, the likes of which it's never seen. It lived through 9/11, it lived through the Great Recession, but it's never lived through a period where demand is literally shut down at the level that it's currently shut down. Just like a lot of small businesses and small restaurants, I don't think will reopen. I think in the same way, we're going to see a real attrition in the number of hotels that are functioning going forward. hotels are very unique forms of real estate. They have very, very high, kind of minimum operating cost levels. And therefore, leaving the door open at, say, 7% occupancy is really, really pretty awful. At the same time, we're not suffering. The country is not doing anywhere near as badly as the newspapers are headlining. And consequently, I think that the overall demand factors are going to help the country move forward accordingly. I mean, look at single-family homes. It's a form of real estate where literally we've gone from slow market to very rapid market, and obviously the fact that we're dealing with interest rates as low as they've ever been are pretty significant.
And we're going to talk about those interest rates coming up in our next segment. Sam Zell will be staying with us to go through his thoughts on the economy and the Fed. Plus, another check on Nevada. A few more votes have now come in, and former Vice President Joe Biden has about a 9,000 vote lead. This is Balance of Power on Bloomberg Television and Radio.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Welcome to That's Debatable, an interactive series on today's most pressing issues. The resolution this time, is a U.S.-China space race good for humanity? We'll hear from both sides.
The competition, if you look at the past, led to innovation.
A whole new arms race could start.
And we'll get your perspective, too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. The election is far from the only important news this week. We're just over an hour away from a decision from the Federal Reserve. And tomorrow we're going to get U.S. jobs numbers for the month of October. Sam Zell of Equity Group Investments is still with us. And we're joined now by my colleague Michael McKee, Bloomberg International Economics and Policy Correspondent. So you mentioned the low interest rates just before we went to break there, Sam. Let's talk about what that's done to you as an investor. And do you expect the Fed to just keep it down? If not at zero, then just above zero?
It's very hard for me to imagine that the Fed has a choice. At the rate at which we're creating debt, servicing the debt is becoming a bigger and bigger future risk. You know, for many, many years, the average interest rate was 5.6%. If the government had to pay 5.6% on the debt outstanding today, from a cash flow point of view, we wouldn't have a chance. So I think that the Fed has no choice. Although I would tell you, in my opinion, the overall activity level in the economy is better than people are expecting and people are giving credit to it. Just like this past week, the numbers on manufacturing, showed a significant recovery. I think generally speaking, business activity is better than you guessed by reading the newspapers.
Well, Sam, as an investor, what do you see in terms of demand for credit? The Fed can lower the cost of credit, not significantly at this point, but is there any real demand? We're not seeing much take-up for their lending programs like Main Street.
Well, I think that, everybody's got, all kinds of a shortage of patience. I promise you that if the Fed had a policy for providing cash flow to close hotels, there'd be unlimited demand. I think we have a kind of a binary economy at the moment where parts of it, like airlines or tourist or travel, is suffering, restaurants is suffering very significantly, that the rest of the economy is not suffering.
So are you at a point where you have to offer incentives to people in order to fill up some office space that you own, or are you negotiating with people? There's a lot of concern about what's going to happen when we get to the end of the year when rates usually reset.
Well, I guess, we are no longer in the office business, thank God. But we are still very much in the residential side. There's no question, particularly in what I would call our two softest markets, New York and San Francisco, whether it be concessions or lease extensions with, other considerations, the net effect of which is that the downside has been a reduction in the net rent generated. The good news in the New York market is that as prices have come down, the number of showings has gone up and the leasing pace and occupancy have increased accordingly. So that's a function of the fact that, demand is forcing a repricing to a certain extent. I think a lot of that repricing and demand change is all very convenient when everybody can work remote. I don't see that occurring for much longer.
Sam, you've mentioned a couple times that you think the economy actually is stronger than you might get from the headlines in the newspaper or, for that matter, on some cable television programs. Yes. At the same time, it is hurting some people disproportionately. You mentioned some sectors particularly. Yeah. We've still got 10.5 million people who don't have jobs who did beforehand. What do we need to do to address that issue? And let's be very specific. What about this so-called fiscal stimulus fourth round?
Well, I think that it's quite clear that some additional stimulus would be very helpful, and I would certainly be very supportive of that. At the same time, turning the demand for stimulus into an excuse for just literally solving other, states and cities who have been prolific in terms of the way in which they've spent their capital is very unappetizing. And I think that as long as the results lead to a divided government, I think the restraint will be there. And then I think, helping particularly areas of extreme hurt. I mean, here in the airline business today, you're talking about, 10 or 15 or 20% of the demand that previously existed. In the restaurant business, even when occupancy is banned inside, your chances of breaking even are very little. And if it's limited to 25%, you have a very difficult chance of making it economically viable. So I think that what's needed is a bridge that will get us through the end of COVID and particularly focused on those arenas that are taking the most amount of pain.
We have just a minute before the break, but let me ask you this. You said that you are concerned about the level of debt out there, but you're also suggesting that we do some more stimulus. How close are we to a tipping point where debt becomes an issue? As long as the Fed keeps rates at zero, can we do whatever we want?
Well, I don't believe we can do whatever we want. I believe the ultimate risk here is the U.S. dollar as the quote reserve currency of the world. And I think that we won't, unfortunately, that won't happen over a very slow, long period of time. It'll happen all of a sudden, when all of a sudden there aren't enough bids for the debt that our country wants to sell. I don't think we're there yet, but I think we're close enough that I'm worried about it.
Okay, thank you very much on that word of caution. To Sam Zell, founder and chairman of Equity Group Investments. He's going to be staying with us. In the meantime, we thank also my Bloomberg colleague, Michael McKee. Stay tuned for special coverage of the Fed decision. That's going to be coming up at 2 p.m. Eastern Time today. This is Balance of Power on Bloomberg Television and Radio.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. One of the big issues weighing in the balance between a Democrat in the White House and a Republican is our national policy on energy. Sam Zell of Equity Group Investments is still with us. And welcome now an authority on energy in her very own right, my colleague Alex Steele, co-anchor of Bloomberg Markets and the European Close. So Sam, before we get to energy, let's talk generally about how you're investing these days. SPACs seem to be almost a fad as far as I can tell. I know you're in SPACs, I believe, as well as in private equity. How are you looking at the method of investing right now?
Well, we did a SPAC. We're 52 days into it, so it's very early. We did it because we thought it was an attractive way to sequester capital and provide an opportunity for combination of our judgment and capital and creating a public company. Yes, there's a lot of SPACs out there. I suspect that their success ratio is indicative of the fact that there's too many of them chasing too many opportunities. But it's no different than any other time. It's just another quiver in the, another arrow in the quiver, and it's going to end up financing a lot of transactions, particularly in the area of family-owned businesses that are looking for monetization.
And Sam, it's good to talk to you again. A lot of SPACs have also been energy. That was sort of the fad about a couple years ago, and a lot of them did not do well. What's your take on that? Do you think that there are opportunities there that are being missed right now?
Well, I think that the energy environment is very, very treacherous right now. We've been an investor in energy for however long I can remember. I don't remember a period that's been as volatile as this, and as such makes energy the one thing that it always was very stable. And with the price of oil and the price of gas moving back and forth the way it has been, that stability is gone, and that makes it a very treacherous place to play. And whether or not the current pricing is getting paid for the risk is a big question.
Well, fair enough. What we have seen, though, is a lot of M&A in the space. Finally, I feel I've been waiting for it for about 4 years. I spoke to Leon Calvaria. He's Citigroup Global Markets Chairman of Institutional Clients Group earlier, and he talked a little bit about what he thought it was going to play out. Here's what he had to say, Sam.
A number of those companies will have trouble getting their cost of capital and being able to fund themselves, especially given where energy prices are right now. So my own view is you will see continued consolidation in terms of the shale business right now. And that would be for a simple reason, which is some of the companies are too small to compete. Their access to capital is limited. So you'll get more and more consolidation as people try to get their costs down.
Sam, what's your call on that?
Yeah. Well, I think he's exactly right. I mean, from a securities point of view, energy has been a big bust. And to a large extent, it's been a big bust because there's been too many companies and too much capital, chasing the space, driving down the cost of play. Now we're in the reverse, and in the energy space is very, cross-dependent. I mean, they stopped drilling in the Permian, and it ends up squeezing the amount of natural gas that naturally comes with that drilling. And all of a sudden, the price of natural gas goes from $1.90 to $3.30. So everything is tied together. And again, from an M&A point of view, I think he's exactly correct.
So, Sam, finally, to wrap this thing up, you've invested in a lot of different asset classes and been very successful. How about the asset class of cash right now, given all the uncertainty? Are you rich in cash? Do you think that's a place to go?
Well, I'm very focused on, the alternatives. And we probably are more liquid today than we've ever been before. One of our public companies was sitting with $3 billion in cash as a result of a 5-year liquidation program. I'm not sure that it's going to be as valuable as it was in 1992. But I think that as we evolve out of COVID, lots of opportunities will come up, and ultimately capital determines it all.
Sam, it is a real treat to get to talk to you. Thank you so much to Sam Zell, founder and chairman of Equity Group Investments. And also thanks, of course, to my colleague, Alex Steele. Coming up on the second hour of Balance of Power, we're going to be awaiting results from the state of Nevada. Here's where we currently stand on the electoral map. This is Balance of Power on Bloomberg Television and Radio. For those of you on radio, we are at 264 for Vice President Biden. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
What is happening today in India is actually a determination to rebuild our economy.
India has an opportunity not only competing in the space of the factory of the world, but a very big opportunity to compete in being the office of the world.
From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, I'm David Weston. Welcome to Balance of Power, where the world of politics meets the world of business. Another day of suspense in the presidential election, with the world waiting now for results in Nevada, a state that could take former Vice President Joe Biden to the magic number of 270 electoral votes. As we wait for results, we now bring in our political contributor. He is Rick Davis, who's been with us throughout. So, Rick, where are you in this race right now? Where do you think we're headed?
Well, I think that the shortest path to anybody winning is the path that Joe Biden has, where he picks up today, Nevada, and if Arizona closes out its ballots tonight, we could wake up on Friday morning. It's been a long week. Friday morning with someone with 270, exactly 270, and that would be Biden with the pickup in Nevada and Arizona, both states of which he's leading today.
So let's focus on a couple of these states. And let's start with the one that I know you know terribly well, the state of Arizona. You ran campaigns, including for president, for John McCain in Arizona. You know that state. Now, there was a lead for Biden. It seems to be narrowing some. There's a lot of pressure on the AP and Fox, but particularly on AP, about that early projection they made. What do you think is going on in Arizona? Will that projection hold?
Yeah, I think it'll hold. We've done our own independent analysis of where we think these ballots are coming from and what they look like. The vast majority of them are coming from the Republican-rich territory of Maricopa County. So even though Joe Biden has won Maricopa County writ large, in other words, he actually stole a Republican county, which is driving his lead in Arizona, the ballots that are remaining are coming in slightly advantaged to Donald Trump. So different from almost every other state that is still counting ballots, in this state of Arizona, the remaining ballots seem to favor Trump. And so a $100,000 vote, or 100,000 vote advantage that Joe Biden had at the start of the day will be whittled down. But I believe by the time all these percentages, if it holds based on what we know is coming in today, I think net Biden will finish out the victor in Arizona by maybe 35 to 50,000 votes.
Okay, so let's go to Nevada, because if Arizona holds, as I understand it, if Nevada goes for Vice President Biden, it'll be right at 270, just right on the number, I think. What is going on there, and particularly going on with a particular county? It is Clark County.
Yeah, Clark County, like Maricopa, they're the two largest counties in the United States by population. And they've been two of the largest growth counties for a decade in the United States. And so the politics of Clark County, like Maricopa County, has changed a lot over time. Nevada, different from Arizona, seems to advantage Joe Biden. The votes that are coming in now, which are almost all absentee ballots being counted, seem to have an additional margin of addition to Joe Biden's current lead that he has. In Nevada, like in Arizona also, the real strength of the Donald Trump campaign has been in the rural counties, and those just don't have enough votes to make up any kind of margin. So if the trend continues along the lines it has in Nevada, the more votes that are counted, the larger the lead that'll exist with Biden. just the opposite of where they exist in Arizona.
What about Pennsylvania? As I say, if Arizona holds and Nevada were to go for Vice President Biden, Biden won't need Pennsylvania. We just had Ed Rendell on. You know him well. He knows Pennsylvania. He predicts an 80,000 vote majority for Vice President Biden when the counting's all done.
Yeah, you really have to flip the script in Pennsylvania, where Donald Trump currently leads. So in these other two states, Joe Biden's protecting his lead. And in Pennsylvania, Donald Trump is trying to protect his lead. And Governor Rendell is right. It looks like the counties that are coming in are really those around Philadelphia and Pittsburgh. These are urban areas. These are Democratic voters. And the question is, are there enough votes left? Certainly there are enough overall votes, 500,000 votes to be counted. The question is, how many of those are going to go for Biden, and can he make up the difference that currently exists? And I think Governor Rendell's right. I think that there'll be just enough to be able to have Joe Biden eke out a victory in Pennsylvania. But we won't know that until probably the end of the week, Friday afternoon or even evening. It could roll into next week. They're doing their best they can. The Donald Trump folks want continued voting to happen in Arizona. There were protests there last night by the Trump folks to say count the vote, which is what they're doing. But in Pennsylvania, they're doing exactly the opposite. They're trying to use legal maneuvers to try and get them to stop counting the votes, because the more they count, the less likely it is he'll win Pennsylvania.
Well, you know what they say about a foolish consistency, right? Okay, thank you so much to Rick Davis. He's our Bloomberg political contributor. He is also of Stone Court Capital. News organizations may think that they have a clear picture of where this presidential election is going, but President Trump has a decidedly different point of view, and he's putting his trust in the judiciary to give him the victory he thinks he already has won. Here to take us through the various legal challenges the president is already pursuing is Bloomberg opinion columnist Noah Feldman, professor of law at the Harvard Law School. So, Noah, thank you so much for joining us here. Give us your assessment of what the legal strategy is. And by the way, I might even ask, is it really a legal strategy or is it a public relations strategy at this point?
You know, it's starting to look more like a public relations strategy than it did yesterday, when it had like a colorable chance of looking like a legal strategy. The centerpiece would be to go to the U.S. Supreme Court, as President Trump said he wanted to do at around 2:30 a.m. on Wednesday morning, and ask it to say that there will be no more counting of votes received in Pennsylvania after 8 p.m. on Election Day. And the thing about that is the president might actually win that claim. It's possible. It would be a very close call. But it's not clear that that would solve any of his problems, because as the margin of difference between the candidates narrows in Pennsylvania, it's at least possible and maybe even probable that at the end, without those votes, Biden may still have won. It's also possible, depending on what happens in other states, that it won't matter what the outcome is in Pennsylvania. That leaves the president with his other strategy, which is sort of locale by locale, filing suits, challenging individual ballots, or trying briefly to stop the counting. And as you were just mentioning in that previous segment, the president doesn't want to stop the counting anywhere where he needs to catch up. He does want to stop the counting anywhere where he might be falling behind. And so those kind of suits don't usually have very much in the way of legal legs to them. They're not that powerful.
You
so the upshot is, that we do have some feeling right now, or at least I have the feeling right now, that these are more setting the groundwork for the president to later say the election was stolen from him, rather than actually blocking counts in a way that would enable him to use legal tools to win.
Yeah, just to put a point on your issue about Pennsylvania, because it went up on an emergency stay. It actually is still pending, could still come up on the merits in the Supreme Court. But this is different, as I understand it, at least right now, from Bush versus Gore, because it was clear that those South Florida votes were critical and would determine the President of the United States. We got to go through several steps to get to the point that those votes coming in after Election Day in Pennsylvania will determine who the President of the United States is.
Correct. And what's more, the Supreme Court, a lot of them aren't going to want to touch this case regardless, because there's no way to come out of a Bush v. Gore situation looking good, no matter what the outcome. But they really aren't going to touch this case unless it looks like the outcome in Pennsylvania is determinative of a country, and the votes that they would be discussing and debating would be the votes that would determine the outcome. So that looks less likely with each passing day. And so we may actually see the Supreme Court spared the agony of having to dive into this.
Yeah, and to go just one step further, drawing from your writings for Bloomberg, actually, I dare say I'm not sure that a lot of justices in the Supreme Court would say, boy, I'd really like to go back and do Bush versus Gore again. I'm not sure they felt they came out of that covered in glory. But we have the President of the United States now having declared victory. He's already said, I've already won. I don't know what the big issue is. That, if anything, even puts more pressure on Supreme Court justices if the case gets up there.
Yeah, had I been one of Donald Trump's lawyers hoping to go in front of the Supreme Court and heard him say those words, I would have thought, oh man, don't do that to us. Not a good look for the team, because the justices would want to have cover. They would want to be able to say they were reaching a decision that was not in any way motivated by partisanship. And the president just made that a lot harder for them when he said, oh, we've already won the election, at a moment where everybody, Fox News included, knew and said he hadn't won the election. And that sort of kind of magical thinking does not look good, because he then said in the same sentence, and we're going to go to the Supreme Court to deliver this outcome.
Yeah, and oh, by the way, one of those Supreme Court justices was just nominated by President Trump and just confirmed barely before the election. Let's come back to some of the allegations about fraud. A lot of talk about fraud coming out, particularly of the Trump campaign these days. I hear a lot of general allegations. I at least haven't seen many specifics. I mean, normally you go into court, in my experience, you got to have something behind it. You got to have some affidavits about some specific instances so the judge thinks maybe there's something there.
Remarkably, none of the lawsuits that have been filed thus far by the Trump campaign has included concrete allegations of fraud backed by any specific evidence, like an affidavit. So you're quite right. What I do see, not in court, but in the culture, and perhaps you're seeing it too, is proto-conspiracy theory accounts of what, quote unquote, must be happening given that the margins for Donald Trump are closing. And that, I think, is a trend line that it's unsurprising. We were so accustomed to this kind of conspiracy theory and innuendo. There were people apparently chanting the word Pizzagate outside of the Arizona vote counting centers. So we live in a world where there's lots and lots of this sort of thing. But that's really different than any credible substantive allegation. And thus far, I think if the Trump campaign had that, they'd be putting it in their legal pleadings. And they haven't done that thus far.
And Noah, I wonder in conclusion here, and I don't want to lead you as a witness here, but it struck me, I'll just say it struck me, that the best counter for that sort of perceived conspiracy or evil doing going on, whether it's left or right, is basically for our institutions to stick to their knitting, to do their jobs. And right now, after all the anticipations of all the problems we're going to have, by and large, I think I see a lot of election officials sort of doing their jobs, their hard jobs, they're going through the night, they're trying to be diligent, and the courts thus far are sort of just taking it straight up and down. They're not actually coming into the political contest at all.
I appreciate that you mentioned that, and I deeply agree. When I see that the fate of this election rests in the hands of, tens of thousands of people whose names we don't know and will never know, who are ordinary election officials, who are temporary employees, lots of them retirees, who show up once a year or a couple of times a year to count votes in an election, I actually have a feeling of great faith in the capacity of those people to be efficient, honest, and to do their jobs, and to do them deliberately and slowly if need be, but to get those jobs done. And that is a sign of at least one aspect of democracy, the part where you count the votes, working the way it's supposed to work. And thus far, the courts have also been, I think, doing their jobs and doing so carefully and rationally. You don't want to always guarantee that it'll continue that way, but that is the way it looks to me right now.
So very well said. Thank you so much. It's a delight to have you with us. That's Harvard law professor and Bloomberg opinion columnist Noah Feldman. Coming up here, Jason Furman of the Harvard Kennedy School joins us to talk about the Fed, jobs, and what a difference President Trump might be able to make despite a Republican Senate. This is Balance of Power on Bloomberg Television and on radio. I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Mostly, I'm confident because we have so many shots on goal, really an unprecedented number so quickly. So I think science will win in the end. It's just hard to pick the winner at this point in the horse race.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We're going to turn now to Mark Crumpton for Bloomberg First Word News.
David, thank you. Joe Biden could be on the brink of taking the White House after wins in Michigan and Wisconsin. Biden now is 6 Electoral College votes shy of the 270 he needs to win. His best chance may be in Nevada, where new results show he holds a lead over President Trump of about 1%. The president's campaign is suing in Michigan, Pennsylvania, and Georgia and says it plans to do so in Nevada. But Mr. Trump could still be re-elected. He would have to win all the battleground states that have not yet been called. Nearly 60 people were arrested here in New York City overnight as peaceful demonstrators turned into heated confrontations with police. Demonstrators took to the streets to protest President Trump's challenge to vote counting in several states. Some protesters set fires and clashed with police. The United Nations will hold a summit on the COVID-19 pandemic next month to respond to the spread of the disease around the world. The General Assembly voted 150-0 today, with the United States, Israel, and Armenia abstaining on a resolution authorizing the meeting. Officials say the purpose of the gathering is to discuss the virus's, quote, unprecedented effects on societies, economies, jobs, global trade, and travel. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much, Mark. Just a quick update now. Election officials in Clark County, Nevada, that's the county we've been talking about, the most populous in Nevada and the most important, are now holding a news conference right at this moment. We are still awaiting more results. We'll bring those to you as they come. Right now, former Vice President Joe Biden is up by about 12,000 votes in the state of Nevada. So in the middle of all this back and forth of the election, we also have something called a Fed decision less than an hour from now, and a October jobs numbers report coming out tomorrow morning. Here for a read on the economy and what will shape it over the next few months, if not years, is Jason Furman. He's professor of the practice of economic policy at Harvard's Kennedy School. Professor Furman served as chair of President Obama's Council of Economic Advisors. So, Dr. Furman, thank you so much for being with us. First of all, give us a sense now of where the economy is. We don't expect much out of the Fed today, other than maybe saying we need more fiscal stimulus. Jobs numbers, probably they'll add some, but we still haven't replaced them all. Where is the economy?
Yeah, we're 11 million jobs short. I'm pretty confident in predicting we're not going to get 11 million jobs tomorrow. So we'll still be something in the range of 10 million jobs short after tomorrow. And the concern, David, is one, the virus is resurging. Two, the fiscal stimulus has gone away. And three, the pace of job growth is just so slow, it'll take us much longer than it should to replace those jobs.
And that brings us to the Fed. Is there anything really that the Fed can do at this point? Have they basically done what they can do? I think this gets to this pushing on a string sort of issue.
Yeah, I think there's very little the Fed can do anymore. I mean, they could increase their asset purchases, they could change what they're buying, but interest rates on almost everything are really quite low right now. This is really the main thing that Chair Powell could do, is use all his political skills, as he has been doing, to try to convince the president and Congress to do the right thing, which is fiscal measures on their side.
Yeah, not that it's been to much avail so far, at least. Well, I think we're within some reasonable period of time, I hope, going to have an answer about who the next president of the United States is, as well as what happens in the House and the Senate. Let's assume, and it's just an assumption right now, that we do get a President Biden replacing a President Trump, but that the Senate remains in Republican hands. The majority are Republicans. What does that mean for the prospects of substantial stimulus? Or do we basically have to take what was done before and say it doesn't have a 3 in front of it, doesn't have a 2 in front of it, maybe it doesn't even have a 1 in front of it when it comes to trillions?
I expect something big is going to happen. Senator McConnell was out yesterday with, in some ways, what I thought was the best statement I've heard him make on the importance of this topic. You know, maybe it'll happen in the next month or two. Maybe it will take a President Biden. You know, the other thing I can tell you is I've been in the room with then Vice President Biden and Majority Leader Mitch McConnell, and they can work well together. You know, there's a give and take. You need to do something in exchange for something else. And I expect he'll figure out how to thread that needle, do something that's fiscally expansionary.
In running for president, the former vice president had some, I think, pretty bold plans in terms of investment in infrastructure, in green energy, in a whole range of things, trillions of dollars, which were matched with a fair amount of tax increases as well. How much of that survives a Republican Senate?
If the Senate is Republican, and it looks like there'll be 2 runoffs on January 5th, but that's obviously not an unreasonable assumption to make, then you're not going to get, you're going to get a lot less of that done over the next 2 years. Can you fight to define the issues? Absolutely. Can you figure out where there's a trade? I think there's some places where there is. Things like infrastructure, both parties have an interest in it. So I think you can get big things done in the next 2 years, but definitely not every big thing he proposed in his ambitious campaign agenda.
Jason, you, of course, are an economist. You're not a public health official. At the same time, I wonder if the most important economic issue we face right now is a public health crisis. Is there much that an administration can do about that, or do we just have to ride this out? Does the virus get to do what it wants to do?
Yeah, the thing I'm most excited about, that I think is the most positive change from President Trump to President Biden, would be testing. President Trump hates testing. He thinks the more you test, the more cases you have. President Biden would understand that testing is the absolute key to getting ourselves back on track before the vaccine and with an imperfect vaccine. I get tested once a week so I can come here to work at Harvard. That's something every American should be able to do. Every American should be able to do it more often than that. That's the win-win solution. More activity and save lives. That, I think, would be a massive, massive change under Biden.
By the way, that's something they're doing for a lot of us here at Bloomberg as well, weekly testing that we're doing. And it is an assurance of at least we keeping our arms around what's going on. Thank you so much, Jason. It's always a pleasure to talk to you. That's Jason Furman of the Harvard Kennedy School. And stay tuned for the Fed Decision special coverage. That's going to be beginning at 2 p.m. Eastern Time today. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now to get a check in the markets. Joining us now is Abigail Doolittle, the person I talk to every day, and it's true, to figure out what's going on in the market. So where are we now, Abigail?
You're very kind, David. Well, you know, we still have this rally going on, a huge surge for stocks this week, despite the fact that we still do not know who officially is the next president of the United States. Investors are all in on stocks. The S&P 500, the Dow, the NASDAQ, all up by about 2% or more. The NASDAQ right now heading to its best week since April. Today, bonds are down slightly, not a lot, so it is a true risk-on tone. What stands out to me, though, David, is the degree of certainty that investors are rushing towards stocks suggests that the markets, again, think they know who the winner of the presidential race is. Making it even more interesting is there were signs yesterday that the markets were leaning one way. Now there's signs that they're leaning another way. Either way, stocks are going up. Investors want all in on stocks. Interestingly, though, David, we have the S&P 500 trading in a range. It's going to make a big, big break once the bulls or the bears really take over, depending on the true economic picture. The bigger, more important range, though, is really the 10-year yield, because it is stuck in this year's range. Now, right now, between 75 basis points and let's call it 1%, that's the reflation growth side of the range. Below 75 basis points, though, I think you can make a pretty strong case that that would be risk off or haven, suggesting that there could still be some big surprises ahead and lots of volatility. And very quickly, David, just to revisit what we were talking about yesterday with pot stocks, they were down. Today, we have a huge rally. At one point, the space overall was on pace for its best day ever. This, of course, as it is thought that Joe Biden, if he's elected president, that he would decriminalize the federal marijuana law that you were talking about, plus, of course, legalized in some states. So those stocks are really on fire.
And to that point, Abigail, some people think the Senate probably is changing too, which you might be able to get it done. Thank you so much to Abigail Doolittle for that report on the markets. Up next, GM was out with very strong earnings this morning. We hear from Mary Barra, the chairman and CEO, about how the election results might or might not change its prospects. This is Balance of Power on Bloomberg Television and Radio.
So when you went to Baltimore, you went initially to be an anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well,
well, demoted. I was
got demoted, but they didn't. They had a contract, so they didn't say goodbye. Yeah. And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year And my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making 22,000. Imagine when you're 25, then you're 30." So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000,
Right.
so they kept me on and said, "We'll put you on this talk show just to run out your contract."
I don't remember a time, and I've been investing for over 50 years, I don't remember a time when I've seen such volatility as we see today.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. The fight for the White House is heating up. President Trump's campaign has filed election-related lawsuits in Michigan, Pennsylvania, and Georgia and says it intends to do so in Nevada. The Biden campaign calls that, quote, political theater. As it stands now, by the Associated Press's count, Democratic presidential nominee Joe Biden has 264 electoral votes, and President Trump has 214. The statewide manager of Georgia's voting system implementation is defending his workers against allegations of voter fraud or manipulation. Gabriel Sterling says elections directors and their employees are about protecting democracy. Sterling's comments this morning came as the presidential vote count in the state continues.
People have asked, why has the number not moved more quickly? Well, as you all know, the law calls for all absentee ballots to be accepted by 7 p.m. on Election Day. So obviously on Election Day itself, election officials are very, very busy actually running the Election Day voting. So normally what they'll do is have to come back in that evening and into the next day and accept those ballots. And by accepting them, they have to go through signature match and all the other processes to confirm the validity of those. And in our case in Georgia, especially when they come in right before or on Election Day itself, we have to get notifications out to those people that they have 3 days to come in and cure their ballots.
President Trump currently leads in Georgia, but the margins have narrowed as more votes are counted. France is stepping up its border controls after a series of terror attacks in recent weeks. President Emmanuel Macron says he will double the number of police and troops in charge of border controls. They will focus on fighting illegal immigration and smuggling activities. President Macron referred to last week's attack at a church in Nice that killed 3 people. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thanks very much, Mark. GM was expected to rebound from a loss in the second quarter, but it did much better than expected, especially when it comes to earnings per share, powered by consumer spending and its powerful line of trucks. We talked with GM Chairman and CEO Mary Barra, and we asked her how much of the strong performance was because of all that stimulus.
When you look at one of the key reasons was the GM team members. They have done just a phenomenal job across all areas of our business, working and demonstrating their commitment to the business, also prioritizing safety and following our safety protocols. And that has been a key ingredient to driving this very successful quarter. I would also say it's on the strong demand for trucks. A couple of years ago, as we started to roll out our new full-size trucks, we talked about the fact that we were going to cover the whole market, both from a value perspective, but also from a feature perspective. That strategy is working out extremely well, and we see very high demand for our full-size pickups at all levels, but especially in those high-end pickups with the AT4, for example, with the GMC. We also continue to have very strong cost performance, not only the specific austerity measures that we took because of the pandemic, but also the work we'd already been doing as part of the transformation. And then finally, GMF performed extremely well. So all of that coming together, I think our products, the discipline of the team, and our focus on costs is what allowed us to have this strong quarter.
Yeah, Mary, as you say, I looked at your waterfall chart there carefully, and some of it was price and some of it was cost savings. So well done. You have it balanced. Let's talk about trucks. They clearly powered you. You've talked about them for some time now, your pickup trucks. Do you have enough of them? Can you produce enough? What are you seeing in demand?
We're seeing strong and growing demand. And right now, we're building every truck we can make. But I think very shortly, you'll hear us taking action to how we're going to further our capability to build more trucks, because what we see is the demand continues to grow. We think the shift to trucks, especially with the luxury trucks, the premium trucks that we're offering for both GMC and Chevrolet, that is going to be a continuing trend.
So, Mary, you talked about the safety of your colleagues at General Motors. Is the coronavirus at this point inhibiting at all your ability to produce enough product, enough trucks?
Well, we've worked hand in hand not only with all of the GMT members, and I'm just so proud of the way everyone is following the safety protocols and staying safe, and I think they're even in many cases taking them home. Our employees tell us they feel safer at work than they do at a grocery store, and I think that speaks to what we're doing and their commitment to following the protocols that we jointly developed with the UAW and our peers across the industry. We've shared all that with the supply base, and that is allowing us to continue to make sure we have the parts necessary. It's a very dynamic situation, and we just work to address each situation as it occurs. But right now, really pleased with how the team is being creative to keep our ability to build as many trucks as we can.
Mary, looking out into the future, you have been consistent in saying an important part of the GM strategy is electric vehicles and autonomous vehicles. Give us a little bit of insight into that, particularly as we are now waiting for a result on the election. Does it make a material difference to your strategy whether we have a Democrat or a Republican in the White House? Because they have very different approaches to things like fossil fuels and green energy.
We are 100% committed to EVs, and we're working to accelerate our EV transformation. I think some of the examples of that are the GMC Hummer EV, the Cadillac Lyriq, and then the Bolt EV as well. We also just recently announced a multi-billion-dollar manufacturing commitments at Factory Zero in Detroit-Hamtramck, the Ultium Cell LLC in Lordstown, Ohio, and then just most recently at our Spring Hill assembly plant in Tennessee. So we've got the manufacturing capability, we have great vehicles, and we've got the expertise and the technology with Ultium. Speed is vitally important as well, and that's why we're working so quickly. So regardless of who wins the election, we're going to continue on a rapid pace to transform to EVs.
Mary, you mentioned the Hummer EV. A lot of people out there are excited about that Hummer EV. How many pre-orders have you got so far?
The demand has well exceeded our expectation. As you know, this is a very premium entry, so we're incredibly pleased at the strong demand, and we'll continue to monitor that as we go forward.
And so, Mary, it's not just electric vehicles, it's also fuel cell. You announced a deal with Nikola. As I understand it, there's a deadline on that deal in December. Where are you on that right now? Do you expect to go through with it? And will there be material changes in the terms of the deal?
So right now we are in ongoing discussions with Nikola regarding the transaction. The transaction has not closed, and so we'll provide further updates at the appropriate time. But I think what's important to note is our fuel cell technology, the Hydrotech hydrogen fuel cells that we've developed with Honda. They are industry leading, and that's from external sources. And so we're going to continue to look for ways to not only commercialize our fuel cells, but also the Ultium battery platform, because I think that continues to advance our zero-emission future.
Finally, Mary, briefly, do you expect a continued rebound into 2021? What are you looking at?
A lot depends on if we across the globe get the coronavirus under control, and we know what we need to do from a safety protocol perspective. So we're hopeful that we'll start to make some progress there. Obviously, in the United States, we're monitoring what will happen with additional stimulus. But if those factors if we get the virus under control and other elements stay on track, we think we can continue the recovery into 21, and definitely we believe we'll continue to see strong full-size truck demand.
That was my interview with Mary Barra. She is GM CEO and Chairman. Coming up, our Bloomberg Green series focuses on the difference a Biden administration could make, even if it has to deal with a Republican-led Senate. This is Balance of Power on Bloomberg Television and on radio.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Balance of Power on Bloomberg Television and radio. I'm David Weston. One of the big differences between President Trump and former Vice President Biden is over policy on energy and climate. And although the election certainly isn't over yet, it's not too early to start thinking about ways in which a Biden administration, if it happened, might take the U.S. in a different direction from a Trump administration. For this week's Bloomberg Green, focusing on developments in green finance and environmental solutions, welcome now Bloomberg's Akshat Rathi, coming to us today from London. So, Akshat, thank you so much for being with us. Give us a sense, from your point of view, how big a difference could a Biden administration make?
We know that the Biden administration will follow the science, which the Trump administration has ignored in the past 4 years. And what we are going to get is laid out in a comprehensive plan on Joe Biden's own website. The main headline goal is to try and get the U.S. to reach net zero greenhouse gas emissions by 2050, which would align it with what the European Union has targeted, what Japan and South Korea have recently set their goals on, and will bring it close to what China is promising, which is also net zero greenhouse gas emissions by 2060.
So, Akshat, goals and targets are really nice to have. The question is, can you get there? And one of my questions is, if in fact the Senate remains with majority Republican leadership, even if President Biden becomes a reality, how much of that can they get done? How much of that target can he reach?
Indeed, and you're absolutely right that short-term goals are just as important as long-term goals. One of those short-term goals for the Biden administration is to reach zero carbon electricity by 2035. And that would be a huge lever that the administration can pull in electrifying all kinds of carbon-emitting devices. These are cars or power plants. But getting there, as you say, will require having a Democrat-held Senate. If that's not possible, there is still a lot Biden administration can do through executive action. These are reducing emissions from methane leaks. It's sort of wielding $500 billion worth of procurement that federal government does towards clean energy and electric vehicles. It is going down and supporting farmers and advanced biofuels. So there is plenty that you could do through executive action, but you're right. If the goal is to reach net zero greenhouse gas emissions by 2050, Biden will need a Senate in his support.
One of the first things that President Trump did when he took office, as I recall, was to announce he would be pulling the United States out of the Paris Climate Accord because there was an advance notice requirement there. Vice President Biden has made it clear he would go back in. Does that in and of itself make much difference at all, Akshat?
It definitely does. We should remember that the U.S. has just left the Paris Climate Agreement on November 4th, a day after the election voting stopped. And Biden, in his first policy statement in this period, has said that he will join the Paris Climate Agreement on the first day. It's a symbolic but a very important move because what the U.S. does matters a lot. It's 15% of greenhouse gas emissions globally, second largest emitter. And what Biden signals will be something that other countries will pick on. I gave the example of Japan. Japan has set a goal, but it has to go through and legislate on that goal of reaching net zero greenhouse gas emissions by 2050. If Biden comes into power, joins Paris, Japan has a clear signal that that's what it has to do. And that matters on a global diplomatic level.
Akshat, apart from the symbolism, which is important, I certainly agree. We shouldn't just rush past that. At the same time, one of the things that Vice President Biden has said he would really pursue if he were president is to cut back on some of what he calls the subsidies of fossil fuel industries. As you know, there's a lot of tax breaks, various things in the U.S. code that give an advantage in some respects to fossil fuels. Is there any hope of that without a majority of both the House and the Senate?
No, not really, because as you said, it's in the tax code and that needs to be legislated upon and will require instruments of Congress to get through. But as I said, he could direct what money he has access to towards clean energy. And those are not small sums. When you're looking at a federal procurement program of $500 billion a year, those are large sums of money. He could also, because there is support in Congress, bipartisan support, pass legislation or more money towards innovation and research. This is something both Republicans and Democrats agree upon, and the U.S. leads on. And there, Biden is promising that he would like to put in as much as $400 billion, which would be 3 or 4 times the amount that the federal government currently spends on innovation and clean energy.
Exactly, but that would probably require congressional support as well, right? He doesn't just have it in his back pocket as president.
Indeed, that would require congressional support. And in this case, he would have it because Republicans are or have been in the past typically pro-innovation. And it would support certain industries that Republicans care about. So one of the technologies that will cut emissions is called carbon capture, where you capture emissions from a power plant and you bury them underground. It helps support the fossil fuel industry, which we know Republicans want to continue supporting, and at a time when you can cut emissions as well. And that requires a lot of support in terms of innovation, and that kind of money coming from the federal government will make a real difference.
Well done, Akshat. You found some bipartisan possibilities, actually, in climate change. That's terrific. That's hard to do. Thank you so much to Bloomberg's Akshat Rathi for joining us today. Coming up, Christine Todd of Amundi Pioneer tells us what to look for in the upcoming Fed decision. This is Balance of Power on Bloomberg Television and on radio.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
There are $3 billion being prepared. So the lending program has increased. So that's the very important feature we did not expect.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We are just minutes away now from the latest Fed decision, and it's due at the top of the hour. That's 2 p.m. Eastern Time. For a preview, welcome now Christine Todd, head of U.S. Fixed Income at Amundi Pioneer. So welcome, Christine. It's great to have you with us. And let me go out on a limb here. I think the Fed have to be crazy to do anything dramatic right now in the middle of this election, everything else going on. But you tell me what you're expecting.
I would say 3 boring things and 3 more interesting things.
Oh, good.
First, the whole market is looking for, and there's a lot of pressure to understand the quantitative triggers around the change in inflation target with the new regime of average inflation targeting. So what is the inflation number? Is it 2.2%? What's the employment number? Is it 4.5%? We're at the edge of our chairs, and they may not give us much. Also, probably an emphasis on forward guidance. Yield curve control seems to be in the rearview mirror, and forward guidance seems to be working quite effectively, as we've seen very little variability in the U.S. Treasury market, despite the high level of variability in the equity markets. Again, another plea to Congress to step up and employ fiscal stimulus with a lot of cautionary discussion around the coronavirus and its headwind to emerging from this economic setback. More interestingly, we just saw the Bank of England surprise the market with more quantitative easing, more asset purchasing than it was at all expected. And does that put pressure on the Fed, or is the Fed thinking along the same lines already to increase the level of QE? And would those asset purchases be longer out on the yield curve? Secondly, in terms of the more interesting things and intangible things, we've heard from Biden, who may become the president, that he thinks the Fed mandate should not only be price stability and maximum employment, but also economic equality. And we've heard, particularly in the Fed press conferences, Jay Powell be acknowledging economic inequality as a economic problem, and he becomes somewhat emotive about it as well. He's referred to it as tragic. He's said that he is going to push hard on employment in order to get back away from that K-shaped recovery that we're seeing. And he says that it's very much on the Fed's mind. So whether that creeps in to the consciousness is something to watch. And then finally, with the lower likelihood, given the composition of Congress and the executive seat, of a high level of stimulus, will the Fed start to contemplate negative rates? Is there more pressure on monetary policy, and will they succumb to it?
Well, that would be a U-turn, wouldn't it? I thought the Fed's been pretty explicit. They don't have much patience for negative rates, and they haven't seen much success with them over in Europe.
Well, I'm being provocative here, David.
Yes, I like that. That's good.
So it's not the base case at all, but it would be very interesting to see if it has been raised or contemplated. We have 18 or so trillion dollars of negative yielding debt globally. It's not an anomaly. The Fed has been absolutely adamant that they will not and do not intend to go there. That said, the pressure on them to do so, with the lack of the fiscal side helping out, may create a window to contemplate it.
So, Christine, let me go back to your penultimate really interesting thing. And I agree, you did what you promised to do. You gave us 3 that were pretty predictable and 3 that are much more provocative or interesting. And that is addressing wealth and income inequality. A lot of people say we need to do that, including a lot of economists who think that actually that would foster more growth for all sorts of reasons about who spends money, who doesn't spend money. At the same time, I've always been a little perplexed thinking what the Fed can do about that problem. I mean, the Fed can't fix every problem. Do they have the tools that would really allow them to address that issue in the United States?
I'm glad you asked that, because they do in the back door. So they have the municipal liquidity facility that they've offered to state and local governments. And by supporting state and local governments, which they've been extremely vocal and proactive about and nudging Congress to be more attentive to. But by offering this liquidity facility, the Fed is supporting municipal governments, which is 15% of employment. And those jobs tend to be the bottom part of the K. So by supporting state and local government through the municipal liquidity facility, it supports employment for the people who are being hardest hit, and, as Jay Powell said, less able to shoulder the burden of this. That goes a long way. Now, what they might have to do in order to make the municipal liquidity facility more effective is do what they did with Main Street lending, which is make adjustments to draw in customers, if you will, to take advantage of it.
So I'm so glad you raised Main Street lending. Just to interrupt, I'm sorry, Christine.
No.
That has not been a raving success, has it, Main Street lending?
No, a fraction of the, something like $500 billion has been employed. And I think that's because the Fed believes that for smaller loans, the PPP is the most efficient facility to distribute liquidity and to provide a backstop. The underwriting of hundreds of thousands of small loans is a big burden to the banking system. So I think the Fed has hoped that the PPP would pick up the slack, and the PPP still has 130 billion or so left that they could lend.
Right.
The Fed recently lowered the amount of loans, so they're going that direction.
Okay, Christine, great to have you with us. We're going to wrap it up just so we can get ready for that Fed decision, actually. That's Christine Todd. She's a Monday Pioneer head of U.S. fixed income. Stay tuned for the Fed decision special. That's covered at 2 p.m. Eastern time. And stay with us as we continue to follow the election all across Bloomberg. This is, after all, Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is The Fed Decides on Bloomberg Television. I'm Caroline Hyde. Amid an uncertain election result, we bring you Fact, the Federal Reserve's rate decision. Chair Jay Powell will host a virtual press conference and take questions in 30 minutes' time. We dissect the market moves. Tom Keen's with me, Scarlett Fu, and Michael McKee. Take it away.
Well, this is a very different kind of Fed statement. No change in rates, no new guidance, no additional QE, but a lot of bearishness. The Fed, instead of starting with an economic assessment, begins with a pledge. Quote, the Federal Reserve is committed to using its full range of tools to support the U.S. economy in this challenging time, thereby promoting its maximum employment and price stability goals. It then goes on to say, the COVID-19 pandemic is causing tremendous human and economic hardship across the United States and around the world. Economic activity and employment have continued to recover, but remain well below their levels at the beginning of the year. Prices, they go on to note, are being held down by weaker demand and falling oil prices. The path of the economy, the Fed says, will depend significantly on the course of the virus. The ongoing public health crisis will continue to weigh on economic activity, employment, and inflation in the near term, and poses considerable risks to the economic outlook over the medium term. The Fed's statement on its policy goal, the same new language it used at the last meeting, that they will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. The committee expects to maintain that accommodative stance of monetary policy until those outcomes are achieved. The only thing else we can tell you, the decision unanimous, no dissents this time, although San Francisco Fed President Mary Daly voted in place of Minneapolis Fed President Neel Kashkari, who is on paternity leave.
We do indeed wish him well, Neel Kashkari there. Congratulations to him. Michael McKee, a great breakdown. We thank you on all things Fed. Tom Keen, co-host. Let's talk. What do you make of perhaps an unmonumentous Fed decision amid monumentous times?
I'm going to go back, Carolyn, way back early this morning where we saw a completely different approach, and we saw that through the United Kingdom. You're a little familiar with that. And it is just amazing the difference to fiscal and coordination response and the British model versus the American model. And to me here, right now, the British-American distinction here is really front and center. They just simply don't have the policy structure that is in the United Kingdom to act in a more forceful manner. Now, the markets have been moving in a more forceful manner, mostly off of our politics. Scarlett Fu provides immediate wisdom. Scarlett, what do you have?
Well, we pretty much have what we did before this 2 p.m. Fed announcement. Stocks are higher. They've been higher for all this morning. In fact, extending the rally that we saw after the election, and that has not changed. And of course, this has been a broader advance today as opposed to yesterday when it was very much tech-driven. So the S&P 500 holding on to its gains. We're looking at an advance of 2.3%, and it is set for the best week since April, up at least 1% every single day this week. The 10-year yield also remains higher as well, although if you look at what it's done this week, it's been wild, right? We went from 94 basis points, a 5-month high on Tuesday night, to 72 basis points overnight. And the positioning, of course, before the election was that blue wave hopes or optimism sparked unprecedented short positions, and that was unwound as the election results rolled in. Today, yields have been moving higher, leaking higher, and of course, we are still not clear on what's going to happen with Senate control. It's could be a toss-up if David Perdue in Georgia ends up in a runoff election. So you can't rule out a blue wave, which means massive stimulus is still kind of in play. We're looking also at the dollar, which has been under pressure all day. It remains under pressure, and in particular, weaker versus all 16 currencies by at least 0.4%. I don't know what exactly we pin it down to. Is it the lack of haven interest? Is it a reflection of election uncertainty? Or is it just general positioning before FOMC day? Because generally, the dollar tends to weaken on Fed days. Looking at the credit market, AG, the ETF that tracks the overall bond market, overall fixed income, erasing some of its gains, but it wasn't up by very much. So just little change at this point. LQD, HYG, they were up modestly. They remain up modestly at the moment. And of course, what Mike pointed out, which was so critical, is that the Federal Reserve is not changing its bond buying pace at all. If you look at how the Fed's balance sheet has moved over the last couple of years, oh, you know what? Surprise, this is another chart. Let's look at the 10-year range, the range for the 10-year yield. And you can see that even though we've been making some wild swings all this week, it's pretty much been in a range, a longer-term range, at least since March. Yes, it poked above that for a while, but it's come back down. And again, you're looking at the fixed income ETFs, and not a lot of movement there.
Quite amazing, the inflows that we have seen, particularly into LQD. Your life within ETFs speaks it all. But I know this is something that Tom was looking at front and center earlier, was the move versus the yen. The dollar, absolutely extraordinary, but also so has been the lack of volatility, Scarlett. The VIX, much lower than the 40 that we'd seen back in late October. It feels as though the market is embracing uncertainty. I thought markets didn't like uncertainty.
Markets don't like uncertainty, but they also knew that there would be a lot of uncertainty, a lot of volatility coming into this election, and that it would take several days, perhaps weeks, to play out. And you see that with the VIX holding above 30, which is pretty much where it's been all this year, and certainly elevated compared to its long-term average, historical average of under 20. So let's get a little more insight into what we heard just now from Mike McKee. Insight, context, analysis, all of it. Scott Minerd, Guggenheim Global CIO, joins us now. His firm has over $295 billion in assets under management. And Scott joins us now from Los Angeles. Scott, is this a forgotten or forgettable FOMC meeting, or does it become more critical because monetary policy is the only game in town?
Well, look, I think we have, you're correct. I think this will be a forgotten meeting. This did exactly what I would have expected. It punted to December, because taking any action right now opens them up to criticism of doing something by the action prior to this. But, you know, the most interesting thing to me, Scarlett, is this thing is quite an essay. When you look at the addition they made in the last paragraph, they're torturing themselves to explain that they're there, ready, willing, and able to do everything to support the economy. And, you know, for old guys like Tom and me, you know, you look at, you know, you consider this against statements that used to come out from Volcker or Greenspan, to just go on for such length about their commitment to supporting the economy, you know, shows that they've just slowly continued to drift into fiscal policy rather than just the traditional roles of a central bank.
Scott, good morning, or good afternoon, I should say. It feels like morning. As John Farrow said, it's late Tuesday evening here, the way we've been going with this election. Scott Minerd, I want to talk about the algebraic function and the fact that in light speed, the epsilon has drifted away. Caroline Hyde notes the VIX from 40 down to 27. We're seeing that across the entire system. What does it do to your investment call to see such stability, to see the risk drift away?
Well, you know, Tom, it's interesting. I think it's playing out pretty much as I had expected. You know, in the lack of a blue wave, more and more reliance now is going to be on monetary policy because the stimulus is much less likely to happen. The more liquidity the Federal Reserve keeps pumping into the system, the more pressure there is for credit spreads relative to treasuries to contract, and at the same time to drive stocks higher. So, you know, I think even though we've, you know, had a pretty good rally, a huge rally in like high yield, HYG, LQD, you know, I think that we're still going to have a meaningful rise in those because if you're a yield-oriented investor, like a mutual fund or an insurance company, the pie at which you can, you know, get attractive yields is getting smaller and smaller.
Scott, the $295 billion that you currently have under management, you're looking clearly a change of tune almost. You wrote back in late October, you're in the eye of the storm, a moment of calm. The markets are coiling, and now you sound pretty bullish. Are you bullish across stock markets too?
Well, you know, the one thing I'd say, Scarlett, and I should have pointed it out in the in my piece, is storms don't last forever. And a lot of my concern was focused on the election, which I think we now have behind us, though we still don't know how the divided government is going to resolve itself here, whether it'll spiral into anarchy in the short run, which could could cause people to become more fearful. But the other thing is, we're about to have a massive increase in the COVID cases. And, we're up now above 100,000 a day. I would expect that by December, we'll be at 200,000 a day, which is 4 times roughly where we were at the prior peak. So, again, we've got to weather that storm. And what I think the Fed is telling us is they know that storm is coming, and they intend to, provide all the cover they can as far as they have the power to in monetary policy.
But, Scott, this is Mike. We know they don't have a whole lot more power. They can push down on interest rates, but not do much more to stimulate the economy. So what message are they really trying to send with this really downbeat statement here? It's not like you don't know that there is a big COVID problem coming. Are they maybe trying to signal something to Congress here, go beyond the markets?
Well, I think so, Mike. I mean, I don't know if you agree with me on how unusual this essay is.
Oh, absolutely.
Right. Yeah, I think, there are 2 things. One is they're trying to signal to Congress that they really need to get in gear and get something done. I think they're also trying to signal to the markets that, at the end of the day, they can just keep buying securities. And I know Scarlett is a faithful reader of my commentaries. A few months ago, I outlined a path for the Fed that if things get really bad, they'll start buying equity ETFs to keep this thing from collapsing.
That would be an incredible move if and when it does get to that point. So in terms of signaling to Congress, I wonder, legislative gridlock, which is what so many people are pricing in at the moment, Scott, it may be seen as positive for markets as long as nothing else needs to be done. But in this economy, with the data of late showing momentum, but at the same time knowing that we are around the corner from another wave of COVID, is the whole gridlock is good thesis positive for the economy overall?
Well, again, I think there's a difference between the long run and the short run. Scarlett, that's up for question over the next 30 to 60 days, because I think there's a high probability we could actually get a negative print on GDP in the 4th quarter if the COVID scenario plays out the way that I'm predicting. But 6 months from now, we know that the policymakers will have reacted, and the more unstable things are in the next 60 days only increases the probability we get an even bigger stimulus. And the other thing is it's all clear, right? That they've made it clear now that taxes aren't going up, and people can go buy risk assets and play for the game.
Scott Meinert, I look at where we are. In effect, as markets rallying, we've got dollar dynamics, EM doing better, Japanese yen powering through 104 this morning. It was stunning to see the yen strength. Is the Pacific Rim, is there enough of a growth vector there to support the rest of us?
Well, it's interesting, Tom. I was just looking at some data the other day, and, China has become the dominant economic power of the world now. The majority of growth in the world is coming out of China. So, clearly, I think that the torch is being passed to China as the economic locomotive of the world, which was always the role of the United States in the post-war era. And, it raises serious questions about the dollar as a reserve currency and what the role of the RMB will be in the future, based on the fact that China is becoming a dominant player.
Scott, I got to go in a few minutes and ask Jay Powell a question, and I'm wondering what it is that the markets really want to know from the Fed. We know they're on hold right now and probably going to be on hold for years. They've given us additional forward guidance. They've come out with a downbeat statement about where the economy is right now. They've changed their framework. What's left for you to figure out from the Fed?
Well, what I'd like to know is, what is their view of the catalyst to make decisions, and what's the decision process look like? Meaning, are we going to increase QE first? Will yield curve control come to the fore under certain circumstances? And then, ultimately, the great terror of the Fed, which is, do you think that the market will start pricing for negative rates if we have a rough fourth quarter?
Within that rough fourth quarter, Scott, we were just talking about how the Bank of England managed to work in unison with what the government is doing over there. How much hope, how much probability, how much do you factor in that you'll get some sort of fiscal package, and to what size?
Well, I think that the Republicans now are more motivated than they were prior to the election, because they couldn't see it as compromising with Nancy Pelosi. But now that political problem is kind of set aside, and Mitch McConnell's already sending signals that he's willing to compromise. But I think, the president, if he is not declared the victor, which, by the way, I'm not expecting him to be, then in all likelihood, he's going to dig in and basically say, look, I need a payroll tax cut. No, we're not going to support municipalities. That's a bailout of the blue states. And I think the real problem before it was in the Senate. Now, since the president's passed the election, and if he has no path to the presidency, I think he's going to dig in.
And that could be we could be seeing that play out for weeks on end. I wonder, in the meantime, as we come to grips with the fact that perhaps fiscal stimulus will be a lot less than what people had anticipated, my understanding is that most Fed officials had incorporated some fiscal stimulus into their 2020 forecasts, somewhere in the neighborhood of $1 trillion plus. How would you advise them to adjust their assumptions at this point?
I think their assumption should be that there will be stimulus until next year. Even Congress, when it reconvenes and the Senate's back in session, they're able to come to some compromise. It's not likely to pass until December. And once the bill passes, it probably won't get implemented really or impact the economy until January. Now, if you believe what I do, which is this is all going to be put off until January, then you would think, well, it's going to be February. But the bottom line is, in the fourth quarter, I don't see the cavalry coming to the rescue of the Fed or the economy.
All right, Scott Minerd, thank you so much for your time. Scott Minerd, Guggenheim Global CIO, joining us from California. Tom?
Thanks so much. Right now, as we look at the Fed, we've got other election numbers coming in. I really want to this is quite important. We have a little bit of a movement in Arizona. I'm quite surprised by that, but there it is. I'll be honest, I haven't done the math yet. I'm going to do it here when we pick up our continued Fed coverage. But in Georgia, we have a really profound move. It's a 300-point nudge for Mr. Biden in this election that's transfixed all, including the Federal Reserve. And Caroline Hyde, we've moved from 13,000 and change down to 13,219. And again, that's a Biden advantage off the last tick of about 300 votes. That's with 98% in Georgia. And I'll do the Arizona math right now.
Please do get to your calculator. And of course, our wonderful Bloomberg opinion writer, Brian Chapato, was taking the joy of hindsight to be able to say, hey, I was calling this. Georgia on my mind. That should be what our investors are looking at. Georgia on the investors' minds right now. All swing states, of course, all battleground states in investors' minds. But Scarlett, it seems as though for now, the market has embraced the lack of clarity, the uncertainty, and we push higher.
I think the market just fixated on the fact that there is nothing new in the Fed statement, and it's just going to go with what we've known so far today, which is it's risk on and everything's in the green. All 11 sectors in the S&P 500 are up by at least 0.4%. And this is a much broader advance today than yesterday. This is therefore more bullish, according to Peter Chur of Academy Securities. Yesterday was a very narrow rally. The S&P gained 2.2% as decliners outnumbered advancers. And of course, we got to look at the 10-year yields overall. That's been just all over the place. Right now, the 10-year yield still up a bit at 77 basis points. Of course, it's been on this wild ride over the last 48 hours. And that, of course, we'll see whether it continues as we get more details on the vote count across some of those swing states. And you guys mentioned the Bank of England a little bit earlier on. I told you about how the dollar has been weaker all day. Cable is back above $1.30. The Bank of England coordinated with the UK government to extend wage support until March of 2021. It did boost its QE as well, gilt purchases, which is usually pound negative. But I think from what I've read, there's more fixation on this coordination between the fiscal and the monetary authorities at the moment. And of course, let's take a look at the Fed's balance sheet. I think we have that chart now pulled up. The big story here is that the Fed is doing nothing with its asset purchase program. Currently, it's on pace to buy $80 billion of treasuries and $40 billion of mortgage-backed securities. And back in September, which seems like ages ago, it said it would keep at least at the current pace, and that kind of looks like where we're at right now. And of course, the balance sheet there in blue, it kind of blew up in March, and that lifted stocks off its lows in late March.
Scarlett, great insight. I like that you referenced what happened with the Bank of England in the UK, because our next guest knows the UK well. In fact, he earned a blue there for basketball over at University of Oxford, but he was also studied at MIT, University of Northern Carolina. He also now, of course, is at Dean Emeritus, the New York University Stern School of Business. We welcome Peter Blair Henry with us, Professor of Economics, Finance, a man who knows global economy. That is your forte, your focus. Talk to us about how much the US needs to take basically a leaf out of the book of the United Kingdom and work in unison here, fiscal and monetary.
Delighted to be with you. So the United States is in a very important position at present. The Fed has basically done all it can do, with the exception of extreme emergency measures. And so really at this point, we're waiting for two things to happen in the US economy. One, obviously, we need another fiscal relief package. And I think you'll hear Chairman Powell allude to that and continue to allude to that pretty strongly in his remarks. But in addition to fiscal relief, the thing that you cannot lose sight of is that this recession that we're in, this downturn, is a public health-induced recession. And in the absence of serious policy changes to actually address the public health issue, COVID will continue to be a drag on the U.S. economy. So we need monetary policy and fiscal policy to work together, but very importantly, and yet to be determined, we need to see what will happen in this election. It's looking as though our next president will be Joe Biden. And the biggest news in that, from a market perspective, is whether there'll be a change in public health policy.
Your voice is important today, Peter, because you once led the Economics Advisory Group for then Senator Obama back in 2008, his presidential campaign. Peter, what policy do we need right now? You've done a lot of studying in between the work of policy making versus institutions. Policy where it's at. What do you expect? What is needed?
Well, what's needed is a clear focus. So the thing that changes economic trajectories of countries are when governments do three things: when they exercise discipline, and when they give clarity of direction. And so what's missing at present is clarity of direction, right? And clarity of direction in particular with respect to COVID. So as we know that cases are on the rise around the world. They're on the rise in the United States. And if we look at the data on what has happened in the U.S. economy, we know that the economy began to slow before we went into lockdown. So there's been a lot of debate about sort of, is this the slowdown a result of the lockdown, or is it the impact of public health? We know it's the impact of public health because people began adjusting their consumption behavior before we went into lockdown, which suggests that until we actually have confidence in public health, people are not going to resume consuming and engaging in the economy in the way they were before.
Peter,
so that's critical.
Good morning. Good afternoon. That's the second time I've said that, folks. Good morning. You'd think I was on Bloomberg surveillance. Dean Henry, you don't look like an emeritus. That's all I got to say. Peter, wonderful to catch up with you. Okay, you wrote a paper a while back, Institutions and Policies, which is why we're transfixed by this election. Our the perception is that our institutions have failed us. The perception is that our policies are going to fail us. What's a prescription for a Biden administration if they are selected in the coming minutes and hours?
So the Biden administration has got to, number one, reassure people that this is going to be a president for all the United States. I think that's sort of number one. Number two, I would say you've got to get very, very clear that it's not a surprise, Tom, that we've got to address public health, right? And so, in some ways, yes, the institutions have failed us, but if you look at the markets, one of the things the markets are telling us is that the institutions have held enough, right? The markets are sort of counting on divided government, and we have an orderly transition so far.
Peter, I think it's brilliant, but the fact of the matter is, and the Post had a great article on this today, the Washington Post, not the other one, about the collapse of the Democratic model in Florida. The fact is, Mr. Trump campaigned against socialism. How does a President Biden affect forward institutions and policies under the threat of creating a greater socialism?
Well, he's got to demonstrate his commitment to a market economy with his actions, right? The time for speeches is past, and the new president, assuming we have a President Biden, is going to be judged by what his administration actually does, and that's going to be the key, right? And so, but I would also point out that what happens between now and January, irrespective of who is the next president, and again, we think it's going to be President Biden, is going to be very, very important, Tom, from your point of view about institutions, because so far the reaction we've seen in markets is predicated on a fairly orderly transition, and that needs to continue. But President Biden, if we have a President Biden, will be judged on his actions. That's it.
Professor, we, of course, are talking about the snooze fest of the institution that is the Fed at this very moment, having done absolutely nothing. But steady as she goes, the support that they can unleash through Main Street lending facility, through the municipal lending facility, why is it not coming to bear? How can they make it so?
So the Fed's sort of relative quiet speaks volumes right now, actually. So Chairman Powell is the most respected policymaker in Washington. And the most important thing that he has in his arsenal right now is his credibility. And so he's going to continue to reassure markets that the Fed will do whatever is necessary in order to keep the wheels on this recovery. But probably the most important thing that Chairman Powell can do right now, because of his continuing credibility, is to continue his, what I would say is sort of credible, persistent, reasonable drumbeat for fiscal relief, and emphasizing again that this is an economic recession caused by a public health crisis. And we need to address the public health crisis, and we need to have fiscal relief. And so Jay Powell is very wise not to say very much beyond that, because he is the most powerful policymaker at present because of his credibility. And it goes to Tom's earlier point. Maintaining the credibility of the institution of the Fed has been critical in the Fed's ability to stabilize the economy right now.
We speak to you today, of course, Professor Henry, because you are a professor of economics, but you're also, I read, apparently a campus-wide slam dunk competitor finalist I'm interested in. But notably, you're also on boards of companies. You're on the board of Citi, you're on the board of Nike. Big companies are doing incredibly well right now. Banks are finding it tough, though, notably with yields at ever lower. Nike doing particularly well. But what do you say to smaller businesses right now? How hopeful are you of their sustainability?
Well, again, it's a very important point, Caroline. We have a two-tiered economy at the moment. And if you look at the data, right, so we had a bounce back last quarter. We're still 3.5% below trend. Unemployment's coming down, but in the unemployment data, we see a couple of really important things. One, a fall in female labor force participation, really important point. And we also see that amongst low-income workers, the employment numbers are still down by about 20%. And so we have to have, again, fiscal relief and policies to actually help smaller companies, smaller businesses bounce back. Otherwise, we're not going to see an overall recovery. We'll continue to be sort of this K-shaped recovery, as it were.
Well said, on a day.
Exacerbate the challenges we've seen related to income inequality in this country, which is, again, to Tom's point, it's part of the underlying political economy that's really pulling and putting pressure on our institutions.
And of course, inequality is exactly what was being written about in the Fed's statement just earlier today. And you speak so well of it when we got initial jobless claims today coming in worse than expected. Peter Blair Henry, great to have your voice on today. We thank you, Dean Emeritus and a professor at New York University's Stern School of Business. He talked about the markets. He discussed about the institutions. Let's have a look at those markets. Currently up 2.25% on the S&P 500. Phenomenal moves in small caps as well. The LTY, the Russell also really flying today. We see money moving out of the US dollar at great pace. We heard from Tom about the gargantuan move we've seen in the yen at the moment. You're also seeing the 10-year yield. What a move that we're seeing in terms of the VIX, though. Continuing 27, Tom.
Oh, 27 to VIX is extraordinary. I really can't say enough about this. What it's called, Caroline, is gamma or acceleration, and we're seeing that now. These are abrupt moves. Scott Minerd alluded to that earlier. The abrupt moves, not only in equities and the good feeling of up, up, up. I'm sure President Trump likes that based on his history. But today, Caroline, was correlated much more than yesterday. Summed together, NASDAQ 100 is a 9% lift. That gets your attention. The 10-year yield, multiple deviation. But when everything's said and done, today it's much more sewn together.
And what's so interesting is there's still lack of clarity, still uncertainty.
Yes.
Where we did gain certainty was a slow and steady as she goes Federal Reserve, continuing to pump money just at the tune of $120 billion per month, of course, in terms of the bond buying. That stays resolute. But what of the future? What we'll hear from Jay Powell in terms of support for the economy when fiscal stimulus still seems so far away, though being promised, of course, by Mitch McConnell by the end of the year. Let's get to Jay Powell now speaking.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we have taken forceful actions to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. Today, my colleagues on the Federal Open Market Committee and I reaffirmed our commitment to support the economy in this challenging time. Economic activity has continued to recover from its depressed second quarter level. The reopening of the economy led to a rapid rebound in activity, and real GDP rose at an annual rate of 33% in the third quarter. In recent months, however, the pace of improvement has moderated. Household spending on goods, especially durable goods, has been strong and has moved above its pre-pandemic level. In contrast, spending on services remains low, largely due to ongoing weakness in sectors that typically require people to gather closely, including travel and hospitality. The overall rebound in household spending owes in part to federal stimulus payments and expanded unemployment benefits, which provided essential support to many families and individuals. The housing sector has fully recovered from the downturn, supported in part by low mortgage interest rates. Business investment has also picked up. Even so, overall economic activity remains well below its level before the pandemic, and the path ahead remains highly uncertain. In the labor market, roughly half of the 22 million jobs that were lost in March and April have been regained, as many people were able to return to work. As with overall economic activity, the pace of improvement in the labor market has moderated. The unemployment rate declined over the past 5 months, but remained elevated at 7.9% as of September. Although we welcome this progress, we will not lose sight of the millions of Americans who remain out of work. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the services sector, for women, and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices picked up over the summer, in part reflecting a rise in durable goods prices. However, for those sectors that have been most affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer-run objective. As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check. The recent rise in new COVID-19 cases, both here in the United States and abroad, is particularly concerning. All of us have a role to play in our nation's response to the pandemic. Following the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to full strength. A full economic recovery is unlikely until people are confident that it's safe to re-engage in a broad range of activities. The Federal Reserve's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As noted in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As we said in September and again today, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, over coming months, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace. These asset purchases are intended to sustain smooth market functioning and help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. At this meeting, my colleagues and I discussed our asset purchases and the role they are playing in supporting the recovery. At the current pace, our holdings of securities are rising at a substantial rate of $120 billion per month, $80 billion per month of Treasuries, and $40 billion per month of agency MBS. We believe these purchases, along with the very large purchases made to preserve financial stability in the depths of the crisis, have materially eased financial conditions and are providing substantial support to the economy. Looking ahead, we will continue to monitor developments and assess how our ongoing asset purchases can best support our maximum employment and price stability objectives, as well as market functioning and financial stability. The Federal Reserve has also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments. Preserving the flow of credit is essential for mitigating damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances, such as those we find ourselves in today. These programs serve as a backstop to key credit markets and have helped to restore the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox. As I've emphasized before, these are lending powers, not spending powers. The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers are benefiting from these programs, as is the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we as a society should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. Even so, the current economic downturn is the most severe in our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year. And it may take continued support from both monetary and fiscal policy to achieve that. I'd like to mention a couple of changes that we plan on making to our summary of economic projections beginning in December. First, we will release the entire package of SEP materials at the same time that the FOMC statement comes out. Previously, some of these materials were released 3 weeks after the meeting as part of the minutes. This step will make more information available at the time of our policy announcements, including the distributions of forecasts and how participants judge the uncertainty and risks that attend their projections. Second, we will add 2 new graphs that show how the balance of participants' assessments of uncertainty and risks have evolved over time. These changes to the SEP will provide a timely perspective on the risks and uncertainties that surround the modal or baseline projections, thereby highlighting some of the risk management considerations that are relevant for monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I look forward to your questions.
Rachel. Hi, Chair Powell. It's Rachel Siegel from the Washington Post. Thanks very much for taking my question. I'm wondering if you can speak specifically about what indicators you're seeing that suggest the pace of improvement has moderated, including in the labor market, and how correlated those indicators are to the recent rise in COVID cases that we've seen going into flu season. Thank you.
Sure. So, of course, let's start with February. In February, we had an economy that was performing well. Then the pandemic hit and we had a record decline in activity in March and April. And then we had a record bounce back in May and June. And so, as I think would have been expected and was expected, the pace of improvement from May and June has now moderated. So it's not unexpected. And I think if you look at just about anything, for example, the payroll readings, the payroll job gains in May and June were just outsized. And they're certainly still very large, but the pace of improvement has moderated. That's the case for all different measures in the labor force, in the labor market rather. Another would be claims. Just about all the data showed a big bounce back, but then, as you would expect, when you sort of had a lot of people go back to work at once, the pace will moderate. Same thing with economic activity. Most forecasts call for, still significant growth in the fourth quarter, but not at the 33% annualized pace that we had in the third quarter. So in a sense, that would be as expected. We have been concerned that the downside risks, though, are prevalent now, which are really the risk of the further spread of the disease, and also the risk that households will run through the savings they've managed to accumulate on their balance sheet, and that could weigh on activity. But what we see up to the present really is continued growth, continued expansion, but at a gradually moderating pace.
Thank you. Marty Kretzinger, Associated Press.
Thank you. Could you talk a little bit about where you think the stimulus package that is being debated in Congress is, and how severe a threat that could be to the economy if it does not get passed, say, before January?
So it is obviously it's for Congress to decide the timing, size, and components of further fiscal support for the economy. And I will say that the support provided by the CARES Act was absolutely essential in supporting the recovery that we've seen so far, which has generally exceeded expectations. And I do think it's likely that further support is likely to be needed for monetary policy and fiscal policy. I just mentioned the 2 risks that I think we face, and those would be well addressed through more fiscal policy. One is the further spread of the virus, and the other is the lapsing of the CARES Act benefits and the savings on people's balance sheets that will dwindle. But I think it's appropriate for us not to try to prescribe for Congress exactly what they should do or what the timing of it should be or what the size of it should be, and leave it at that.
Nick Timrose.
Thanks, Chair Powell. Nick Timrose of the Wall Street Journal.
To follow on Marty's question, you really have been saying since April that more is needed on the fiscal policy front, and yet we don't seem to be that much closer than we were in the spring or the summer to additional spending. Two questions. Would the lack of fiscal support compel the Fed to provide additional accommodation? And are you and your colleagues being more vocal about the need for fiscal support because the capacity for monetary policy to support growth is diminished here given the low level of short and long-term rates? Thank you.
So on your first question, we'll take into account all external factors and do what we think we need to do with the tools that we have to pursue our goals. That's what we will do. And I've said on a couple of occasions that will go better and move more quickly if we have a broad set of policies from across the government. And we've said this from the very beginning. It's really, first and foremost, healthcare policy, getting the spread of the virus under control and working on therapeutics and vaccines and that kind of thing. Those are absolutely critical to the economy now. Those are important as well as health policies. They're going to be critical to the economy. Fiscal policy can do what we can't, which is to replace lost incomes for people who are out of work through no fault of their own. And then what we can do is we can obviously support financial stability through our lending programs, and we can support demand through interest rates and asset purchases and that sort of thing. So we're going to take the economy as it comes, including all external factors. So I think all of us lived through the experience of the years after the global financial crisis, and for a number of years there in the middle of the recovery, fiscal policy was pretty tight, and I think I just would say that I think we'll have a stronger recovery if we can just get at least some more fiscal support when it's appropriate. When it's appropriate and the size Congress thinks it's appropriate. I do think that will likely. And by the way, you see a lot of discussion on both sides of the aisle, on both sides of the Hill, that suggests generally that there will be something.
Thank you. Steve Leisman, CNBC.
Thank you. Mr. Chairman, also to follow up on sort of what Nick was talking about, two questions about quantitative easing. The first is, if the market is functioning better, as you and other Fed officials have said, and QE right now is designed for smooth market functioning, why haven't you reduced QE that you're doing if the market is functioning better already? The second question I have is, what good for the broader economy would additional QE do at this point, given that interest rates are already low and don't seem to be rising even above 1%? Thank you.
So on the first question, it's our asset purchases are serving both purposes, financial market function and support for economic activity. So, and that's really been true. I think in the very beginning of the crisis, the main focus was obviously financial market function, particularly in some of the major markets. But after that period, we've understood all along that our purchases are also supporting economic activity, and that's important. And that need hasn't dwindled at all. So we haven't looked at reducing purchases. So in terms of what they can do, first I would just say the purchases that we have in place are providing strong support to economic activity still, and by the way, they're sustaining the gains we've made in financial stability. We don't take anything for granted. We don't expect that things will deteriorate, but nonetheless, we have a habit of keeping things in place for a while. So we're not taking our gains in financial market function for granted, although admittedly they've been very large. So the asset purchases are just another very important piece of the accommodative policy stance that we have. And, as you know, we're buying $120 billion a month. That's $1.44 trillion, if I remember my times tables. And it's just providing a lot of support for economic activity. And by the way, removing just about the same amount of duration risk from private hands as QE3 did. So this is a big program, and it's doing a lot of good. And we also today, we had a full discussion of the options around quantitative easing, not quantitative easing, the asset purchase program, and we understand the ways in which we can adjust the parameters of it to deliver more accommodation if it turns out to be appropriate. Right now, we think that this very large, effective program is delivering about the right amount of accommodation and support for the markets, and so it continues.
Thank you. Craig Torres, Bloomberg.
Hi, Chair Powell. First, it's great to see you're okay and healthy. Chair Powell, what is the risk that we come out of this with lower productivity, weaker labor force attachment, slower growth, and important for your tools, Chair Powell, a cycle of lower real interest rates? And if you think this type of scarring is a risk, then I'm wondering what's stopping the Federal Reserve from having a more explicit dialogue with Congress about the particular types of fiscal support we might need to avoid this outcome, to make sure that you push away from the zero boundary, or that the economy does, when we exit this. Thanks.
Thank you. So you laid out nicely the risks of damage to the supply side of the economy, or scarring, as you put it. And we've been talking about those since the very beginning of the pandemic. The risk is that, for example, people are out of the labor force for an extended period of time. They lose their attachment to the labor force. And it's harder to get back. Your skills atrophy. It's harder to get back in. And the record is, if you don't get back in fairly quickly, it can be harder to get back in. And that holds down the whole economy. And by the way, it also it places enormous burdens on individuals who may have this happen to them at an important stage in their career. So it's important. And so that is one of the reasons why our response was so strong and so urgent at the beginning, and why we've called this set of risks out. I don't know how we could be much more vocal about it than we have been. Fortunately, for the economic recovery has exceeded certainly the downside cases that we were very concerned about, and even exceeded the baseline expectations. Now, that's so far. We are a long way from our goals, and we're sort of halfway there on the labor market recovery at best, and there are parts of the economy where it's going to be hard until there's a vaccine. The parts of the economy. So, that's the supply side damage. That's sort of the third thing that we talk about. The first, at the beginning, it was to provide relief and comfort. The second part was to provide support to the expansion when it came, and the third was to avoid longer run damage to the economy. And that's all of these things. I think we have been vocal. We'll try to continue to do that. And that's again, that goes to keeping this episode as short as it can be and avoiding unnecessary business bankruptcies, unnecessary household bankruptcies, and unnecessary long-term stays of unemployment, or supporting people through them so that they can maintain their financial footing in their lives and be able to go back to work in a productive way. It's very important that there is a real threat here of those things, and we're trying to do everything we can to minimize that threat.
Like, and whether you anticipate any consequences if they are not extended.
Yes, thanks. So first, let me say we do think that the facilities have generally served their purposes well, particularly in supporting the flow of credit, particularly acting as backstops to private markets. So overall, we think that the programs have gone well. In terms of the extension, we are just now turning to that question. We've had a lot of things to work our way through. Right now, we're just in the process of turning to that question and have, of course, not made any decisions. And in terms of the process, this is a decision that, of course, we have to make and will make jointly with the Treasury Department.
Thank you. David Gura.
IMF's chief economist, Geeta Gopinath, wrote a piece this week in which she said unequivocally we're in a global liquidity trap, and talked about the limits of monetary policy right now. She said fiscal policy will need to be the main game in town. And it's been a busy week. I don't know if you were able to pick up the pink paper and read that piece, but she does say 97% of advanced economies have rates below 1%. And I just wonder if you'd agree with her in principle that we are in a global liquidity trap and what the consequences of that would be. We've talked a lot about fiscal policy here domestically, and she talks about the need for sort of a global cohesive approach to fiscal policy. My second question is, you talk about how you follow the epidemiology. You're looking at the course of this virus. And I wanted to ask you about how you look at the course of Christine Lagarde laying out what the ECB plans to do. As you lent an ear to what she had to say, the dire warnings that she was making this morning as she looks at the situation that Europe's in, what can you and your colleagues learn about the second wave or the third wave that you've talked about and we've all feared when it comes to a policy response?
Okay, thanks. So 2 questions. First, I take the sense of your first question to be, is monetary policy out of power or out of ammo? And the answer to that would be no, I don't think that. I think that we are strongly committed to using these powerful tools that we have to support the economy during this difficult time for as long as needed. And no one should have any doubt about that. And we do not doubt the power of the things that we've already done or the things that we may do in the future. I do think there's more that can be done. And I also think if you look at the stock of assets that we've bought, if you look at the facilities and the way we've been able to keep accommodative financial conditions accommodative, I think we've been able to do a lot of things that are providing very strong support for the economy, and we're gonna keep at that. We've said from the very beginning, though, that this is the particular situation we find ourselves in is one where there is a sudden loss of income on the part of millions and tens of millions of people. It's not so much a typical recession where demand weakens, the Fed cuts interest rates stimulate demand, and the economy recovers. It's a sudden shock where tens of millions of people are out of work, and the fiscal response was frankly, I think, very good and very robust in the United States, and it's certainly one of the main reasons why the recovery has been as good as it's been so far. So I do think fiscal policy is absolutely essential here. You know, stimulating aggregate demand is one thing, but where there's a part of the economy that kind of will be resistant to that, you also need fiscal policy, and of course you need healthcare policy too. I didn't see Madame Lagarde's comments this morning, but I took the sense of that question to be the spread of the disease in Europe and what do we think about that? Yeah. So as I mentioned in my opening remarks, it's a concern. We have a widespread spike in cases across the country, more in some regions than others, and even if we don't have, and I don't expect that we would, government-imposed restrictions, it does seem likely, though, that people who have maybe begun to engage in activities that they hadn't, flying, staying in a hotel, going to restaurants, going to bars and things like that, that they may pull back in a situation where suddenly the cases are everywhere in your city, your state, your community. So I do think that that's a risk that we have as we go into the fall now and the cases spike. That could weigh on economic activity. One would expect that it would. We thought the same thing, in fairness, about the wave we had this summer in the South and the West, and the economy, seemed to move right through that. This one seems to be larger and more widespread. In any case, it's a risk, is what I would characterize it. I would characterize it as a risk, as I did in my comments.
Can I ask a quick follow-up just about the passions of the Fed chairman? We've listened to your rhetoric over the course of this pandemic, and you talked about what the Fed was doing, the reasons for doing it at first. You talked about the balance between monetary and fiscal policy. I think in your recent comments and in Governor Brainard's comments, certainly there's been more passion yet about the need for Congress to do more. I know you're limited in what you can say or the degree to which you'd want to advise Congress, but a simple question. Do you feel that you're being heard? As you look at the prospects for this economy and the potential need for more fiscal policy, do you feel like those who are crafting that policy or could be are listening to you and have a firm grasp of what you're saying about how that might affect or improve the economy going forward?
So let me say, in the first instance, our main focus is on doing our job, and that is really what we're focused on, is using the tools that Congress has given us and the assignment they've given us And I think that is the thing that we think about night and day. I just know from the experience of the last cycle, it helps to have the whole government working on these things, and this one is particularly that way. And I don't want to say whether I feel like I'm being heard or not, but sure, I think there are plenty of people on Capitol Hill who, on both sides of the aisle, on both sides of the Hill, who see a need for further fiscal action and understand perfectly why that might be the case.
Thank you. Thank you.
Thank you. Edward Lawrence, Fox Business.
Thank you, Mr. Chairman, for taking the question. So what would cause the Federal Reserve to shift more of its asset purchases towards the long-term securities and treasuries and change the amount of spending there also? And as a second point onto that, if there's no fiscal stimulus package, would that then trigger buying of more long-term assets or change the asset purchases?
So I don't really have a specific hypothetical I would put to you. I would just say that we understand that there are a number of parameters that we have where we can shift the composition, the duration, the size, the life cycle of the program. All of those things are available to us as ways to deliver more accommodation if we think that's appropriate. Right now, we like the amount of accommodation the program is delivering. And it will just depend on the facts and circumstances. We may reach a view at some point that we need to do more on that front. Today's meeting was about analyzing one of the things it was about analyzing the various ways and having a good discussion about how to think about those various parameters, which I thought was quite a useful discussion.
Thank you. Victoria Guida.
Hi, Chair Powell. Thanks for taking the question. I wanted to ask about climate change. FHFA Director Mark Calabria recently said that financial regulators need to account for climate change. I'm sorry. What are you all thinking of doing on that front beyond what you're already doing? And do you have any plans for joining the Network for Greening the Financial System?
Yes, so I do think that the public will expect and has every right to expect that in our oversight of the financial system, we will account for all material risks and try to protect the economy and the public from those risks. Climate change is one of those risks. It's the science and art of incorporating climate change into our thinking about financial regulation is relatively new, as you know. And we are, very actively in the early stages of this, getting up to speed, working with our central bank colleagues and other colleagues around the world to try to think about how this can be part of our framework. And we're watching what other countries are doing. We're active participants, as you know, in the the Greening the Financial System. We hadn't actually formally joined, but we're in the working groups, and we're doing all of that. So we're very much working with and monitoring the things other central banks are doing. You hear, there's lots of research going on at the various reserve banks and here at the board in trying to understand this. These tend to be longer-term risks, but of course, the longer term does arrive over time. And, we take it as our obligation to understand these risks and incorporate them into the way we supervise and think about the overall financial system and the economy.
Thank you. Howard Schneider, Reuters.
Quick follow-up from Gina's question. Have you gotten a commitment from Secretary Mnuchin to extend the 13.3 facilities if you decide it's necessary? And are you concerned what a lame duck Trump administration might do in that regard? And then more broadly, on the state of the economy, are you comfortable now that the tail risk for worst case outcomes has been kind of swept aside and minimized at this point? Are we down, in other words, to kind of household level problems among a large set of households, perhaps, but that the financial crisis, double dip recession sort of scenarios are off the table?
So on your first question, we really are just turning to this issue now, and we have not made any decisions. We are just getting started on it, and it's a decision that we'll make jointly with the Treasury Department, and that's really all I can say today. That's all I have for you on that today. In terms of the tail risks, I mean, I think clearly the tail risks that we were worried about have subsided. And, we were worried about very negative potential outcomes. And that's what is to be expected of us is to think about how things can go wrong as well as the way things can go right. But we do make policy from a risk management standpoint. We don't just look at the most likely case. We ask, how do you make policy in light of the risks? And often it's downside risks in a situation like this. I would not say that anybody's feeling comfortable about this, though. We've gotten through the first 5-6 months of the expansion better than expected, but we do see in Europe, look what's happening in Europe, look what's happening here, another spike in cases as the cold weather arrives and people are inside more. So I think we have to be humble about where we are relative to this disease. It hasn't gone away. Clearly, therapeutics are advancing, research on vaccines are advancing, death rates are way down, hospitalization rates are lower now, but so we're learning. But I mean, we're very far from saying that we think we've got this and eliminated the tail risks. But I think clearly the tail risks have diminished since, at least our perception of them has diminished since earlier in the year.
Thank you. Scott Horsley, NPR.
Thank you, Mr. Chairman. Earlier this summer, I know that you formed a task force to look at the distribution of coins around the system. I wonder if you can give us an update on how that's going. I know there's been some public relations effort. I think October was Get the Coins Moving month. So has that problem subsided?
So let me say why it's such an important, in a world where so many payments are made digitally and all that, coins and currency are very important for the relatively low-income people. And so it's a really incredibly important part of the payment system, and we do pay a lot of attention to it. And I actually just caught up this morning with the person who heads that operation here, who says that things have really gotten significantly better on the coin front. So we worked very hard to increase the supply of coins, and even more than that, the distribution of coins around the system, and are happy to say that situation is well on the way to normalizing itself. So very pleased to report that.
Thank you. James Politi, FT.
Thanks very much for the question, Chair Powell. We've just had a presidential election here in the United States. We still don't know who the winner is. Are you concerned that protracted tensions or uncertainty over the outcome of the presidential election could pose a risk to the economic outlook or trigger market turmoil? And has the Fed had any discussions either internally or with the Treasury Department about responding to that should it happen?
Thanks. So I'm very reluctant, as you will imagine, to comment on the election directly, indirectly, at all, other than just to say that it's a good time to take a step back and let the institutions of our democracy do their jobs. So at the Fed here, we will, as always, continue to do our jobs. Every day we'll continue to serve the American people using our tools to support the economy during this difficult time. You ask, have we had discussions? I would say, the meeting we just finished, for example, what we do is we talk about the economy and markets domestically and around the world. We hear reports on how households and businesses are doing. We talk about risks to the outlook. We talk about what the right policy response might be. And the election comes up in some, it comes up now and again, but it is not at all a central focus of the meeting, not at all. So I'll just leave it at that. Again, very reluctant to get into anything more than that. Thanks.
Thank you. Anakin, CNN.
Thank you for taking my question. Chairman Powell, can you tell us a little bit more about why the minimum loan size under the Main Street facility was reduced last week and why that was done now rather than earlier, seeing that small businesses are clearly still struggling to make the change necessary?
Sure. So We have had very little demand below $1 million in loans. And part of that just is that the fee structure is what it is, and that's the compensation that the banks get. And there's a certain amount of work that they have to do to get into the loan program and to document the loans that they make. Because these are loans that that go on their balance sheet. They keep 5%, so they actually have to underwrite the credit, and we're relying on them to some extent for doing that. And so we were reluctant. We moved the minimum down to $250,000, and we were reluctant to go below that. But we heard over and over again that it would be great if we could reduce it to $100,000. So, and we've been saying we'd have to redesign the program, and I got the question in an oversight hearing a month or so ago with the secretary and said that. Then I went back to the office and thought, okay, so what would that look like if we were to redesign the program in a way? It's the least thing we could do to redesign the program so that we could move to a lower level. And basically, we concluded we could just change the fee structure to create incentives for that. So we did that. We try to be responsive. We want, qualifying businesses to be able to borrow, and we'll see how much demand will come. With these programs, why didn't we do it right away? We tend to. There's more work than one might, certainly than I imagined, in setting up one of these facilities. And you just try to get it out there and get it working, and not try to do everything before you start it, because you'll never start it if you do that. Then you get it started, and you make changes. And we've been willing to make changes. That's the most recent set of ones that we've done. And again, we hope that it will help some companies. And I guess we'll find out.
Thank you. Heather?
Heather Scott this time, right? Thank you, Chair Powell, for taking the question. You say that you're not out of ammo. So I'm wondering then, what is the next tool you expect to be able to roll out? Would you consider some sort of credit program for state and local businesses, state and local governments that are facing real budgetary pressures?
So when I say we're not out of ammo, I'm looking at a couple of our tools mainly. As I mentioned, the asset purchase program, there's a number of dimensions in which we can adjust that if we deem it to be appropriate. Right now, we like the job it's doing. We could, if the facilities are extended, we could certainly look at new facilities. If things deteriorate, that would be the case where you'd want to maybe continue the facilities and maybe change them and maybe have new ones. Who knows? But certainly the facilities have been doing a lot of work and been very successful, I think, overall in accomplishing that job. So I do think there are things that we can do. But remember, we've always said this will take a whole of government approach, including healthcare policy and fiscal policy too. So it really is, if you want to get the economy back as quickly as possible to where we want it to be, then really it should be all of government working together.
If I could just follow up on that quickly. I mean, you spoke about the small business lending program, but that has only reached 400. There's only been 400 loans. When you say the programs are effective, do you not think there's more that can be done with another type of program or another redesign, either for small businesses or for, as I said, for state and local governments?
Yes, there's a bunch of programs. I would say that the larger corporate market-based lending program has been very successful without making a single loan. I think unambiguously has been a big success. I think the state and local government program has also restored market function, so that whereas there were the sort of individual investors who wind up funding loans in the muni market through mutual funds. They had withdrawn a lot of money, and that we've had many weeks consecutively, I believe, of inflows there, and you're largely back to a normal functioning market. I think that's also been a success. I think certainly the funding market programs have been a big success. The Main Street is just a bigger challenge than all of them. Reaching out to small and medium-sized businesses through the banking system, which we had to do, is quite challenging. I do think the grant programs, the PPP, were a great way to reach smaller companies. What you hear out there is that demand. You talk to banks and they'll say demand for loans is very, very low right now. Companies are not borrowing, and the reason is that the activity's at a relatively low level. They don't want to run up their debt. We put an awful lot into Main Street, and it is very challenging to reach a lot of those companies. But I think we are reaching many of them now, and I hope that the new changes will help us reach more.
Thank you. Last question to Michael McKee, Bloomberg.
Mr. Chairman, there's a small but growing number of people, including some former Fed economists, who say you should find ways to go beyond your mandate to provide additional support to the economy, which in essence would be fiscal support since it hasn't come from Congress. One of the suggestions is buying state and municipal securities directly. Another is perhaps following the BOE in increasing asset purchases to support additional fiscal programs or spending by the Treasury. Is there any circumstance under which you would consider those, or those would be justified? How closely are you willing to work with Treasury?
So I'm going to take your question literally, and so if the idea is money-financed fiscal policy, that's not something that we would consider. So that what I mean by that is really, the central bank is really funding fiscal activities of the government fairly directly. No, that's not something we would do. We have different jobs. That separation between those jobs is absolutely critical in our system of government. The job of taxation and spending goes to people who have stood for election and been elected, and that's the way it should be. They have to be responsible to the electorate. We have a specific, job to do with a specific set of tools to support maximum employment, stable prices, financial stability, help the payment system, supervise banks, all the things we're assigned to do. But we're not going to get into financing the government. And by the way, when we buy government bonds, it doesn't actually, as you probably know, doesn't change the amount of government debt outstanding. We issue a reserve to purchase a Treasury security, and that's just another form in the consolidated balance sheet of the federal government. That's just another obligation. You change the nature of the obligation, but not the total quantity of debt that the government has when you do these asset purchase programs. So I don't know exactly what you're referring to, but to take your question literally about financing fiscal activity, it's really not something that we think the central bank should do, and not something we're looking at.
If I could follow up, there is a suggestion that you buy state and municipal securities directly in the same way that you buy mortgage-backed securities, providing then cash to municipalities that are cash-strapped at this point.
Well, we're doing that with the municipal liquidity facility now. So we're buying, with our own funds and with the CARES Act funds that we've gotten through Congress and the Treasury, we're buying municipal securities of up to 3 years. So we're doing that now as part of an emergency facility under Section 13.3, which has to meet the emergency requirements of exigent circumstances, and which is all clearly laid out in the law. So we're actually doing that now. But I see that what that is from our standpoint is a rare thing that we do under Section 13.3 when regular intermediation in the capital markets or in the banking system has broken down. It's no longer working. So we step in under 13.3 and we provide liquidity. What turns out to happen is we announce a program and the market starts working. So we only actually have to do a backstop. The amount of financing that's happened in the municipal markets this year is much higher than it was the prior year, and we didn't do it. We've done a very small number of loans, but just the fact that we're there as a backstop seems to get the private parties to get back together and get the market working again. So that's what 13.3 is for. That shouldn't be a permanent thing where we're just another federal financing agency that's available to direct credit to very worthy borrowers. That would be more along the lines of a GSE. That's not what we do. We're there to provide emergency liquidity when intermediation has broken down, and then to pull back on that when, as the markets normalize, we pull back and we put those tools away, as we did after the global financial crisis, and as we will here when the time comes.
Thank you very much.
Thank you. Thank you.
And there we have it. The last question going to our very own Mike McKee to Fed Chair Powell. That remote news conference winding up, and we know that there's no change coming from the Federal Reserve. $120 billion per month of bond buying remains intact. We see rates near zero. We do get some updates in terms of the words of caution, though, regarding the virus. Powell saying that the rise in virus cases is particularly concerning. He also sees the continued need for support from monetary policy, but once again calls out to fiscal measures to be deployed. He says they are absolutely essential here, but he would not be moved in terms, of course, about the election and politicking any further. The labor recovery, Tom, is halfway done at best, says Chair Powell.
Well, he did mention the democracy. I thought that was very, very important here. While he's been speaking, it has been a movable feast. Remember, we have two huge stories going on here. There have been micro changes in Pennsylvania, in Georgia, in Arizona as well. That really surprised me, and I don't have much to say about it except one headline, and I'm not sure where Mr. Powell was on that, and that's where Georgia votes went from 55,000 to count down to 47,000 to count. David Weston, of course, looking at that for us here as the news comes through this afternoon. The other thing I noticed was the data. It is still awfully good data, isn't it, Scarlett Fu?
It's awfully good data. Of course, data is backwards looking as well. The latest manufacturing numbers certainly show that that part of the economy is doing well. And in fact, Chair Powell referenced that and contrasted it with the slowdown that we're seeing in services because people simply can't go out and congregate and spend money on hanging out and dining out and going to bars the way that they used to be able to. When you look at the market reaction, it's pretty much a big yawner. We're looking at equities holding on to their advances. It's green across the stock screen right now, whether you're looking at big companies, small companies, tech companies, cyclicals. A broader rally, to be sure, than yesterday. So I suppose that's a bullish sign. But as we see stocks rise, we're seeing the VIX fall. And Carolina, I just need to correct myself. The VIX was at 30 yesterday. I'm clearly one day behind because all the days melt into one another. But it is lower this afternoon. And you can see it's below 28. Yesterday, really, the narrative was the price action showed a repricing from a blue wave to gridlock, where you have a divided government and the president and Congress are from different parties. And historically, that's been the best scenario for equities. You can see the average annual S&P 500 performance is a gain of 12.5%. In this election, of course, when you talk about a divided government and gridlock, we're talking about no big fiscal stimulus, no big infrastructure spending plan, no big tax hikes, if any, and no overarching regulation, particularly when it comes to technology. The next biggest move across the asset classes, of course, is the U.S. dollar. Tom has been talking about dollar-yen. Yen at an 8-month high right now versus the dollar. But the weaker dollar is the story here, and it's across the board, particularly against the emerging market currencies. Russian ruble stronger by 3%. Brazilian real, you can just see it up there, the kinds of moves that we're looking at there. The Fed is the only game in town, and it's going to mean more monetary stimulus. In fact, Tom, I was just looking at a note from Pantheon Macroeconomics, which indicates that they are of the view that faster QE is coming at some point, potentially in December, given that the language on COVID was not really that different. Pantheon thinks that it's going to be changed. It's going to change quickly in December when we get the next wave of COVID.
And Scarlett, clearly, as Caroline showed as well, a real shift here, a difference from the British model of what to do in crisis. Diane Swank joins us now. She is with Grant Thornton, and what is so timely here, Diane, is Chairman Powell was channeling classic Swank economics. I was blown away by one quiet moment where he said, you know what? It's not about the money flowing, it's about the demand for the loans. And this sounded classic Swank economics, that the demand for loans really isn't there. Is that an indicator of how weak this economy is?
It is, and you clearly see, this was the Fed trying not to make any major news, although he did make some news, I think, in his press conference. The Federal Reserve doesn't want to be in the middle of all the election, clearly, But I think what's really important here is how concerned he is about what the world looks like without additional fiscal stimulus. And, that interchange he had with Craig Torres about the scarring in the U.S. economy, which is something we're also very worried about, that if you don't get more fiscal stimulus, what kind of recovery can you have on the other side of this if you don't get it soon? And I think that's very important as well.
At some point, when we get the data you're speaking of, will it be enough to have the politicians act?
I've been holding my breath and I'm turning blue waiting for this deal to be done. Mitch McConnell was more optimistic about a deal getting done in the lame duck Congress yesterday than he has been. That said, I'm not holding my breath until the next president, whoever it may be, whether it is Biden or President Trump, sworn into office, because I do think that the politics are difficult at best. And I think we're also talking about a much skinnier package than the one that has been negotiated or being worked on between Treasury Secretary Mnuchin and Speaker Nancy Pelosi. And I think that's important as well, because Speaker Pelosi has lost some of her ranks as we go into the new year. And the Republicans in the Senate know that, and they would like a different size package. So that scales back the size of the package that they deliver either to a President Trump or a President Biden. And I think the most likely scenario is that we don't get it until we get that next president sworn in.
Dan, you haven't held your breath about your calls for December when it comes to the Fed. You've long argued that the FOMC will be there come December. What do you expect in terms of the addition to 120 billion bond buying? Where will they look to be buying? What do you see?
It's interesting because he used that word that will keep the bond purchase program at least at 120 billion. And I think that was very important. That was a tell. I also think, his talk about how they can use their asset purchases more liberally. I do expect, even though long-term rates are low and they've come down recently, that the Fed will be buying more long-term maturities in the Treasury bond market. It will be interesting to see as well is if the Fed is willing to dip its toe further into the toe of fiscal policy and extend maturities on its municipal bond buying program. There are some within the Fed that would like to do that, others that would rather not cross that line. When all bets are off, if we really see the negative risks that are out there with a resurgence in cases we're currently seeing and a further pullback in consumer spending and by businesses, I think it's important to understand that the credit card data has really stalled out in the latter part of October. And as we're moving into November, when things should be ramping up, we're losing even more momentum. And much of the growth we saw in the third quarter was due to the gains we saw when the CARES Act was in full force in May and June. It wasn't due to what we saw later in the summer as actually growth started to peter out. And as he talked about, you noted it earlier, that we're only halfway back on the employment losses, and we're still well below the losses we saw during the Great Recession.
Diane, it's Mike. I'm wondering why the Fed should do anything in December. You're not the only one who's calling for Fed action then, but suppose they increase the amount of asset purchases. What's that going to do in an economy where borrowing costs for cars and homes are already at rock bottom, and there is, according to the chairman, not that much demand for loans right now?
Well, the Fed doesn't want to admit that it can't do anything. First of all, that's clear, which he made clear by saying they didn't think the Fed was in a liquidity trap, although that is something that the IMF has talked about, and I think that's important. And also the ECB is worried about it as well. But I think what we are seeing going forward is that, the Fed is going to have to do, they're forced into this terrible position they were during, the subpar recovery, only it's even worse. And that is that their tools aren't well suited to deal with this situation, but also they still need to do something because we could get yet another step down in the economy. I think the chance of a negative on employment in the month of November and December is very high. The economy could flatline or worse in the fourth quarter, given the kind of patterns we're seeing and what could be this larger pullback as cases surge if we cannot stem the overwhelming of hospitals, which it looks like we're not doing a very good job of doing. So I think the Fed is going to be in a position where economic conditions are deteriorating, and it could also trigger, I fear, some financial market instability that the Fed will want to try to intervene on. I think that that's one of the things they're most worried about at this stage of the game. But you're right, as things stand right now, things are already low, and the loan demand, as Tom pointed out and Chairman Powell pointed out, isn't exactly there, except for in the housing market, which is the only sector that he noted had fully recovered from the crisis.
What's also low, and I'm looking right at it in a chart next to your face, Diane, is the dollar, currently off by a percentage point, weakest in 2 years if you're looking at the Bloomberg Dollar Index. Diane, what does the dollar mean for the U.S. economy? How does it aid corporates? How does it help trade? Or we know that the consumer is the backbone in the U.S. economy. Does the dollar do anything?
It's one of these things that, again, because of the unique nature of COVID, it doesn't really help us as much as it should in terms of manufacturing activity. If Europe, in fact, is shutting down now, they're doing it more strategically than they did in the past. That's good. But their purchases of goods are not likely to be what they've been, and that means our exports are going to be hurt. So a weaker dollar is not going to help offset the fact that they're already not buying as much. So I think that's the dollar doesn't have the kinds of effects that it once could have had in terms of helping us out in our manufacturing sector. And I think it's more a reaction to the thought that the Fed may push rates even lower in the U.S. and that economic conditions they're clearly worried about in the U.S. as well.
Diane Swank, what will you see on Jobs Day tomorrow? It's such a blur with the election, but guess what? There's a jobs report. What will we see?
I think we're going to see a sharp slowdown in jobs growth, which already slowed to 661,000 last month. It could be as much as half of that. We saw the preview of that in the ADP report. I don't think they're closely correlated, but we're losing over 130,000 jobs in the census alone. Plus, we counted up about 200,000 layoffs that were tied to the end of everything from the bailouts for the aid for the airlines to keep their furloughed workers on payrolls to also additional layoffs that were coming due to COVID, everything in theaters to amusement parks, all of that, and in some oil industry that really are layoffs that are starting to mount, and some of those will show up as a headwind to the overall employment gains that we see in the month of October.
Now, Diane, you look at jobs and you look at the different ways to look at it. You know what? It still comes back to wages as well. I saw unit labor costs today, pretty sluggish. We've sort of forgotten about it with a partition of the American economy. What's your estimation of real wage growth right now? Is anybody making money or is it just the elite?
It's really interesting is how unique, we don't have a really good handle on wage growth because how many people who, one, lost their jobs and then took went into the gig economy to do all the deliveries that we're now seeing out there, and that has actually pushed wages even lower in that part of the economy. So, even in areas that had, not great wage growth, but, that's pushed that part of it lower because of all the influx of workers trying to chase after those jobs in the gig economy. So they're trying to make ends meet in any way they can. We also saw during the height of the crisis, many companies pull back and cut wages temporarily. They then restored wages. What I worry about is how much we could see some sort of repeat of that in November and December as cases resurge, depending on how strategic lockdowns are and how bad the pullback is by consumers as they deal with the fear of going out. Like I said, we're already seeing it in some of the high frequency data, and that's something that's already in the playbook, that when we do have some kind of shelter-in-place rules or are afraid to go out more, companies conserve cash by actually hitting a blow to wages. And I think that's something that is very hard to get at in the data.
Diane, let me follow up on that by noting Tom is like 6'4". I can hide behind him for asking a nerdy economic question. How sticky do you think wages are? Are employees at this point going to have to take what they can get because the labor market is so bad? Is there no leverage on the labor side these days?
Well, it's really interesting on that side of it because we've seen minimum wages at the state and local level move up quite dramatically since 2014 when they started. They don't want the government interfering in things, but they like minimum wages. Voters, whether they're red or blue, seem to vote in, or independent and purple, vote in minimum wage hikes. They tend to overwhelmingly favor that at the state and local level. So the minimum wage hikes have gone up. That said, we have a very perverse economy where we have labor shortages in construction, in the housing market sector, where the rest of the economy has excess labor in the service sector. So there are sectors where we've also seen in some factories where they've had shortages because of the number of people who had to take days off to stay at home with their children that are no longer in school, or because of the virus itself. In areas that had a surge in the virus, many factories had a shortage of workers because of so many workers out sick. In one case, a GM plant actually had white-collar workers go out and work on the manufacturing plant floor, and then the union said, please hire more union workers to do that instead of your white-collar workers to do that. But that's how this virus is so unique and unusual in how it's playing out in the labor market. It's not just that there's an overhang of workers. There are in the service sector, clearly, but there are these sort of isolated pockets where we see a shortage of skilled labor.
Amid election uncertainty, amid Federal Reserve, we still all come back to the virus. Diane Swonk, we thank you, Chief Economist at Grant Thornton. Stay well over there in Chicago. Always great to have your time. Now, let's get back to these market moves. They're big. They have been big for the past couple of days. Scarlett Fu, bring us in the latest.
Yeah, they've been big the last couple of days. They haven't been so big this afternoon, but we continue to keep an eye on the dollar here, which is down, down, down. It's off by 0.9%, the Bloomberg Dollar Index, at its lowest since April of 2018. And when you look at WCRS, it's pretty stunning. This is against the expanded majors, and you can see the emerging market currencies are really flying against the dollar. But even against the G10 currencies, we're looking at one-day moves of at least 0.6%. You don't normally see those kinds of moves in major pairs. So once again, the dollar continues its trend of weakness on Fed days. Also, of course, looking at the 10-year yield and the 2-year yield, they're both higher right now. The 10-year yield has had a wild couple of days. Today, yields have been so-called leaking higher. Senate control is still uncertain here. And, of course, everyone's not necessarily ruling out a blue wave, but it's still potentially on the table, depending on how things shake out in Georgia. And if you do have a blue wave, that means massive stimulus is potentially back in play. Let's also take a look at the yield curves here, because the 2s10s curve is steeper. The 530 yield curve is somewhat flatter, but it's certainly a change from what we saw yesterday, which was much more of aggressive flattening. Before this week, there were a lot of questions on whether the Fed maybe would need to step in and say something to halt the steepening yield curve. Cameron Kreis over at MLive blog points out that over the last few days, there's been a correlation between the 530 yield curve and the ratio of the Russell 2000 to the NASDAQ 100, in which small caps outperform big tech, and you also have this yield curve steepening, which perhaps indicates that there's a little bit of that blue wave trade. It's still in the markets right now. Caroline?
All addicts to Scarlett's market insights, but also to the MLive blog, the TLive blog. If you've got Bloomberg's, tune into them. Meanwhile, let's get more insights on these markets. We're pleased to welcome, with, well, 25 years of experience, and boy, do we need it right now, Alan Ruskin, Deutsche Bank Chief International Strategist. Your FX head, your bond head, your markets expertise here. Alan, how have you been digesting, in particular, for example, the dollar move off the back of this election uncertainty, the market actually embracing uncertainty?
Yeah, I think, if there's been a surprise, it's been the dollar against maybe the G4 currencies. But I think the real story is the way the tail has wagged the dog, to the extent that we always expected the biggest moves, the more emphatic trades were going to be related to emerging markets. There was, very direct impact on dollar China, for example. That poll was going to drive things, and that's exactly what's happening, really. So I think you're seeing, obviously the Chinese currency doing well, Asian currencies doing well, emerging markets doing well, and I think the knock-on effect has been to drag pretty much all the G4 currencies with them as well, and brought some currencies into what is effectively new terrain, where it might become self-reinforcing. I'm thinking of dollar yen in particular.
Well, dollar yen, the acceleration today, Alan, was jaw-dropping. Alan, this is the money question, and you and I have been doing this long enough where I think it's really important. We're at a point of sea change, whatever this election is. Is the market indicating finally the bigger move in weaker dollar that Steve Roach and others talk about? If, like, for 2 standard deviations out around Plaza Accord, we were down 28% in dollar weakness. Do you scope that kind of move, or is this just more noise along the way?
Tom, I don't think this is noise, but actually I would say that on the contrary, if we have a combination which the market's angling towards, which is Biden with a Republican Senate, that combination is likely to reduce the risks related to twin deficits. So, we're looking at smaller fiscal deficits and smaller current account in particular. The current account piece is at least as important, probably more important than the fiscal piece as far as currencies are concerned. And, I think we're mitigating risk, if anything. And, I think we will probably still see dollar weakness, but I think we're taking away from the extreme overshoot scenarios that we could look for where the dollar would weaken by 20% relative to fair value.
Okay, this is really important. This folds into our conversation with Peter Hooper today and David Folkerts-Landau at Deutsche Bank. Alan Ruskin, twin deficit, my chart of the year a couple years ago is a stunning, never before imagined negative 18%. Do you envision twin deficits going back and regressing back to the mean, or are they permanent here and they only get halfway back, say?
Well, Tom, I think we need to make distinctions between what's going on the fiscal side and what's going on in the current account side. The current account side, you're just seeing at the very beginnings of a deterioration, but it's very modest. You're seeing the U.S. current account move from around 2.5% to a number like -3 or thereabouts. It becomes particularly important if we see an adjustment, I think, to -4, -5%. So fiscal, a current account deficit of 4 or 5%. That's the kind of numbers where current accounts have a material impact on currencies. The fiscal side, I think, is one of very much, cyclically adjusted what will happen. There's a presumption that a lot of the fiscal expenditures just fall off as long as the economy holds good, and that you will see the fiscal accounts improve. But, when we talk about improvement, you're still looking at numbers, maybe -7, -8% of GDP. And the reason for that is the starting point was so poor. We're starting with a cyclically adjusted fiscal deficit before the COVID crisis hit of 4.5 to 5%. So the starting point is a problem on the fiscal side. The current account, we've still got everything to play for, I think. But so far, the feed through from the fiscal side, the dis-savings there onto the external accounts has been quite modest. So that one we've got to watch very, very closely for, particularly in the currency world.
Follow on to that, Alan. If the government continues to spend at the rate it is and continues to borrow at the rate it is, and all governments essentially doing it, do we reach a point where people don't want to buy anymore? Everybody was surprised that the pan-European bonds sold so well. And B, do we run into a debt problem where the central banks can't raise interest rates because they'll send basically the whole world into default?
Yes, well, central banks are all central to all angles here. I think, the central banks are critical to financing and keeping interest rates subdued in the face of these large fiscal deficits. I fear that if central banks were successful in terms of driving up inflation, then in fact that would drive up interest rates, and you would, get into some sort of debt servicing related. I hesitate to use the word crisis, but you're certainly getting to problems as it relates to debt servicing. So I think they're straddling a very narrow line, really, just helping the financing for the time being, keeping yields pretty subdued. But if you get a little bit of inflation and above inflation, then I think the credibility issues come into play, and then the debt servicing issues are big as well.
Alan, your notes were digested at quite a velocity in the run up to the elections, and particularly your calls on which direction for equities, which direction for bonds and the dollar in the reaction to how we see the chips align. The chips are still aligning. We're still in an uncertain moment. Where is your call right now in terms of the yield curves, for example? We were having that broken down by Scarlett before we came to you. Do you expect steepening? Do you not at the moment?
Yes, I think we need the election to be settled, of course. But, if the market's views are correct, that it's looking like a Biden presidency with a Republican Senate majority, then I think we've more or less seen the bond adjustment. That was always the easiest trade, that, we'd trade off the idea of less fiscal stimulus or more fiscal stimulus. In this instance, we're trading off the idea of less fiscal stimulus and bond yields coming lower. I think the problem is, how low can bond yields go? We've seen, prior to the election, we traded, in low 60s, for example, fairly easily. But I would say we've probably had the bulk of the bond rally. Today we unwound a little bit of what we had yesterday, but I'd say, can we stick at, say, 70 basis points on the 10-year? Yes. The 2-year is stuck. So all the yield curve flattening is going to take place through the 10-year, and it's going to be modest from here on out.
Alan, I know you're not on speaking terms with George Saravelis, but I'll make a try here. He has a 2-part FX report for you today, and one of it is long EM and particularly long Pacific Rim. ADXY, the Asian index ex-Japan, breaks out. Is it a true breakout where we really can believe long the Asian currencies?
So, Tom, George and I are always talking and are good friends, and we actually agree very nicely on this trade as well. So the Asian, trade, I think, has got a very firm foundation. At its epicenter, I think, is China. China's economy is outperforming all others. Partly as it relates to, getting hit by the virus first, coming out of it relatively successfully compared to a lot of other major economies. And the economy looks very robust. The external accounts look good. The Chinese have not really needed much in the way of monetary stimulus. So interest rates are high in relation to certainly the G10 world. So there's a lot of pressure, I think, for the Chinese yuan to continue to appreciate. I think the fundamental story is very clear. It's just a question of what the authorities do in terms of limiting the pace of appreciation. So that pull factor, I think, is huge, both in terms of the economy and in terms of financial prices. And, any of the proxies that you look for, Korea, Taiwan, currencies, et cetera, they're all getting pulled along for the ride. That's just part of the story. I think there's another angle in there that even some of the high yielders, notably India, are also doing very well. And that's not because the virus is, the stats are poor, but the economy is actually, coming back and proving quite robust.
Quite amazing when you look at the emerging market functions today. Nearly every single currency pair currently up against the dollar, all except that Argentinian peso. Alan Ruskin, great to have you with us. We thank you, Deutsche Bank Chief International Strategist, taking us global in our thoughts after the Fed. But guys, let's get global, let's get US, let's get political as we head towards the end of the Fed special. Tom, you've been busy there on your calculator throughout. What's the latest headline that you're looking at?
Well, we're looking at the math, but what I would really look at is T-Live. T-Live, folks, is our compendium of reporters like Michael McKee, people with real jobs, unlike me. And the granularity in the last hour on this election is extraordinary. And the number one message, Caroline, is the idea of officials really beginning to scope out recounts. We see that in Georgia with a headline from our Daniel Flatling moments ago, and I begin to see it in Wisconsin as well, but I'd really focus into this evening, into David Weston's work on Georgia.
Scarlett, the price action that we've seen in small caps in particular, the blue wave trade, it's wooing people back, huh?
It is. It hasn't died completely. Yesterday was a reversal of that, but we are seeing the Russell 2000 outperform all the major indexes. It's up 2.6%. In contrast, the NASDAQ 100 up by 2.2%. Of course, these are minimal moves here because we're all looking at gains across equities overall.
And Mike, of course, the Federal Reserve is basically the only thing we can not be surprised by at the moment. No change. But what was your key takeaway from the last couple of hours?
Well, I think the Fed wanted to make no news and succeeded at that. At this point, we don't know who's going to be president. We don't know what the virus is going to do. And so, see you in December.
Well, we leave it there. No surprise from the Fed. Plenty of surprises to come, I'm sure, in terms of the election. Tom Keene, Scarlett Fu, Mike McKee. This is Bloomberg.
there are $3 billion being prepared. So the lending program has increased. So that's the very important feature we did not expect.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostic.
Guys, what a day. The majors currently up more than 2 percentage points really across the board for the NASDAQ, up 1.93 for the S&P 500. But your star performer, the potential for a blue wave, and it certainly looks like one there on the screen, the light blue is your Russell 2000. Suddenly, there's sort of hints of amid the uncertainty that bet is one to place again, Romaine.
Yeah, an interesting day here because remember, yesterday's rally was very narrow in a certain sense. This is a much broader rally here. Of course, you saw the S&P 500 up a couple of percentage points, but so was that equal-weighted version. That's a complete reversal from what we saw yesterday, where the equal-weighted version of that was flat. Materials, which was one of the biggest decliners yesterday, getting a pretty strong bid here, and that's been the story for a big part of the day here. Big tech, the chip makers, they continue to rally. But now you're seeing the materials, you're seeing the industrials. Marijuana stocks were sold off yesterday, now getting a strong bid. Tilray looking like it's going to finish the day here up more than 20% here. Also seeing these solar names, the renewable energy names, again, which sold off yesterday because some of the uncertainty around the election. Now those bids coming back in here. You can see one of the main ETFs, TAN, right now up 11% here on the day, Taylor.
Well, and let's get right to it. For more market analysis, we're joined by Jack Manley, global market strategist at JP Morgan Asset Management. Jack, I am curious. We've had a huge run just in the last few days post-election. Are equity markets looking just past all of that volatility, even though we don't even have a final outcome yet?
I mean, I think a lot of that is what's contributing to the optimism that we're seeing. Just finally having election day come and gone. We're moving on. We know we're going to get an answer relatively quickly. We can start thinking about the bigger picture items. I do think that's a help. I think markets are also looking at how this election is playing out. And while I still do think it's too close to call, I wouldn't necessarily want to count my chickens before they hatch. I think one of the biggest things that we can see coming out of this election, at least as it stands right now, is more stimulus in the pipeline. It's what we need really more than anything else at this moment, given that the pandemic is still raging. There is still no vaccine out there. And I think once we get past the partisan squabbles that have been occupying Congress for the last couple of months, we can get down to brass tacks and actually move forward on this stimulus. I think that's a big contributor to the optimism as well.
How big the stimulus? Is it big enough to sustain these moves?
Well, I think it depends a lot on who's in charge and what the composition of government looks like. We know that stimulus is a bipartisan topic. Exactly how much to stimulate with and who to stimulate is up for debate, clearly. But we know that we'll get probably a round of $1 trillion at least in additional stimulus before the pandemic is up. You combine that with what the Fed is doing, the fact that markets are starting to look beyond the virus into a post-virus kind of run rate, I think it can be argued that you can justify what's been happening now, just that additional clarity that we're looking to see in terms of where things may be going.
And so the additional clarity and the reflation trade, and I guess a lot of the trades now being placed here that don't necessarily seem to be tied specifically to fiscal stimulus, but more broadly on some of the policy decisions that the market thinks the White House and Congress would make over the next 4 years here. What specifically do you think the market really wants to see beyond just sort of the immediate effect of fiscal stimulus?
So, Romaine, I think one of the biggest things that we can deal with right now is almost paradoxically that a mixed government may be the best way forward for markets at the moment. You get a little bit more stability, but at the same time, you avoid some of these things that markets may have been a little bit spooked about, things like higher corporate taxes, things like additional regulation that you would see under a blue wave. So we're looking at things like that as perhaps not being as certain as they seemed even a few days ago. Of course, you have to balance that against perhaps not getting as much fiscal stimulus in the event that we don't get a blue wave. But I think the absence of higher taxes, the absence of greater regulation, or at least the possibility of not higher taxes and no more regulation, I think are certainly encouraging. They're being taken in stride by markets at the moment.
Yeah, definitely. A little bit of stasis here seems to be what the market is banking on. Jack Manley, he's sticking with us, helping us count down to the close right here on Bloomberg Television. About 5 minutes to go. And Taylor, a lot to talk about here in the markets.
Yes, we are, and it's Fed Day, so I'm standing up and really walking you through literally these charts that we're about to show you. And you've just heard from Jay Powell. It is lower for longer. That means it is good for tech. So here, of course, you're seeing some of the biggest monthly tech outperformances that we've seen. March and April, of course, were decent as well. But otherwise, you have to go all the way back almost a dozen years. Lower for longer. Some of these renewed virus cases, lockdowns, certainly really, really good for big tech here as we post some big returns. I do want to flip up the board. It's not big tech, but it's one of those smaller, high-flying tech stocks that we look at. It is still earnings season. So this is shares of Peloton, of course, on the day. You're up more than 6%. As we await earnings, of course, get to see what sort of benefit they can glean from gyms still being locked down. Look for 1 million connected fitness subscribers by fiscal 2021. How is profitability? How are they doing on fixing some of the supply chain issues, of course, as they have a big revenue backlog? Finally, let's flip up the board. And Jack, I'd love to bring you in on this chart. It is all about bonds. That's everything that we do as we go cross-asset here on the close. I'm taking a look at inflows into HYG, some of the biggest that we've seen. Jack, this comes Monday after LQD, the investment-grade ETF, saw the biggest outflow on record, with Jay Powell saying we are lower for longer. Does high yield still get a boost here? Do all bonds really continue to get a boost?
I think all bonds in general do get a boost, either because of explicit or implicit Fed intervention. I mean, we know it goes without saying the Fed stepped in several months ago with a lot of these unprecedented stimulus measures. I think very broadly speaking, it adds support to the bond market. I don't know if it's great for bond investors because yields in general have been pushed lower. And as a result, I think there is a lot of additional interest in those higher yielding fixed income instruments. I push back a little bit on that, though, in terms of relative attractiveness. I look at a high yield index right now that still has elevated defaults relative to history, that still has a substantially lower recovery rate relative to history, and yet those two risks I don't think are accurately reflected in the spread. There is a lot of assumption out there that because the Fed will throw you that lifeline when nobody else will, it makes these bonds almost invincible. But at the end of the day, the Fed cannot make you make your coupon payment. And when you consider that upwards of 20% of the index is comprised of some of the more sensitive names right now, things like energy, travel, leisure, hospitality, retail, I think there is more risk out there than meets the eye. And so if investors do want to move into that space, I think they have to do so cautiously, fairly prudently, and I think working with active management.
Should, therefore, there be more prudence about running into the Russell 2000 at the moment?
I would think so. I mean, I look at where we stand right now, and even with the election, past us or soon to be past us, there is still a whole lot of uncertainty out there. And frankly, I think the virus and the timeline of the vaccine have always mattered a lot more than the outcome of the election. And as things stand right now, the United States is going through its third wave of coronavirus. We are heading into colder months. We're going to be more focused on being indoors, which could cause some additional problems. And we still don't have a clear timeline on where this vaccine actually is. I think there's also a lot of confusion in the sense that even once we get a vaccine, it will likely take several months, if not longer, for the broader population to be inoculated. This is not something you can do overnight. So the road to recovery, from my mind, is still a pretty long one, and it is a road that is really littered with these potential potholes. And if I'm still trying to be defensive, still trying to be conservative in that allocation, I would step back from small caps at the moment unless I was willing to take a whole lot of risk.
All right, well, that's the landscape here for what's going on in the U.S. Jack, as a global market strategist, I'm sure you also have to have your eye on the economic recovery going on elsewhere as well. We've seen Asia, to a certain extent, bounce back, particularly in the greater China region. And, of course, we know that Europe now is sort of grappling with some of its own issues with a resurgence in COVID-19 cases. What's your general outlook here for the rest of the world?
We continue to be long-term bulls on international markets. I mean, you look at places like Europe, Japan, they will get past this pandemic. There's some really exciting cyclical tailwinds to be found in that part of the world. You look at the composition of the European stock market, for example, it relies much less on technology, much more on things like financials, industrials, materials, energy, all of which should have a pretty nice tailwind when the cycle starts fresh next year. And then you look to places like emerging Asia. I mean, Romain, you mentioned China. It's a great example, but Taiwan, Korea, India as well. These are places that I think have very exciting high growth opportunities. You're looking at regions that are heavily exposed to manufacturing while at the same time not particularly exposed to commodities. They're fairly stable from a social and political perspective, and they have a very rapidly growing and very large middle class that is going to be entering the global marketplace over the next decade. You combine all of these things with a strong valuation argument, a pretty good income argument, all of these things I think point to long-term outperformance of those markets.
Jack Manning still with us, but we're going to take us to the close. We close up 69 points there or thereabouts for the S&P 500, but every single industry group in the green. It was materials that really outperformed the infotech as well. So clearly we're starting to see a broad-based risk on, and it was the outperformance of the small caps that really caught my eye, Romain.
Yeah, I mean, you had a broad-based rally here. A lot of those materials names really sort of participate in this rally. Of course, you had big tech doing its job as well. Apple looking like it's going to close up about 3.5%. Amazon up 2.5%. But then when you go down the scale there, you did see a lot of these, I guess, smaller and mid-cap names. Yeti having a monster day. Of course, the maker of those thermoses and a lot of other materials up 16.5% on the back of some good earnings. And that seems to be, Caroline and Taylor, the story for a lot of the reasons why some of these small cap companies rally. We did actually see some relatively good earnings out of a whole slate of these companies that seem to suggest that consumer spending is still intact, at least for a certain cadre of this market.
And you just take a look at the S&P 500. We're up for 4 straight days. That is the best 4-day period that we've had since April 9th. Remember, that's when we bottomed out on March 23rd. So really posting what has been a banner week as we see some calm through the elections, calm with Jay Powell, yields cross-asset. Caroline, you noted the VIX, relative calm, of course, in these markets. Let's go and bring back in Jack Manley, of course, who's still with us, global market strategist, JP Morgan Asset Management. Jack, we were talking about earnings, and Romain really highlighted this. We await some high flyers like an Uber, like a Peloton. You don't have to talk specifically about those, but some of these higher flying stocks, have you been impressed at the resiliency of some of these high flyers yet again in this market?
Yeah, I mean, we look at the earnings season. I think that there are a couple of things to take into consideration. One of them is that we did have an enormous amount of stimulus that was still making its way through the economy through the end of the third quarter. Of course, that helping with personal savings rates, helping to keep up retail sales, helping to keep up consumer spending. So from that perspective, there was a lot of support, not just from the Fed, but also from the federal government. But you look at the earnings season right now, and what I think is so remarkable is not just are earnings beating expectations at near record levels. We're seeing an extraordinary number of companies that have beaten, and they're beating by very large margins. What is also exciting to me is that revenues are beating, and they're beating in a big way. It means that this is not just cost cutting. There actually is a return in demand, and that is a critical part of the recovery story that we saw in the third quarter. And as long as that demand can be sustained, I think that this road to recovery becomes a little bit more smooth.
Yeah, well said, Jack. And of course, while we were speaking, we are getting a few earnings crossing the wire. T-Mobile coming in with its third quarter numbers. That revenue number is a beat, $19.3 billion. The street was looking for $18.2 billion. Adjusted EBITDA coming in also above estimates at $7.1 billion versus a consensus estimate of $6.3 billion. We should also point that the company is raising, here you go, raising its second half 2020 outlook. It's also raising its financial guidance for 2020 as well. Again, doesn't appear that they're attaching a specific number to that, at least not that we can see yet here, Caroline. But they are boosting their forecast here going forward. So that's certainly a bullish sign for investors who are looking for a little bit of stability here with the growth of some of these companies.
It is so sad when we're getting the drip feed from companies like TripAdvisor and then from Live Nation as well, and the losses that these companies are posting. It's such a bifurcated market at the moment. It is so the haves and the have-nots, and clearly those going to live events aren't doing, those perhaps going traveling aren't. But what we are doing, Taylor, is perhaps exercising at home. And Peloton, I know you've been all over this.
Well, you as well have been part of this story. First quarter revenue, here's the one number that we know, $757.9 million. That is a 25% gain on a quarterly basis, firmly beating estimates, which were for about $735 million. So you're getting $15, $20 million of an improvement here versus analyst estimates. I'm going to continue to search through this press release. Remember, this is a stock up more than 300% year to date. One of those high flyers, if we get some of these renewed shutdowns, can they fix those supply chain issues and get those deliveries out faster?
Yeah, and just to be clear, the number on your screen is that's where the shares actually closed at on the day. Right now, here in after hours trading, they're actually down about 5%, just to be clear there.
Oh, important. We'll get that number updated as soon as we can. But going back to Jack Manley, who's still with us, JP Morgan Asset Management, we await earnings. We await the next shoe to drop, really, it feels. Jack, what's been your key question coming from clients? What's been your key answer?
I mean, I think the biggest thing that we're looking for is what's the catalyst for that next step, as you mentioned. What is that next shoe that's going to drop? And I think we're sort of in a holding pattern right now. Romain, you said that earlier. There is some uncertainty that is now behind us, but there's still a whole lot of uncertainty out there on the horizon. I really do very truly believe that the next big thing for markets, if we want to see meaningful moves higher, is, if not a vaccine, at least a more concrete timeline on what this vaccine will actually look like. Once that happens, those have-nots of the last 6 months, when it comes to the economy, when it comes to the labor market, when it comes to the stock market, those are the things that are going to be able to start to come back. That's going to be that part of the market that starts to drive higher.
We want to thank you, Jack Manley, Global Market Strategist at JP Morgan Asset Management. Great to have you with us. Thick and fast, the earnings come. Uber, third quarter adjusted net revenue, $2.81 billion, basically in line with expectations. They say they're confident to meet the quarter adjusted EBITDA profit before 2021 end. They are posting a loss per share, 62 cents. The estimate had been for a loss of 61 cents, so a slightly bigger loss than expected. But overall, the third quarter gross bookings are coming in slightly ahead of expectations.
Is this still a growth story, though? I mean, is that what investors were looking for? Were they looking for growth this quarter?
Food delivery, I'm sure they were.
Which continues to outpace the rideshare business. No surprise there. We're all still at home ordering Uber Eats more than we are taking some of those Uber rides.
Yeah, mobility bookings, 5.9 billion. That was shy of expectations. Delivery bookings, though, 8.55 billion, well ahead of expectations that were for 7.8. But Uber down after market. Let's get you more coverage coming up. Bloomberg Markets at Close is still with you. We're talking more on the elections. Stick with us. This is Bloomberg.
Do you think you'll have to produce less beer in 2021?
No, I don't think so. I think consumers will find a way. But I mean, if there are restrictions, but consumers, of course, are smart and they'll learn to live with those restrictions, I think some occasions will migrate.
Uncertainty in politics, but The market embraces that uncertainty and we rise higher in stocks. What a day. We see volumes climb. We see every industry group on the green side for the S&P 500 and the outperformance of big tech, the outperformance of the small caps as well, front and center. But we've got a lot of earnings to break down. And Taylor, take it away with Peloton.
Peloton's an interesting one because it looks like the last quarter, that first quarter, looked to be an improvement on revenue, an improvement on EBITDA. A slight miss, of course, on earnings per share, but it really is that full year guidance, which should have provided some confidence here. First quarter connected fitness subscribers coming right in line. They're seeing better connected fitness subscribers going forward in the second quarter, better revenue in the full year, raising that. Still not enough for the markets. Again, this could remain a fact that this is a stock that's up 300% year to date, and digging in to see, of course, more concerns perhaps about some of the backlogs in those supply chains.
Yeah, two names in the video game space are reporting. Electronic Arts out there, their fiscal 2Q numbers actually coming in slightly below estimates here. The company also providing a 3Q outlook that appears to be lower than what the street was expecting. 3Q adjusted EPS, they're looking for 285. The street was looking for 301. Those shares down 8.3%. We should point out that its competitor, Take-Two, which of course makes Red Dead Redemption, actually having the opposite effect here. They actually reported earnings that beat estimates and guided higher. I want to take you to Roku now. Those shares actually moving higher here in after hours trading. That company reporting 3Q net revenue that came in well above estimates, $451 million. That's a 73% jump year over year and above the average of analyst estimates of 367. They're expecting 4Q revenue growth to be in the mid 40% range right now, Caroline.
Roku up 4.4%. Uber, let's bring it in because remember they got a big reprieve from the California voter in terms of Proposition 22, but they don't get reprieve from selling right now, down by 2.4% as their loss is coming in deeper than it was this time last year. It's an improvement in terms of loss from quarter on quarter, but basically in line with expectations. But nevertheless, we are still front and center the challenges facing this business as we see ongoing, down 18% in terms of its ride hailing, but their delivery does well. Sales of that division up 125%, Taylor.
For more right now, let's just go straight to it with more analysis. Mandeep Singh, Senior Technology Analyst over with Bloomberg Intelligence. Mandeep, we've given you a cool few minutes to look over the numbers. Is the delivery business not enough to offset some of the declines that we see within mobility?
Yeah, so delivery business top line is looking good, but it is a big drag on EBITDA. And what you are seeing with Uber is the delivery segment had negative EBITDA yet again, negative 183 million. So what it tells me is even though in the U.S. their revenue declined 30% and bulk of that was because of the strong performance of delivery, it wasn't profitable revenue. In fact, in EMEA and Asia Pac, they had revenue growth. So obviously the ride sharing did well in Asia Pac, and it contributed to the EBITDA in those regions. So Uber really is in a tough spot that it's scaling up. It's betting big on food delivery, but food delivery is inherently a lower margin business, and that's just making it hard for them to be profitable.
Yeah, and Mandeep, that's not a surprise. I mean, we've heard some pretty frank commentary about just the economics of this food delivery business here. But does this provide, I guess, Uber at least a little bit of a buffer until we get to the day where we're all...
It's a good point. Like, had it not been for the food delivery business, we'd be talking about a 50% decline in their top line. So it does offset the top line. But my problem is once we are past the pandemic and in a normalized environment, food delivery and grocery delivery, these businesses are not that attractive in terms of, a company of this scale burning so much cash, about $200 million in cash every month. It's just the economics are so poor that you have to think, what does the top line and the profitability look like 3 or 4 years down the line? And the picture isn't looking good.
Even with that win at the voting level with California?
Yeah, so that's a positive thing. I really think at least, their business model is validated now, and that goes for the whole, sharing economy companies. So that's a positive step. At least they don't have to spend as much on legal expenses, so their G&A expense side can come down a little bit. But all these are secondary. at the end of the day, I think investors are going to look at Uber and say, okay, do they have a moat in this transportation as a service business? And the answer is yes, they do have the scale. They have the brand on the ride-sharing side. But then when you look at the addressable market and the growth, there isn't much left in terms of Uber being a high-growth company anymore. So our view is Uber, even past the pandemic, won't be able to grow more than 20%, let's say. So this is more of the high-growth phase is over, at least in the near to medium term for Uber.
Mandeep, Uber coming out and saying that they are, quote, confident that they'll be adjusted EBITDA positive before the end of 2021. Remind us again, our textbooks used to tell us profitability meant net income. For some of these recently IPO'd companies, it seems we give them a pass, and as long as they're profitable on an EBITDA basis, we assume that they're profitable. Is that appropriate? Does that count? Is that enough?
Well, it's one of the metrics that we look at, and you know, at the end of the day, that's the metric that correlates with free cash flow. So, you know, it's an important step, but my problem is, let's say Uber gets to being EBITDA positive for 1 quarter. What happens beyond that? Can they sustain it? Can EBITDA grow over time? And that's where I have my doubts.
Talk to me, Mandeep, real quick here about Lyft. We're obviously not going to get their earnings until next week, but a company that I guess to a certain extent has a little bit of a different business model.
Well, so Lyft's problem is lack of diversification. We just saw in Uber's case, their EMEA and Asia-Pac revenue actually grew 20%, 30%. So that kind of acted as a buffer. In case of Lyft, they don't have that buffer, and the ride-sharing demand right now continues to be weak. And with the resurgence of cases and the shift to suburbs, the headwinds are so strong that I can't see them growing anytime soon, even once we are past the pandemic. So they really have a tougher challenge compared to Uber.
We want to thank you, Mandeep Singh of Bloomberg Intelligence, all things ride-hailing. And, of course, guys, this is after what was an immense day across the markets, and one in which we saw big tech once again remain, whether it's the haven of choice or whether it's actually a risk-on fervor that we're getting in the market, but certainly it was your outperformer. But even the chip stocks, quite phenomenal, Ramesh.
Yeah, it was an interesting move here. I mean, some people are pointing to this as a little bit more defensiveness. You're buying growth. You're buying, to a certain extent, what Mandeep was sort of talking about that Uber lacked, which is, of course, cash flow and a big cash balance sheet. So you saw the big cap names move higher, the Apples, the Netflixes, the Amazons, the Alphabets. You did see a bid, though, outside of the bigger cap tech names into some of the smaller cap tech names. And that seems, guys, to be a little bit more of a bet on this idea that there is a growth story here, economically speaking, and that some of these smaller and mid-cap type of tech names could be sort of tomorrow's big cap tech winners.
And lower for longer, certainly. Zero interest rates is a boost to tech as well. Caroline, the NASDAQ 100 posting the best 4 days that we've seen since April. So again, big winner with lower for longer as that theme, the stay-at-home theme, prevails.
Who won the election?
You know what? I think we need an update. Let's get that right now. For the latest, we welcome Bloomberg. Of course, we get to David Weston, who's been busy counting numbers ad infinitum. Tell us, David, what's the latest?
Yeah, I'm sorry. I don't want to let you down. I don't have the final answer here. But I think the latest really is Pennsylvania. The attention keeps shifting around. It was Nevada for a long time. We thought that was the answer. Now Pennsylvania, which says they're really going to have the vast majority of their reports on votes out today. And as we're watched, the lead that President Trump had has narrowed and narrowed and narrowed. Now Vice President Biden is going ahead in some counties. There are a lot of people who are thinking this is going to turn around in Pennsylvania. It may be actually that Pennsylvania could conceivably push the Vice President over the top. And we're going to hear from the Vice President shortly here.
David, as we watch these counts, I should say, we've already seen a few legal challenges from the Trump campaign. What do we know about the status of those challenges?
There are a lot of them. That's the main thing we know. There are a ton of legal challenges. Most of them haven't gone anywhere yet. In fact, a few of them have dropped out. They've gotten a couple of judges to rule their way, sort of saying you should let people come in and see what the voting is. One of the problems, I think, fundamentally, Romaine, is that the claim has been fraud. but I've seen precious little specific allocations about what the fraud is. They say there is fraud, so we have to protect against it, but I haven't seen any specific allegations of fraud. And I actually have been taken by how diligent it appears that these election officials have been. You have to remember, a lot of these people are volunteers, they're retirees and things like that, and they're working through the night doing the best they can. So there's a lot of lawsuits being filed, but it doesn't take that much to file a lawsuit. It takes a lot more to win a lawsuit.
Talk to us about Arizona. Counting underway as well. How does that count look?
Well, Arizona is a fascinating story, actually, Taylor. Good question, because as we know, the Associated Press, as well as Fox News, but the Associated Press, particularly pay attention to, made a projection on Arizona fairly early on election night. And there was a lot of consternation, particularly the Trump campaign really complained to Fox News about that. The Associated Press has stuck with their projection, although the lead of Vice President Biden over President Trump has narrowed and narrowed and narrowed in Arizona. Now, we talked earlier today on Balance of Power with Ed Rendell, the former governor of Pennsylvania, who is, albeit a Democrat, but Rick Davis, who ran John McCain's campaign, who's a Republican, and both of them agreed. They think, this is just their hunch, they think that the former Vice President Biden will ultimately prevail in Pennsylvania. And if that's true, that is sort of game, set, and match.
And what's interesting, David, is what the markets have been trying to think. And there's almost been hints of a replay in terms of the blue wave, the so-called blue wave trade going into your small caps, going into marijuana stocks. We've seen money going into solar stocks, for example. And this seems to come back down to Georgia right now.
Exactly right, Caroline. You've got it exactly right. For the longest time, it looked like it was very, very unlikely that the Democrats could take the majority in the new Senate. But now we certainly have one runoff of the two races. And now increasingly it looks like David Perdue, the incumbent Republican, may end up in a runoff. In fact, he himself is saying, well, if there's a replay, then we'll be just fine. So we could easily have two runoffs there. And now, given the way it's playing right now, both of those would have to go for Democrats. But if they did, we could end up with a 50-50 Senate, although I emphasize we wouldn't know that until the end of January, not when the Senate comes into session at the beginning of January, because the runoffs would be, in fact, in January. So this really is just hanging in the balance all across the board.
All right, and as we're talking to you, I believe we see former Vice President Joe Biden coming to the podium.
The economic crisis facing this nation. And we're reminded again of the severity of this pandemic. Cases are on the rise nationwide, and we're nearing 240,000 deaths due to COVID. And our hearts go out to each and every family that has lost a loved one to this terrible disease. In America, the vote is sacred. It's how people of this nation express their will. And it is the will of the voters, no one, not anything else, that chooses the President of the United States of America. So each ballot must be counted. And that's what we're going to see going through now. And that's how it should be. Democracy is sometimes messy. It sometimes requires a little patience as well. But that patience has been rewarded now for more than 240 years with a system of governance that's been the envy of the world. We continue to feel, Senator and I, we continue to feel very good about where things stand. We have no doubt that when the count is finished, Senator Harris and I will be declared the winners. So I ask everyone to stay calm, all the people to stay calm. The process is working. The count is being completed, and we'll know very soon. So thank you all for your patience, but we have to count the votes. God bless you all, and may God protect our troops. Thank you so much.
All right. We were just listening there, of course, to Joe Biden, of course, the Democratic nominee for president, awaiting, of course, the results of the November 3rd presidential election, saying that it is the will of the voters to choose the president, that every ballot should be counted, must be counted, in his words. He also talked about the fact that democracy is sometimes messy, but then he also finished by saying that he had no doubt that he and his running mate, Kamala Harris, would be declared the winners, guys. Let's bring back in David Weston. Of course, he is a co-host of Balance of Power. I believe he's still with us. David, Biden did touch on something about this idea of democracy being messy at times. And we should point out that these vote counts that we're getting and the time that it's taking to get these votes counted isn't necessarily unusual or abnormal.
No, actually, if you go back through history, recent history, there are a lot of elections in which we didn't know the answer when we went to bed at night on election night. It's not that unusual. And this year in particular, as you know, record number of early voters. Over 100 million Americans voted early. A lot of them absentee and by mail. Couldn't even start counting them in many states until election day. We all predicted this. And I understand what the vice president is saying. At the same time, I'm not sure this is as messy a democracy as a lot of us thought it would be. There are relatively few reports of real disruption at polls. There are relatively few reports of real irregularities going on, apart from some allegations being made in some lawsuits. Actually, I've been struck by the fact how orderly it has been. It's gone on. It's a difficult process, but we had a record percentage of eligible voters, a record percentage since 1900, the most eligible voters show up to vote, and that ultimately is not a messy democracy. That's democracy, I think, the way it's supposed to work.
Hear, hear, David, because also we braced ourselves on the streets of New York. You saw boarded up, and thus far we pray that they won't come into any sort of use as we see people remain calm and patient, as is being called for at the moment. I look back to certain tweets at the moment that are reminding me that December 12, 2000 was when we found out who won in the year 2000, Gore versus Bush. How much do people managing to keep their perseverance, their patience, and just talk us through the next steps from your perspective?
Well, I was running ABC News in 2000. I was there. I was in the control room when we got the calls wrong. I had to go down and testify in front of Congress. It was not a pleasant time, but it was also a big shock to us. There are some parallels in the sense that the country really is divided 50-50, and that's certainly, I think, what we're seeing in this election this time. There are also some important differences, because in that election, pretty early on, we knew it was a handful of counties in southern Florida that would determine the presidency. This is different. We have Nevada. We have Arizona that some people still think is being contested. We have Pennsylvania. By the way, we still have North Carolina and Georgia. So this is a much broader issue. It's not focused on one particular part of the country deciding it. And right now, it's too soon to tell anything, but right now, it looks like the former Vice President Joe Biden has more paths to get to that 270 magic number than President Trump does.
Yeah, we always have to remind people as we sort out these votes. I mean, this is a record year for turnout, and of course, an unusual year in that a good number of the folks out there, the majority actually voted by mail or some sort of form of absentee voting. David, always great to get your perspective here. Of course, he is the host of Balance of Power. David Weston, you can catch him every day for all of our politics coverage. All right, let's go over now to Mark Crumpton, who's standing by with the Bloomberg First Word News. Mark?
Romaine, thank you very much. The presidential contest between President Trump and the Democrat Joe Biden now depends on the outcomes of a handful of states. Each has different rules on counting votes and contesting results, and that could further delay the declaration of a winner. A winner has not yet been declared in Pennsylvania, North Carolina, Georgia, or Nevada. Nevada officials say they will not have any more election results to release until tomorrow. Judges in Georgia and Michigan quickly dismissed Trump campaign lawsuits today, undercutting a campaign legal strategy to attack the integrity of the voting process in states where the result could mean President Trump's defeat. The president and Joe Biden continue to battle it out in Pennsylvania, whose electoral votes now loom large. In Pittsburgh, Allegheny County Executive Rich Fitzgerald spoke to reporters this afternoon.
At this point, there are approximately 35,000 mail ballots that are to be looked at. In that 35,000 ballots to be looked at, 29,000 ballots have been ordered by federal court to not be handled or processed until 5 o'clock on Friday.
The president's campaign said it was moving to intervene in existing Supreme Court litigation over counting mail-in ballots in Pennsylvania. Stay with Bloomberg. We will have more on the outcome of the presidential race. Thank you for joining us. I'm Mark Crumpton. We'll be back in just a moment.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Going into the fourth quarter, we're going to have to see how healthcare systems grapple with the next wave of the pandemic. But I believe that healthcare systems have now learned a lot, learned how to manage the cases better. So overall, we're cautiously optimistic.
From Bloomberg's World Headquarters in New York, I'm Caroline Hyde.
I'm Joe Weisenthal. I'm Romain Bostic. Let's get you caught up on where U.S. financial markets stand right now, because you had technology, you had industrials, you had financials, everything rallied. Right now, extending the biggest rally that we've seen since April.
But the question is, what do you miss?
Confusion, Joe. Good thing we're a financial channel, because right now it's all about the math. And it all depends on what numbers you're actually using. With control of Congress now up in the air, big bets on gridlock are being unwound somewhat. Bond yields pushing slightly higher again. What is certain, though, is the Fed has America's back. Jay Powell confirming the central bank supported the economy and calling for further fiscal stimulus. Joe, the market is desperately trying to price in that size of the future stimulus, given control of the Senate remains in question. But it's pretty amazing how much markets have rather thrived in this uncertainty.
Yeah, once again, I mean, here we are trying to figure out what's going on in the election, and it has not been an issue. But for more on the latest, I want to welcome Bloomberg Government Kyle Trigstad. Kyle, thank you so much for joining us. Just what's your view right now? What are you watching most closely?
Well, right now we're waiting for final results in Georgia. Of course, the presidential race we're watching, but the Senate race, David Perdue, Republican senator there, just dropped below the 50% threshold necessary to avoid a runoff. If those results hold and he finishes with less than 50%, he will be going to a runoff with Jon Ossoff on January 5th at the same time as the other Senate seat in Georgia goes to a runoff. Then all of a sudden we're looking at control of the Senate being decided after the new year.
Yeah, I mean, the story in Georgia intriguing both on the Senate level and, of course, on the presidential level. What's happening in Arizona right now? Because there seems to be some confusion as to which way those electoral college votes are going to go.
Yeah, of course, AP and Fox have called Arizona for Joe Biden. I'm hearing we're probably going to be getting a lot more votes in by tonight, and we could see some more networks follow suit and it go towards Biden. But it's interesting in Arizona because it's the opposite of what's happening in Pennsylvania and Georgia, where Trump's lead is dwindling. In Arizona, it's Biden's lead that's dwindling, and we're waiting to see how much. Good thing for Biden, a lot of the outstanding votes are in Maricopa County, which accounts for about 60% of the vote, and it's gone very blue for him so far.
I'm interested in, you mentioned Pennsylvania, because if Pennsylvania is called, sort of all bets are off to a certain degree. Do we have any decision, any idea when that might happen?
Well, there's over 500,000 votes still outstanding. We're supposed to hear by the end of the day about a good amount of them. One interesting county is Allegheny County over in the west. That's Pittsburgh's county. Biden's leading there by about 20 points. There are about 35,000 outstanding ballots. We're not going to hear about those until Friday afternoon, early evening. So we may not know until then, depending on what happens with what we're hearing today. There's more than 100,000 votes still outstanding in Philadelphia, which of course is very blue. So that's going to be a good thing for Joe Biden, most likely. He's going to be cutting into the lead and potentially taking the lead by the end of today or into tomorrow.
All right, great update there from Bloomberg Government's Kyle Drigstad. Of course, keep an eye on what's going on with the U.S. election. We'll bring you any results that happen to break here during our hours. But we want to get over to the other big news of the day. The Federal Reserve standing pats on rate today, making no changes to asset purchases either. That's all as expected. And we heard from Jay Powell, who made an unusual, I guess, to a certain extent, plea for additional fiscal stimulus. For more, let's bring in Seth Carpenter. Of course, he joins us as UBS chief U.S. economist. Seth, I guess what we got out of the Fed today was what everyone expected. Do you think that Jay Powell's plea, this idea here that he needs to see more fiscal stimulus out there to be more comfortable with this economic trajectory, was out of line for him?
So I don't think so. And I think the one thing everyone can remember is going back even pre-COVID, there was sort of a chorus of central bankers globally asking for a bit more fiscal policy because interest rates were low, inflation was low, and it wasn't clear how economies were going to come unstuck from that. Now with the COVID shock and the sort of biggest, sharpest collapse in a single year that we've ever seen, I think it sort of renews that call. And if you look at our forecast, the UBS forecast is the baseline. In the baseline, we don't get back to pre-COVID levels of GDP until the very end of 2021 or maybe the beginning of 2022. So I think it's very consistent with what he's been saying.
Seth, there obviously isn't a lot more that the Fed could do on rate policy right now, especially with its forward guidance strategy. In theory, and Powell hinted at this, they could do more long-end Treasury purchases. In your view, would that have much effect on anything?
Well, I think the hard part is it probably represents the most of what they have left to do. I think at the margin it would, in fact, put some downward pressure on longer-term yields. Right now, they're buying $80 billion per month of treasuries, but only 35 or so billion per month of those are 5 years and longer. So they could shift all of those purchases to being 5 years and longer. That puts some downward pressure on yields at the margin. I think the hard part is we've seen monetary policy really struggling to get an economy to really move forward all by itself.
And almost testament to that was what we've seen over in the Bank of England and the UK government today. It was notable how they worked in concert and what move that therefore made in terms of inspiring confidence within the Great British Pound. Seth, your perspective that we might ever get that? Are you feeling that we could see enough fiscal spending to really line up with the monetary policy here?
Yeah, so I think at this point, I'm a little bit skeptical. It all comes down to what the results are from the election. Your previous conversation about what could happen with the Senate with Georgia, I think really is critical because we've been saying, go back to July when we were framing out the election, split government versus unified government really is the difference when it comes to fiscal policy. If the Democrats do not have a majority, then I think we need to consider what we saw in 2011 when there was a split government, there was antagonism between the minority party and against the president, and you had contractionary fiscal policy at a time when the economy still was so far from potential and the unemployment rate was still high. So I personally think they'll be able to eke out one more COVID relief package in the new year, a small one if it's still a split government. But in contrast, what we said is if there's a unified government, the Democrats control everything, then probably right at the very beginning of the year, a much larger COVID relief package, and that would sort of go in the same direction that Powell's been calling for.
Okay, and then sort of course, as we all sort of await to see what Congress does next, Seth, there are a lot of real people out there who still don't have jobs. We've got, of course, that weekly jobless claims data today, and tomorrow we're going to get an update, of course, on those monthly numbers, which seem to have been trending down.
I think that's exactly right. And that's where I think the fiscal policy impasse is most costly, is that we're talking about millions of Americans who are unemployed, and the supplemental unemployment insurance benefit was allowing those people to make all of their bills, make their rent. And so what we're looking for tomorrow, the UBS calls that we'll get one more month of deceleration in job growth. We've seen correlation across the states where the higher COVID cases are correlated with less job growth. We think that's going to be a factor with tomorrow's jobs print.
So let's suppose Biden were to win, Republicans hold the Senate, stimulus is off the table, we're already looking at deceleration of job growth. How long in the sort of no stimulus view does it take to get back to pre-crisis levels of activity or employment?
Right. So our view has been, even in a split government, maybe they eke out one last package in the spring. Take, for example, the Republican Senate proposal that never got enacted. If even that doesn't happen, then I think we're looking well into 2022, maybe the second quarter, third quarter, possibly later before we get back to pre-COVID levels of spending. So that fiscal policy really is going to be an important lever.
Always great to have your voice, Seth Carpenter, joining us. And your face, glad to see you on the video as well. UBS chief U.S. economist. Stay well, and thank you. Now, coming up, Democratic nominee Joe Biden needs to win in just one more state to reach 270 electoral votes. That's according to AP, of course. We'll dig into the latest numbers out of one of the closest states yet to be called. It's Georgia. More from Atlanta with Bloomberg opinion columnist Connor Sen coming up next. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
All right, let's talk about one state where the election results are extremely close or uncertain, Georgia. Bloomberg opinion columnist Connor Sen following that race closely down there in Atlanta. Connor, what are you watching most closely? What's the gap? How many votes out? And what's the trajectory of things right now?
Sure. So right now, the gap is down to a little bit under 13,000 votes, which is Donald Trump's lead over Joe Biden. And we have a little bit under 50,000 votes to go. So the question is that enough for Biden to come back? And it's really, when you think about not just where the votes remain, which is predominantly counties in Atlanta and Savannah, very Democratic strongholds, but also the type of votes we're talking about, which are predominantly mail-in ballots, which were the preferred way for Democrats to vote. So it's really sort of, it's going to be, the remaining ballots are very, very good for Joe Biden. It's just a question of when those ballots come in and are reported by the counties.
And as these ballots come in, Connor, I mean, I guess the geographic makeup of some of these ballots seems to be the focus of a lot of people, because it seems to be shifting the tide, not only in the presidential race, but potentially in that Senate race as well.
Right, yeah. So this morning, David Perdue in the sort of one of the Senate races, his margin over John Ossoff shrunk to the point where that's now likely to go to a runoff. He's below 50%, which is the trigger for a runoff. So we're likely to have 2 runoffs there in January to decide control of the Senate.
Is the market paying attention to it, do you think? Because what was interesting is suddenly we got a bit of the blue wave bidding back on, it would seem.
I don't think markets are paying attention yet, maybe because, and we talked about this yesterday, I think the sort of market action we've seen over the past couple of days is just these blue wave positions unwound. And so people sort of, whether it was cover their tech shorts or buy their tech stocks back, volatility came down. We're still kind of adjusting to what happened on Tuesday. And I don't think we're really looking forward to January or 2021 yet.
And so, I mean, once we start to get clarity on Georgia, and then, of course, the other states, Connor, that will potentially decide this, maybe potentially before Georgia, is there a general sense here, though, that that no matter what the result, we're going to probably end up with some type of gridlock in Washington, and that, I guess, I don't know how you sort of create the equivalence here, but that somehow equates to good things for the market?
I think the market will assume gridlock just because Democrats have had such a poor record of winning runoffs here in Georgia. Traditionally, you've seen sometimes black turnout isn't as strong after the presidential race is over in these runoffs, and that's tough in a state where the electorate's 30% black and mostly Democratic. I think the one factor that will be interesting is that, if Biden does pull it out in Georgia, that could really motivate and excite people. What will Donald Trump do on the way out, potentially? Will that motivate anti-Trump voters?
Right.
And then also, I think the idiosyncratic nature of these Senate races, where especially in the special election race between Raphael Warnock, the Democrat, and the incumbent Republican Kelly Loeffler, it might take her a while to consolidate the Republican voters. And at the same time, Warnock didn't really have much scrutiny in the first round. So I think that could actually start with a pretty decent polling lead for the Democrat, which maybe would raise some questions to the market in terms of should we predict Democrats could pull this off.
So let's talk a little bit more about Georgia, because obviously there were a number of so-called swing states where Joe Biden was not as close as he was in Georgia. Florida was called very quickly, not that close. Ohio State, it looks like he's probably not going to get there. North Carolina. So of all those, it seems like Georgia is his best shot. What was it about the message and the makeup of Georgia voters that puts him in real contention to win the state?
Well, I think if you look at the sort of polling misses in the areas where Donald Trump outperformed nationally, we sort of missed on these Midwestern white voters somewhat again. And while they might swing in the Midwest, in the South, they're pretty solidly Republican all the time. And so there really wasn't a chance for a polling miss there. And then also we saw the Latino weakness that Joe Biden had in South Florida and South Texas. And while there are some Latino voters in Georgia, they just don't matter nearly as much as they do in other states. And so to the extent that was a polling miss, that wasn't a factor here either.
Connor, I think you pointed out something smart on Twitter, you always do, but one of them is that perhaps our worst fear, this is obviously not the sort of situation anyone wants, this uncertainty, but David Weston said it earlier, actually the process is following its due course. And as we've seen it, the real fear and anger, we haven't sort of come to bear. What do you think about how people are listening to some of the noise that's out there at the moment?
I think there are enough voices that can sort of have authority in terms of whether it's your Nate Silvers of 538 or Nate Cohn at the New York Times. People are trusting the process. We're counting the votes. The votes are being tabulated and recorded. And we're seeing how this is going. And we kind of have an understanding of whether it's election day votes are more Republican, mail-in votes are more Democratic. We sort of get how this is going. And now we just have to see how all the votes get counted.
All right, great stuff. Appreciate your insight. Great coverage. Our thanks to Bloomberg opinion columnist Connor Sen watching those Georgia results. Now, coming up, we'll break down the latest FOMC decision and also talk about economic policy under the next administration, whoever runs that, with Bloomberg opinion columnist Carl Smith. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
All right, all our focus here on election 2020, what it means for the economy, and of course, what it means for markets. The S&P 500 up for a fourth straight day, now heading for its biggest rally since April. Bloomberg cross-asset reporter Katie Greifeld here with more.
Well, Romaine, let's talk about tech. The NASDAQ 100 index is having its best week since April. It's up about 9.4% already this week, with one more trading session to go. That's beating the S&P 500, which is up about 7.4% for context. And the bulk of those gains came after Election Day, and this next chart helps explain why. Now, you had seen that even though we don't officially know who won the presidential race, markets feel pretty confident at this point that Democrats won't take both houses of Congress. That's put a dent in some of those reflation bets. The calculus there that had been that should we get a big fiscal package from a blue sweep that would boost bond yields, but you've seen 10-year interest rates on nominal bonds and real interest rates fall this week as those hopes faded. Now, that's been great news for big tech companies, which have rallied massively in this low interest rate environment. And we just got another reminder this afternoon from Fed Chair Powell that those low rates aren't going anywhere for a while. Back to you, Joe.
All right. Our thanks to Bloomberg's Katie Greifeld bringing us the latest from markets. Now, for more, let's bring in Bloomberg opinion columnist, co-founder of Modeled Behavior, Carl Smith. Carl, thank you so much for joining us. We don't know anything. We don't know who's going to be the president. Right. We don't know who is going to control the Senate. Let's suppose we have a makeup of government that does not have the capacity for fiscal stimulus. Well, actually, do you think that a divided government could pass fiscal stimulus here? And B, how problematic would it be if they can't?
Right. So I think that there is the possibility of passing something probably small now. McConnell has even signaled that. I think whatever incentives Pelosi had for rejecting a small package, and the Senate has said all along it would do a small package, have kind of evaporated now because she's not going to have a unified government in January anyway. So it's better to go ahead and take, whatever you can get now. One that's just good for the economy, but also that's going to help, Biden start the administration well. So I think there's the possibility for something small, and there always was, I think, the possibility for something small. It's just that Pelosi really wanted to hold out for more. The big question, I guess, is 2021. I've been arguing all along that there is the possibility for a large stimulus there. It's probably going to have to come with major concessions to the Republicans on, longer term things. I think, everyone would be benefited by just, laying their cards on the table that they're trying to stuff longer term things into the stimulus and then just give the Republicans some of the longer term things they want, give the Democrats, EITC expansion and CTC expansion that they want, and then push a stimulus through. So that's possible. It's really how, I guess, the partisanship tilts.
Right.
Are people looking for that deal?
Absolutely essential is what Fed Chair Powell called a fiscal deal. How does it matter that it's small if it's sooner?
Well, I think I'm going in and out, but I think, a small deal just for the next 3 months is probably okay, given where we are. I mean, obviously, things would be more secure if there was a really solid package. The really hard lifting is negotiating the 2021, and if all you get is a $500 billion package now and then nothing at all in 2021, it's hard to see how we don't slip into a traditional style recession.
Carl, I mean, you seem to be a lot more optimistic than me. I'm having a hard time seeing sort of what the path would be to something larger, even once we get to 2021. Even if you go by the market scenario right now, that it would be a Biden victory, you would still have a Senate that, even if it's in Republican hands or Democratic hands, is pretty much going to be about a 50-50 split. Do you think that there really is the will, politically speaking here, to actually do this?
I think it's possible. I think it's sensitive to how people approach it. I mean, one thing I think that's neglected is that when we had negotiations the last time, Obama, and I think the conventional wisdom was that we should be moving towards austerity, and so they were wrangling over who was going to hurt the most. It's a completely different kind of game if you're arguing over who's going to get the most goodies. That's a game that Joe Biden is particularly good at. I think even early in the Obama administration, Harry Reid and some other people were angry that he was a little bit too eager to play that game with McConnell. But if he wants to do that, I mean, every indication that I have from people like McConnell that there are senators who have things they want, Republican senators who have things they want. And if they get it, they'll play ball. Obviously, there are going to be some people who are more on the Tea Party side who just feel like they can't go along at all. But you really only need, like a handful of senators plus the Democratic senators to get something through.
Carl, if you were advising Biden, what would you advise him to do regarding the existing trade policies that President Trump has set on course, particularly with China?
That's hard to say. I haven't thought about that in a while.
Sorry,
I mean, obviously, I thought the president made mistakes going into it, but I mean, I would be hesitant about just completely reversing course. I mean, you probably want to give that some strategic thought. I know there's a big rethink going on in Washington altogether about what the future with China is going to be going forward. Just about everybody I talk to wants there to be some sort of decoupling, at least of, essentials from China. How far that goes, I don't know. What it looks like, I don't know. I'd have to give that some hard thought because it's more of a geopolitical question now than just economic.
All right.
We want to thank you, Carl Smith. What great opinion, as always, our Bloomberg opinion columnist on all things factoring the economy right now. Joe, we ask it every day, but I mean, we're all sort of blinded by counts and tweets, but what are you looking at?
I don't actually just check my phone in the morning anymore because, in my sleep, I lift up my phone now and see if I got any alerts or push notifications about new states being called. So I'll probably just be checking my phone every 45 minutes throughout the night tonight, see if any conclusions. Yes, that's my plan.
And then you'll be as fueled on caffeine the next day as always.
Can't you tell how much enthusiasm and energy I have from my 8 cups of coffee today? I hope it comes through.
It's a little bit like having a very small child, I feel like. Every 45 minutes is pretty bleak, though. But
yeah.
Now, I have to say, that's all from What You Missed.
Bloomberg Technology is up next.
Have a great evening. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome to a Bloomberg Special Election 2020. I'm Emily Chang. 4 more states. Ballots are still being counted in Pennsylvania, Nevada, Georgia, and North Carolina. If former Vice President Joe Biden wins just one of them, he will have the electoral votes he needs to become the next president of the United States. With President Trump's lead narrowing, he is taking to Twitter, making allegations of voter fraud, claiming victory is all but secure. Twitter hiding many of those tweets behind a warning that they are misleading. And Biden just spoke moments ago, reaffirming his confidence that he will secure the presidential election.
And we continue to feel, Senator and I, we continue to feel very good about where things stand. We have no doubt that when the count is finished, Senator Harris and I will be declared the winners. So I ask everyone to stay calm, all the people to stay calm. The process is working. The count is being completed. And we'll know very soon.
We will be following the results with live reports from Pennsylvania, where we're just learning that the Trump campaign has filed a lawsuit seeking an immediate injunction as votes are being counted there. We will also take you to the White House and Biden headquarters